sense is that we will see a sell-off continue. This was only a dead cat bounce. It was a bounce probably celebrating the new government that came in. But beyond that, economics will now take center pole.
Um, do you think there is a little bit more value now in mid caps and small caps? How are you looking at things there? Or do you think that you may not want to necessarily be buying just yet? Maybe a little bit more, price correction is warranted.
So I am of the firm belief that we will see further price corrections happen. Valuations are, although they've corrected a bit, they're still on the premium side, and this selling is not abating very early. Also, we have a lot of IPOs that are coming, so those are absorbing the money supply and not coming to the secondary market. So we will continue to see some kind of sell-off.
Vineet, I know it's a tough one because, while the market itself, the benchmark may have not corrected as much, portfolios have come off quite sharply. And there is money on the sidelines. And I know yesterday everybody was talking about how we should go long equities, buy sectors that are exposed to the US. So case in point, IT was looking attractive. Not that I'm saying anything has changed this morning, but we were in conversation with the management of Datamatics where Mr. Kanodia indicated that all this is euphoria for now. If anything has to improve or change, we're still staring at 4-5 quarters out from now. Keeping that in mind, do you feel like loading up on IT stocks right now is a good time, or it may be slightly ahead of the curve and one could wait or should wait?
See, I have been consistently bearish on IT stocks. They don't do double-digit growth. They're doing single-digit growth. Just about managing to cut costs. In fact, their cost cutting has bottomed out. So we are going to see compression of margins go ahead. This is generally a weak quarter for the software companies. So keeping all this in mind, I don't think that I'll be a buyer before March numbers are out. I think one should wait a while for the next 2 quarters and then take a view on IT stocks.
Okay, Vineet, we leave it at that. Thank you for joining us and giving us your quick take on the current state of the market and what you make of it. And of course, a lot of factors, a lot of points that Vineet has made are well taken, considering the kind of correction that we've seen. But the correction has not been as steep so as to make a lot of these prices mouth-watering to get into. But from there on, let's talk about the futures and options space. So at this point in time, we do have Nilesh Jain of Centrum Broking and Amit Puptani of Nirmal Bang Securities joining us on the show. Good morning to both of you and thanks for joining in. Nilesh, how are you looking at the Nifty? It does seem like it's turning out to be a very confusing, trend. After 2 days of gains, once again, weakness seeping in. What's the way forward here?
Morning, Aga. Absolutely. So 2 days of pullback, I would say a dead cat bounce. And then once again, I think the Nifty is resuming its downtrend. But although it's too early to call it as a downtrend, we expect more sort of a consolidation. And on the lower side, the immediate support is placed at 23,800. Till the time Nifty doesn't break below the same, we can expect another round of pullback that might extend towards 24,500, 24,800. So this is just merely a kind of a profit taking as of now. I think 24,000 shouldn't break and Nifty may witness another pullback from here. So overall structure is not looking that weak. After 2 days of pullback that we saw, I think there has to be another leg of buying going forward.
Nilesh, in that case, are you using today's weakness to go long? If you think a bounce back to 2,500 could happen over the next few days, then a long trade at these levels may be okay, right?
Absolutely. So, see, we have seen some positive development on derivative data. The call writers also are active at 24,500. We still need a confirmation which will come above 24,500. But we are preempting that Nifty will break that 24,500 in the November series, and might possible in the coming week we might see the level breaking at 24,500. On the lower side, the stop loss should be placed at 23,800. Any dip towards 24,100, 24,000, that can be a good entry point for the Nifty. And once again, we might see the levels of 24,500 and 24,700.
Okay. Well, Amit, good morning to you as well. Your view on the Nifty and the Bank Nifty, how are you addressing this?
Good morning. So overall, if you look at the scenario from last 2 days of trading session, we have seen that the healthy buying has been witnessed from the lower ends, and Nifty is continuously holding the support of 23,800 level. But on the upside, we are seeing that 24,500 is the resistance zone. So in last 10 days of trading session, we have seen that a Nifty came at 24,500 level around 5 times and have liquidated from that level. So 24,500 is the initial level which we need to get surpassed. Once the 24,500 level get surpassed, then we will see fresh buying or the short is getting exited from the market. But till the time 24,500 is not getting out in the market, till that point of time, we will see the shorts is still intact in the market. The positive thing that has happened in last day of trading session is the India VIX. India VIX came down sharply from 17 level, it came down near 14 level. So this is a positive factor. Another positive factor is the strength from the mid cap and small cap counter. Yeah, we have seen that in last 3 days of trading session when Nifty came from 24,500 to 23,800 level. But overall, Nifty, mid cap, and small cap counters have holded the long positions and have not shown any kind of pressure in the market. So, this is a positive factor right now. So, till the time Nifty is not going below 24,000 level in next 2 to 3 days of trading session, till that point of time, we will expect the market strength to be on the positive side.
You and Nilesh both have calls on fertilizer stocks. So I'll start with you because Coromandel is lagging slightly behind in terms of Chambal. So maybe a catch-up rally there. But you want to take our viewers through the long trades that you have, interesting ones. It's great that you can find a buy call even in a market like this.
Definitely, if we look at the overall scenario, Chambal fertilizer, and if we look at the overall fertilizer space from last 3 to 4 days of trading session, from small cap to large cap fertilizer space like RCF, NFL, Chambal fertilizer, Mangalore fertilizer, all are showing some positive strength in the market. And in Chambal fertilizer, we are seeing that a downward trend line breakout has been created. It is trading above all the major important averages level of 50, 100, 200 levels. And today's session also, we are seeing that the volume is catching up sharply. So I am expecting in Chambal fertilizer counter, it is likely to switch towards the 540 to 560 levels in coming days of trading session. So as per the momentum pick, we will give a recommendation on Chambal fertilizer for the target upside of 540 and a downside support level at 514.
Take a look at Chambal fertilizers and where it's currently trading at because I believe that it's already moved up quite a bit. So it's 522. Amit, just still a buy call, right? Because we have about a actually 18 points left for it to hit your target. And in that case, do you think there would be another target on the upside?
Definitely, I am expecting if it surpasses 540 level, then a fresh breakout will come in this counter. Once if a stock remains stable above 540 level, then as per the Fibonacci extension, the counter is switching on the upside towards 560 to 565 level. And in today's session, we have seen the fresh breakout. It has given open above 50 DMA level and continuously getting stable above 50 DMA level. So that is a positive factor. And in last 3 to 4 days of trading session, we are seeing that the OI positions are continuously getting added up, and the volume is also getting added up. So this is giving confirmation for the counter to create new long position at this point of rate also.
Nilesh, you want to come in on the fertilizer because you've got a constructive call on Coromandel and it's very, very active as I see it.
Right, Samina. So yesterday, Chambal came out with the numbers, strong, I would say strong set of numbers, and we have seen reaction as well. So overall, both Chambal and Coromandel are looking strong. So I've chosen Coromandel, reason being we have seen a strength for the third consecutive session. And this stock has been in an uptrend. If you look at the broader structure, it is moving towards, I think it might hit a new record high from here. So immediate target that we have given was 1800. Now in past few minutes, we have seen a kind of a spurt. So here is a revision in the target. Second target would be 1840. And stop loss, we have advised to keep 1730. And if at all it surpasses 1800 levels in the future, stop loss can be trailed near about 1750. And second target here would be 1840 to 1850.
Amit, you also have a sell call today. Can you take us through that one?
On the sell side, I will be giving a HUL, it's on Unilever. On the FMCG front, we are seeing that continuous selling has been witnessed. In HUL, we are seeing that from counters came down from 3000 level to 2400 level, and continuously in today's session also we are seeing that the pressure is intact. So I'm expecting more selling can be witnessed in coming day of trading session. We have also recommended this counter to our clients also for the fresh short positions. So new short can be created at this point of time for the target downside towards the 2400 level. Once if it comes near 2435 level, at that point of time we should book some partial profit at 2435, and below that we will wait for the target of 2400 level with a stop loss upside towards the 2510.
To come back to you, I know I talked about Oberoi Realty, but you're right, Coromandel has suddenly picked up so much of strength and the volumes have spiked. 1784 now in terms of November futures. Holding strong, right? If one's not bought it, they can still buy it?
Yes, it's absolutely. If somebody is already holding the long position, can shape out for fresh entry, since we have seen quite a bit of spurt. So better I would advise to wait for some dip towards 1760, 1765. That can be a good entry point in the futures. But I still believe that stock has a potential to surpass 1850 to 1900. From a very short-term point of view, might be possible that we might see those levels in the November series itself. So yes, looks very strong, can be added at current level, and it's preferred to buy on declines.
Okay, I think we have time to just take maybe one more stock. So I'm going to take, actually very quickly, let's address the gainers and losers in terms of open interest and see whether or not there are a handful of names which stand out, and perhaps we can take one of them with our experts. So Hindalco is the biggest one on the drop, and Apollo Hospitals, conversely, is the biggest one that advances on the Nifty 50. Maybe I will take each one up. So let's take up Hindalco right now. Nilesh, coming back to you on Hindalco, your view here.
So Agam, structure is looking quite a bit of weakness is coming in this particular stock. A good volume can be seen. So looks like a bit of a short buildup is happening with the OI addition of more than 23%. That's quite surprising. So huge buildup on the short side. We might see another round of selling that may take Hindalco towards 640 to 620. So better avoid taking any contra bet. Short can be initiated on pullbacks. Keep a stop loss somewhere around 680 for the short, and target would be 620.
I'm afraid that's all the time that we have on this show. So thanking Nilesh and Amit for joining us and taking us through their views on the markets. And on that note, it's also a wrap on this edition of the FNO show. Lots more lined up on the other side. Stay tuned to NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and
Good morning and welcome. I am Harsh Saita. With me is Mika Barve. You're watching the Smith Show here on NDTV Profit. Quick check on markets because not a pretty picture clearly today. Seeing a percent or so of a cut on the Nifty 50. ICICI Bank being the key drag. But outside of that, even in terms of the breadth on the Nifty, you're seeing broadly 36, 35 stocks in the decline. So you're seeing some bit of pressure coming up. We'll talk about sectors, but before that, I just want to talk quickly about the constituents of the Nifty. You're doing well where Apollo Hospitals is concerned, doing very well in trade after a very strong set of numbers from the counter. Tata Steel is the other one which is doing decentish on an otherwise tough day of trade. So you're seeing 1.2% higher on Tata Steel. But outside of that, Hindalco on the back of Novelis numbers, 7.5% lower. You have Adani Enterprises, Grasim, TechM all down 2+%, even an Ultratech Cement down 2+%. In terms of the contributors, let's pull those up. You have ICICI Bank, ITC, Reliance, the top drags on the Nifty. In terms of how the broader markets are doing, the Nifty mid cap is flat, slight negative bias coming through. The Nifty small cap too, very similar. We've seen a bit of a recovery from the lows, as you can see on both of those. But let's pull up the advanced decline. We'll see from the advanced decline that volatility seems to be decentish in trade today. You're seeing a flip-flop between advances and declines, and you're seeing within sectors too some bit of pressure. Let's pull up pretty much all sectors in terms of the heat map. The Nifty Auto seeing some pressure, 1.4% lower. The Nifty IT, 1.25% lower. The Metal Index, Pharma, both down 1.6% each. So those are some of the big sectors which are making moves. Nifty IT reversal versus yesterday. Nifty Metal also reversal versus yesterday. So that's how essentially it's playing out. But let's bring on board our first management. Minka, KP Green, just talk us through what is it that stood out for you in terms of numbers? Yeah. And then let's bring in Mr. Farooq Patel, who's the CMD at KP Group, to talk to us about those.
Harsh, a strong set of numbers when you look at it from any front. Revenue is up 67%, EBITDA is up 87%. Margins are a standard, 400 basis point expansion, almost 37.2% versus 33.1%. And net profit up almost double from what we saw a year ago. Right. Now, a little bit about KPI Tech. Well, it's a developer of renewable power facilities, and it caters as an independent power producer as well as a captive power producer. And we're going to talk to the CMD of the company, Mr. Farooq Patel. Welcome to the show, Mr. Patel. Let me start off by asking what stood out this quarter for you, what drove growth, and why did the margin expansion take place?
Thank you very much to put us on a board and knowing about our company. See, the quarter is a very tough quarter, but as you know, we have a very big orders in our hand. Plus, the execution team is very powerful. So you see the highest quarter ever. We have achieved this in last yesterday result what we have given to the BSE NSE. So as you say,
I think we have just, lost Mr. Patel for just some time.
Mika, while we are at it, just for context, what in your view is aiding margins? So he was obviously speaking about how margins are getting better. Do you expect that to be sustainable?
So in terms of a guidance, we haven't gotten it yet. That was my second question to Mr. Patel. But when you talk about what led to margin growth, first of all, the top line expansion. It was up 73%. Major of it was driven by revenues from sale of captive power projects, which was driven by 73% growth.
Mr.
And
Patel
I think,
is back, so why don't you quiz him on that?
Yeah. Mr. Patel, can you hear us?
Yes.
Yeah. I wanted to know what aided the margins. What's the key driving factor this quarter?
See, as I told you, the order is a very old order. We have the in our kitty from the last 1 year, and as
Okay, we have Mr. Patel, it seems, on a very poor line. So while we fix that, let's pull up some stocks, in fact, in focus, especially on the back of numbers. There are plenty of them. And thereafter, let's also see what the MSCI rejig has done in terms of stock returns today. In terms of numbers, something like an Avalon Tech up 13%. Apollo Hospitals we spoke about up 6. You have Chambal Fert, which is up 5. You have Gujarat Gas up 3.25 or so. You have Endurance Tech also doing fairly well, 2% higher. Anything that's in the green at the moment, Mika, on a day like this, definitely calls for a celebration because it's that kind of a day.
About Gujarat Gas, if you see the numbers, just, if you read through them, everything is down except margin. And what actually stood out and why we gave it a thumbs up in the morning itself was the higher margins. Despite revenue being down, despite net profit being down, their unit per margins, which is one of the main metrics that you look at while analyzing the profitability of a gas company. Their Q2 EBITDA per standard cubic meter margins is up sequentially to 6.4 versus 5.6 last quarter. And this is because of higher spot prices and lower volumes and price hikes.
Mr. Patel is back.
Yes.
Mr. Patel, Harsh, just want to quickly allow you to complete your piece with regard to margins. You were telling viewers as to why there's been a margin uptick this quarter and whether that is sustainable.
No, the quarter is powerful because of the execution only. The fast execution always give you the good margin and good profit also. So that is the one thing. Second thing, of course, we have marked in the last 6 months that the drastically panel rate is gone down, which gives you which gives your company to a good margin also. That's two things I can say in this your question answer that why the margin is high. Because of this, only two things: execution, orders, and of course the rate gone down of the panel.
In terms of your orders in hand, cumulative orders of 2,409 megawatts, when can we expect the execution of this space? How much can we expect to be executed in FY25 and FY26?
See, we have already done the till date is 711 crore rupees revenue, and we have an order about more than 2,000 crore in our hand. But of course, that not going to come in this 2025 March. But you can expect at least the 70 to 80% growth than the last year.
Percent growth for the next year. Mr. Patel, you said 2,000 crores worth of orders. So the 2,409 megawatt order book you have is total, and on a total basis worth 2,000 crores, around 1.1 crores
on
of
a total
revenue.
basis, there is a two type of orders are there. One is IPP and one is CPP. CPP always give you the revenue, but in IPP they will not the revenue. After commissioning the IPP project, you will get the annuity revenue for 25 years. So this year IPP always give you the capex. It is a capex. IPP is a capex, but the CPP, of course, the revenue. So altogether, you can say money comes in as a revenue in the company from the CPP only. But from the IPP, when it's installed, which revenue will come for 25 years. And I always say one thing, that CPP gives you the top line and the IPP gives you the bottom.
Okay. So IPP is more of the recurring revenue aspect of it. But Mr. Patel, if we had to like break it down in terms of how margins perform as a whole, just an average CPP versus IPP, which segment does better in terms of margins?
Margin, of course, 76 to 80% EBITDA in the IPP.
Okay.
Right. And in CPP, 22, 20, 25.
Okay, got
So
it.
in a both sector is a different, very different things are there. But of course, in IPP, you need a capex, and you have to do you have to make the IPP in time, say 1 year or say 1.5 years, and then you get the revenue. And in our company, we have a very good customer in IPP, say GUNL, which is the highest order what we got in this year is 1.3 gigawatt almost, and which revenue comes in on a board by 2026 March.
IPP order revenue will come in by March of 2026. And Mr. Patel, how is the hybrid model working for the company? I mean, orders in hand of 1.1 gigawatts. When can we expect this to be executed?
See, you are rightly says hybrid is more than 500 megawatt in IPP.
Okay.
When we say in IPP more than 500 megawatt, which hybrid always give you the very good PLF. Say 50% PLF almost you can see in the presentation also. So in hybrid, the more unit generate and more revenue comes in a company's kitty in IPP. Installation for the CPP hybrid, of course, there is a like for a solar, 3 crore rupees or 3.25 crore rupees per megawatt. When the hybrid comes, it's near about 7 to 8 crore rupees per megawatt. So that's the difference.
So, you have IPP, you have CPP. They're almost 50% right now of your total order book. Is there a targeted mix? Because on one end, one is high, EBITDA generating, but one is high revenue generating. So what's the strategy there?
You are rightly catch the things. See, as I told you, CPP will give you the top line. The bottom line always maintained by the IPP. Today, 18% IPP and say 72% almost revenue from the CPP, which we are going to increase within 1 or 2 years by this new order what we have won from the GVNL, which we are going to say 30% at least in IPP and rest of from the CPP. This is our target.
In terms of your land bank, you have a significant land bank on your books, over 3,000 acres. What's the potential in terms of capacity there, and what's the strategy? Are you going to acquire more land going forward?
Of course, this is the regular things. Land acquire is a regular thing. We have a 3071 acres land in our hand today, and 2,346 evacuation capacity also we have. In a solar, if you have a evacuation in solar, you need a 3.25 acre land per megawatt, and in a hybrid, it's a 5 acre per megawatt. So that's a difference. So whenever we need to do the IPP or the CPP, we require more and more land, and out of 3071, today we can say at least 2,500 land where we are already executing the jobs, and the more 2,000 plus acre land we are going to get in a very stipulated say 1 or 2 month time.
Acquire more 2,500 acres of land in the 1 or 2 months, in the next 1 or 2 months? Okay,
yes.
Got it. So that would increase your land bank significantly and thereby help you, evacuate more projects. And in terms of a growth strategy, the company's been very, targeted to Gujarat. Is there any geographical expansion plan in phase?
Of course, the company now cross.
I think, we've just lost Mr. Patel, weak line today. But Harsh, he said he's going to acquire more land. The mix of his projects are IPP, CPP. CPP, one-time revenue, higher margin, lower margins. Right. IPP, recurring revenues for the next 20 to 25 years and higher margins in that front.
You know what I'm curious about? They've done 1,000 crore QIP. They've paid off a lot of their debt. I'm curious about how the cap structure changes for them going forward, because they've traditionally been a high debt company, and that's something I'm going to likely ask Mr. Patel if he's going to be coming back, and I'm going to get that opportunity, because how does that essentially play out over the medium term? And what the risks therefore would be like for investors will also be interesting. But a 3,000-acre land parcel, you also tell us, Mehika, that around 2.5 gigawatts of power evacuation capacity is what the land bank can possibly generate.
Yeah.
But Mr. Patel, if I can come back to you, you've done 1,000 crore fundraise in H1 FY25. You've paid your debt. What plans with regard to capital? Because you're, of course, churning capital straight back into the business. How quickly can you continue to do that? And are there plans to again start taking on debt, or will debt come off from here? Okay, we have him on an extremely patchy line, Mr. Patel. But yes, so let me cut this conversation close, because unfortunately we're just not able to get through Mr. Patel. Let's switch focus though, talk about a couple of other stocks. So we spoke about Gujarat Gas. Hindalco is down roughly 8%. You have a Gulf Oil, which is also down around 3.5%. I wonder, Mihika, before I let you go, what's on with Hindalco and Gulf Oil?
Yeah, Hindalco, when you talk about why it's seeing negative movement, where two main factors all related to Novelis, which is its international subsidiary. Now, Novelis posted its Q2 earnings yesterday, and net profits was down 18% on a year-on-year basis. And when we talk about what impacted profits, were high restructuring and impairment expenses, low operating performance, and a $61 million charge due to the production shutdowns in the Sierra plant, which was impacted by heavy flooding just last quarter, and the impact of this flooding is due to be carried through to the end of 2024. And one thing that stood out is that they've suspended their near-term margin guidance. This is related to their adjusted EBITDA per ton guidance, and they're going to wait until further clarity of the whole metal markets as a whole, and they expect their margins to contract sequentially in H2 FY25, and this is negative for Hindalco Industries, who is the parent entity for Novelis. Now, why have they suspended the higher scrap prices? Well, it's been affected by rising aluminium scrap prices, and this uptick in these prices is due to intense competition because of some policies that China has put in place. And when you talk about Novelis products, well, 60% is from recycled content, so higher prices means higher input prices, and that puts a pressure on margins. When you talk about why Novelis is important for Hindalco Industries, it's one of its key major subsidiaries that caters to the international markets and accounted for 61% of Hindalco's FY24 revenues, Harsh, and also 56% of its EBITDA in FY24. So not only is a great revenue contributor, but in terms of profitability, Novelis plays a key role. Right, and the knock on the stock evidently clear because of that. But let's quickly switch focus. Thanks, Mika, for that. We have Srinivasan Nandadur, who's the CFO at Eclerx, to talk to us about the numbers. Q2 numbers coming out, solid set overall, Mr. Nandadur. How does H2 look now going forward? Also, 75% of our revenue, largely, if I've got the number right, comes from North America. And we've had a big change there in terms of policy and politic. Talk to us about that.
Thanks, Harsh, for having me on the show. So yes, Q2 numbers came in pretty strongly. And we think that the long-term growth momentum continues to remain intact for the firm. There may be ups and downs in the short term, but long-term, the pipeline is pretty strong. We're seeing growth in financial services, part of our business, in the customer experience part of our business. There's some ups and downs on the digital side, with fashion and luxury part of our business remaining challenged, and that's more Europe-focused. But we are seeing green shoots in other parts of the digital business, which is retail, e-tail, and manufacturing and distribution. So overall, we are pretty positive about the long-term prospects of the company. With regards to your question on the change in regime, we believe that there should be no material change because a lot of, or at least no material impact that results to ITS company. If any, there may be some positive impact because if the president actually follows through his promise of tax cuts, then that could benefit the industry. Otherwise, we don't see any material change.
If I were to talk about margin recovery, especially when I'm looking at the numbers sequentially, from the 21% margin number, you've gone up more towards 26%. You believe that's a sustainable number, and talk us through why that is so, Mr. Nadadur.
So there are some one-offs in Q2 because of which the numbers, the margin numbers have seen that expansion that you talked about. And some of these one-offs will go away in Q3. Therefore, we think that it will moderate in Q3 and Q4. But so at the beginning of the financial year, we gave guidance, and I'm talking about EBITDA here, of 24 to 28%. And we believe that we should be in that range for the full year.
Okay, so the contraction and these one-offs, what kind of an EBIT impact does it have? So if I'm talking in EBIT terms, you're at 22% currently, just for your context.
Yeah, so about 85 bps is the impact.
Sure, and that will reverse in Q3s, and that means your EBIT will come around, will hold up above maybe 21%, likely?
Likely.
Okay, understood. And therefore, how do you look at full year, both in terms of growth as well as margins? What is your guidance at, and what's the likelihood of you getting there?
So on EBITDA terms, the guidance is between 24 and 28. And our guidance includes other income, whereas yours doesn't. So just to clarify that. And we think that we will be within that range for the full year. Revenue terms, we don't give guidance either for the next quarter or for the full year. So I'm unable to provide any color on that.
Right. Digital performance was slightly mixed. You expect a revival there?
We are seeing some improvement in sentiment in retail and e-tail business, in manufacturing and distribution. So we're seeing clients having access to budgets to spend. So that part of the business looks positive. On the other side, we have a fashion and luxury business, which largely serves top luxury and fashion houses, which is European centric, and that portion does look stressed.
And sorry, please go ahead.
The outlook it's mixed.
Sure. And in terms of recoveries, right? Just in terms of traction that you are seeing, the recovery of the business altogether. Client delays, do you see that continuing, or do you see that ebbing? What's the trend like?
Again, it's sort of mixed. In financial markets, we're having a lot of conversations. We can see that the sentiment is positive. I think banks have also declared fairly strong results. Whereas in digital, we think decision making is taking some time. So as I said, it's kind of mixed.
Okay. And with regard to attrition, spiked up a little bit. What's the sense there?
We expect it to remain probably at this level. So Q2 generally for us is always higher than Q1. And that's because of the wage increments that we pay out, which are paid out in Q1. And then that leads to some amount of attrition. But we don't see a significant change from this level in Q3 or Q4.
Focusing on fresh hiring, how is that playing out? How's competition in that space?
It does seem that, demand from other companies or other competition of other companies has increased. So we do see that some amount of attrition may be attributable to hiring at other companies picking up. We've not seen any challenge in sourcing new hires or fresh hires, except in certain pockets like analytics and technology, where skills are a little hard to come by.
And the new deal wins, do you expect a pickup second half in terms of how that's playing out?
That's actually really hard to say because the pipeline is good. And what then affects the deal win is the time taken for companies to close and what our conversion rate is. So those two variables we don't have much of a control on actually.
And in terms of AI, is there traction on AI related products, if at all? You have a pulse, you have a ear on the ground?
So there is some traction. Clients are quite interested in what we can do with AI. So we offer a lot of productized services in KYC, in digital operations, and so on. And we have embedded AI in some of these products and services, and that is finding a good amount of traction with clients. So we have to see what the ultimate impact is and whether we are able to sell more on the back of AI enabling our products.
Where are you investing in terms of where are you putting your free cash flow to work? Any new products, R&D that you are doing?
Mostly in analytics and technology on Gen AI. So that's on the delivery side. That's where most of the investment is going. And to strengthen our sales teams, we've invested in sales leaders across the globe.
Right. And just a quick 30 seconds. What's the unique proposition that you're trying to play? Is there a moat that you're trying to build which other companies are not able to breach?
So our proposition is basically domain-led. So the work that we do is very high, complex, high domain intensity. And then we try to make productized services that make use of our people's knowledge and skills in that domain, along with a delivery backed by technological service. And that's the USP that we have.
Fair point. Thank you so much, Mr. Nandadur, for coming in and giving us all of that perspective out of time on this edition of the SMID Show. Stay tuned to NDTV Profit. More action on the other side. Thanks so much for watching.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
So it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
single day passes like a blur. The news just whizzes past. And you're trying to stay informed. It is our job to bring
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew and with me is Mahima Vajrajani. We'll take you through the next 1 hour of trade, and it is looking just a tad bit muted for the Indian equity markets as it is for emerging markets as a whole. Let's take a look at the screen and see where the Nifty 50 is. Not too far away from the low point of the day, down about 1% or so and down about 270 points or thereabouts. The broader markets also losing ground, and let's pull those up as well. The mid-cap index first, down well, just about a 0.1%, and the small cap index, let's pull that up as well and see where it's trading, also down about 0.1%. So a large part of the selling is restricted as things stand to the larger end of the spectrum, and a few things for you to pay attention to. Of course, if you've been watching NDTV Profit, you will know the context. The context is that there is going to be a new president of the United States. That person is Donald Trump, and his policies have generally been known to lead to a stronger dollar. There is likely to be inflationary pressure in the US, and that has pushed bond yields higher overnight. The 10-year treasury in the US currently at 4.45% or thereabouts, and a higher yield in the US is negative for equities in emerging markets, certainly, and that is what you're seeing perhaps on the screen. Also, commodities under pressure. So you have oil prices that were a little subdued. In any case, Brent crude trading very close to that $76, $75 per barrel mark. Now, we will talk about that in more detail at 12 o'clock. We will be joined by Saurabh Mukherjee of Marcellus, and we're going to maybe take some of your questions to him. So that number that you see at the bottom of your screen, you can send your questions specifically to Saurabh at around 12 o'clock. Before that, we have a couple of other experts joining in to help you with your fundamental and technical queries. Now, before we get into the stock that I've chosen for the focus of the day, there are a few other stocks that we should talk about, Mahima.
Absolutely, Alex. So, one of the stocks which is really under pressure today is Hindalco, and this is after Novelis posting its Q2 earnings. Well, net sales was up 5%, but EBITDA was down 5%, adjusted EBITDA down around 1%, and net profit was down around 18%. But the stock is taking a significant hit today, and this is because it is the subsidiary, that is Novelis, has suspended its near-term adjusted EBITDA per ton guidance, which is why the stock is down around 8% as we speak. The next counter is Blue Star. Good set of numbers overall for Blue Star, but the stock is not doing very well. Revenue is up 20%, EBITDA was up 21%. Margins have not seen a significant improvement because both revenue and EBITDA did move in line, and net profit was up around 35%, but the stock is taking a significant hit, down around 6.8%. The next one is TeamLease Services, where revenue saw around an 8% growth. EBITDA margins did see around a 1% margin. EBITDA, however, did see a slight uptick, and net profits were up around 28%, but the stock is not doing very well. It's down around 4.2%. But certain stocks that are bucking the trend today despite the markets falling, one of them is Avalon Technologies. Revenue up 36%, EBITDA has significantly doubled. Margins have also seen a significant uptick. Net profit has more than tripled, and which is why the stock is doing significantly well. It was up around 17% in early trade, but right now it's trading around 12% higher. Another stock, Alex, is Apollo Hospitals, yes, and it's done very well in terms of its Q2 earnings. The stock is also one of the stocks that's bucking the trend. It's up 6%, and that's the stock in focus for today. And we have Varsha joining in to tell us more details about what exactly has panned out in terms of Q2 earnings for Apollo Hospitals. Varsha, take it away.
So good show when it comes to Apollo Hospital numbers. Now let's see what led to these good numbers or fantastic numbers. If you see that healthcare services, which forms the major part of the revenue, grew. The revenue grew over 14%. EBITDA growth was again 14%, and PAT growth was 16%, and the margins were 25%. Now there was good volume growth also. So they had a strong volume growth of 8% in healthcare, and they are continuing to see this volume growth going ahead. And the average revenue per occupied bed at Metro Hospital was 20% higher. Now when it comes to Apollo Healthco, this is the star for Apollo Hospital as a whole, wherein if you see the performance, revenue grew almost 17% year on year, and there was a EBITDA, they turned out to be an EBITDA positive of 52 crore versus loss of 38 crore last year. Margins were 2.2%, and PAT stood at 19 crore versus loss of 67 crore. So good show when it comes to Apollo Healthco. Overall occupancy for hospital, if I were to say, was 73% versus 68% last year. And Apollo Health and Lifestyle also, there also if you see revenue grew 14%, EBITDA grew 30%, and there was a PAT loss of 4 crore versus loss of 13 crore last year. Now when it comes to expansion plans, they plan to set up 500-bed hospital in Worli, and their subsidiary aims to expand Lucknow facility from 300 beds to 500 beds. Total estimated project cost is at 6,100 crore, and over 1,700 crore has already been spent on land acquisition, security deposits and project development, and remaining 4,400 crore to be funded over the next 3 to 4 years through external funds and internal accruals.
All right, thanks so much, Varsha, for getting us those details. The stock is up very close to the high point of the day, but it's not cheap by any stretch of the imagination. If I remember correctly, 62.5 EPS, and so therefore over 110 is the trailing PE. I would assume, based on the kind of growth that it's generating, it would still be very close to that 100 PE going forward as well. Shahina Mukaddam, independent market expert, joining us right now. We've got Kush Bora, who's the founder of kushbora.com as well. Thanks so much to the both of you for joining in, and good morning. Shahina, what do you make of the results first of all? Do you think that it is expensive, or is it okay to have this kind of a price for a stock, for a company that is slated to grow very fast?
I think it's a good stock to have in your portfolio. In fact, in the size that it has, in number of beds, and also the expansion that they're talking about, in fact, including the Worli Hospital, I think all these things, make the stock attractive to hold. Valuation-wise, I think if you look at the whole hospital space, while all hospitals are a bit expensive, I think in the overall space, Apollo Hospitals is more reasonable priced if you look at it on an EV per bed basis. So to that extent, it is less than 3 crore per bed. So to that extent, it is pretty attractive. And, I think it makes a good holding in your portfolio. And the numbers also excellent.
Answer to this, would you buy at this current price, or would you wait for dips?
I would be buying at current price also if I have a medium to longer term perspective.
Okay. Let's take the next one.
Yeah. The next question is on REC. Now this question is from Sudhir from Punjab. He's asking whether he should hold, average out, or sell REC at this moment. He's bought shares, around 500 shares at 600 rupees, and currently his loss stands at around 36,000. Kush, I'll come to you for this one. How is REC looking to you on the charts?
Hi, first of all, a very good morning to everyone. Well, for Sudhir, let me reiterate, not a big fan of averaging. The stock's on the way down, but the good thing is that now it's consolidating, with some sort of a positive bias, if I might add, from, let's say, the last couple of sessions. 500 is a very strong support zone. It's grappling to hold on to the 200-day moving average, which comes very close to the current price of 520. But I think a meaningful support is at 500. So if that is taken out, you should exit. The loss will be slightly deeper, but that still gives you a chance on the way up. So if these current levels of, 5, or rather if the support zone of 500 is held, then you could see the stock rebound. The volumes are starting to thin on the way down. So perhaps, the selling could either be over or maybe coming to, an end. So hold with a stop loss of 500, no averaging just yet.
So the next question is on NHPC, and
we've got Parag from Mumbai who's asking about this particular counter. Is it a good buy in the current market conditions? Let's pull up the chart. In fact, let's pull up the slightly longer term charts to see how it's done in the year so far. Stock is up about 1% or so and broadly bucking the trend. It's done reasonably well, but down from the high point of the day, of the year so far. Shahina, would you buy at this point?
Well, no, I think the numbers are just, going to be out this week, but I wouldn't be buying at this point. I would be preferring to buy it at lower levels. We have seen some bit of a softness in earnings, so I would wait. Buy it at dips only.
The next question is from Gautam Muhuri from Mumbai, and he wants to understand as to what's the good entry point for ITC for the next 12 to 18 months. Kush, I'll come to you for this one. ITC Q2 results did not do very well. Its margins did drop to around 3 or low now. But is this the right time to enter ITC as per the charts?
It's a little tricky, but the fact, or rather the good thing is that, he's got a time horizon of 12 to 18 months. Now, what could happen is that, this could be a good starting point. 470 is a very strong support zone for ITC. We've seen that held in the past, even right now, in the recent drop, that was the low that, the stock had made. So around these levels, you could start accumulating. So I would suggest an approach of a staggered buy where you keep buying, this as more of an SIP. So a good entry point in terms of a staggered buying. I'm not entirely sure if the entire selling is over. Strong support zone for this one comes in at 455 levels, where there is the 200-day moving average support.
Let's pull up Waaree Energy share price. The stock is down quite considerably in trade today, and I'm just trying to pull up how much it has done. It's done reasonably well since the listing, in fact. And let's talk about the question from Harsh, and he's got one lot that he managed to get in the IPO, and he's wondering whether to sell. Should he do so, Shahina? What was your opinion on this particular issue? Did you say that you should subscribe, and if so, what should you do now if you're holding?
Well, if you're a long-term holder, then it doesn't make it, you can hold. But if you are looking to flip, then it would make, sense to flip. Basically, they raised close to, the money coming into the company is about 300 million. Also, there was some offer to sale in addition. But this 300 million approximately US dollars is now targeted to make an acquisition in the Indian market, in the RE space, of course. So to that extent, yes, if you hold it for the longer term, the valuations which look extremely expensive at current levels will start looking more attractive. But if you're looking to, just about 6 months holding, then you could, exit.
So from a longer term perspective, it's a hold for Waaree, but if you're looking to, book short term profits, you can sell Waaree Energies as per Shahina. Well, the next question is from Balwant Modi, who's from Rajkot. He's purchased 100 BEL shares at 285 for 2 months, and he wants to know an outlook on that. BL is down around 2.6% today in terms of the intraday performance. But Kush, 2 months is quite a short term for a stock like BL to look at. So your view on BL?
And seems like quite a bit of a long term if you're, just trading in this one.
Yeah.
But, I must congratulate him. The fact that, he's bought it at a good price. And if you ask me, among the entire, defense pack, BEL does stand out because it's not seen that sharp a correction that some of its peers have. And that's a very healthy sign. So kudos on the good entry price. My suggestion would be to now put your trailing stop loss at the price at which you've bought. So at least you lock in a no profit, no loss scenario. The stock is now up from his buying price. 300 is a bit of a resistance. But I think if that is taken off, the stock could head to 325 levels also. That's my target for a month, maybe, a little over, maybe around the 2 months time frame as well that he's got. So he should continue to hold. Just put your trailing stop loss at your buying price, as I said, just so you lock in, the no profit, no loss scenario if the stock were to fall along with the market.
All right. Satish from Jammu is asking this next question. Brigade Enterprises is the name of the counter. He's got an average price of 1,237. And I want to look at the longer term charts because this is one stock as a part of a pack that's seen quite the run in the year so far. And it's wobbled just a tad bit on 2 occasions. We've got a long-term view that is being sought. So he's bought at 1,237, and so therefore he's seeing a bit of a loss right now, and he's bought at slightly elevated levels. Shahina, on the fundamentals, do you like this company?
Well, it's reasonably priced, but the thing is, I believe the balance sheet is a bit stretched. So, if you look at it in the overall real estate space, I would prefer, this is not one of my top picks. So, I would prefer some other real estate, player, something like a Prestige, Godrej over Brigade.
The view coming in on Brigade. The next question is from Sushila, who's from Bellary, and she wants a view on Canara Bank. Now, she's purchased 578 shares at 111 a piece, and she wants to understand whether she should exit or keep holding the Canara Bank shares. It's comparatively a technical question, so Kush, I'll come to you for this one. Your view on Canara Bank as to how it's looking on charts.
Not too great. It's had quite a bit of recovery from those 93 levels, all the way up until 100, 105 where it is at currently. But there are a couple of resistance and supply zones. There's a falling trend line resistance that will come about at about 110 odd levels. Then there is a 50-day moving average that this is grappling with. So while the stock is in a near-term downtrend, the fact that the overall banking space has actually relatively outperformed the Nifty, there is a possibility that the stock could also might see some sort of consolidation around these levels, not too far from her buying price. So my suggestion, hold this with a stop loss of 100. If that is broken, you should exit. If that is held, I don't see a very big upside on this one. So you might get an opportunity to exit that call.
Bandhan Bank is the next counter. Basavaraj from Bengaluru is bought at levels of 290. He's got 1,000 shares, and so that's still elevated. China, while it's made a bit of a comeback and the fundamentals based on the last few readings have been better than they have been. And I've asked this just in this past week. So the question marks about MFI have not completely gone away. Would you hold on to this? It's a considerable loss that he's incurring.
Well, Bandhan Bank has actually given you a decent return now in terms of the short-term movement, but and also the numbers were pretty much better than what was expected. At the same time, I think in the NBFC space, it would be better to switch. There are some issues that continue to bother this whole space, so better to be in something like a Shriram Finance.
Shriram Finance over Bandhan Bank is Shaina's preference. The next question is from Rajiv, who's from Mumbai. He's bought 400 shares of Sumitomo Chemicals at 550 a piece, and he wants to know as to what should be the medium target for this particular counter and how is it technically looking on charts. YTD, the stock is not done very bad. It's up around 46%. But Kush, Sumitomo Chemicals on charts, how is it looking to you right now? It's bucking the trend today. It's up around 4% as we speak.
Not too bad at all. There was a correction, but the recovery has been equally sharp. Trading comfortably above some of its key averages. And chemicals, despite the kind of volatility that we've seen in the prices, and maybe China can corroborate in results as well. Some of these names actually kind of stand out. PV, Sumitomo, some of these names. So Sumitomo is above his buying price. So perhaps 550 with his buying price could now be the trailing stop loss. From a medium-term perspective, the target on this one is 610. Once that is taken out, you're looking at the 650 as well. So continue to hold Sumitomo. It's rebounded quite sharply, and the volumes are also picking up on the way up, suggesting delivery marking in this one.
Happiest Minds is the counter that we're talking about, company in the IT consulting space, and we have spoken about the space as a whole, and I'm wondering how this will get affected going forward. Siddharth from Dubai is already holding. He's bought at a price of 903, slightly elevated levels, but he plans to hold for the long term. Shaina, is this the best pick that you would say? And would you say he should hold on to his investment?
Well, he can continue to hold on to his investments. They're doing pretty well in the digital space even now. And if one wants to, add, he can look at some of the, numbers that have come out for small cap IT or mid cap IT. Pretty good numbers. You had Coforge in the larger companies, IT companies, which came out with excellent numbers. You can look at that. Today we had eClerx, which came out with very good numbers. That is in the mid cap space. That also looks good. So in this overall space, you can have a portfolio of 2 or 3 stocks. Happiest Minds, this looks decent at current levels. You can hold.
All right, the next counter is Power Grid. Sandeep has around 400 shares of Power Grid, purchased at 349 a piece.
And I want to add to that because I've just taken another query from okay, from Ishant, who's writing in from Rajasthan,
Yeah.
and he has bought Power Grid at 365 rupees. I think both of them have a short-term view, so why don't we
Yes.
club the two?
All right, so both of them want to know from a short-term perspective, how does Power Grid look on charts? Specifically for Sandeep, he's asking for the next 3 months, and he wants to know as to, what will be the support and resistance levels, of course. I mean, the results were not very impressive for the company in Q2, but how does it look on charts? Kush.
Not too encouraging. The only silver lining I would take is that the stock for the most part of the last 10-15 odd sessions has respected the 200-day moving average, which comes in at 310. Now, any break below this could open floors for slightly lower levels of 280. So you might want to keep a very tight stop loss on this one, close to the 290 mark. Now, if the rebound does happen, I think the first resistance level will come in at 330, and once that is taken out, you're looking at another resistance at 345. So I'm not sure that this stock could see any kind of profits for both of them in a hurry, but maybe any rebound from the current 200-day moving average support, if it does come about, then can be taken as an opportunity to exit at a slightly lesser loss.
That's a view, comprehensive view on Power Grid Corporation of India. Let's talk about a couple of stocks in the same space, Mazagon Dock as well as Garden Reach Shipbuilders. And this is a question coming in from Sharad, who's writing in from Goa. And he's bought the two. He's bought Mazagon Dock at a price of 2,077. So he's in the green comfortably. So he's got 8 shares of Garden Reach Shipbuilders. Let's pull that stock up as well. He's bought at a price of 1,781. The stock is currently trading at 1,592. So in one of them, he's making healthy gains, China. He's wondering whether to hold on to these two and what can he expect based on the fundamentals.
Yeah, I would say Mazagon Dock is a hold, even at current levels. See, the government has about 86% of the equity. So even in future, when there is a FPO, I'm sure you would get some better offer even at that point when the government gives a preference. And in terms of valuation also, well, it is slightly higher. It is expensive, but it looks good with huge order book position on hand. Garden Reach, on the other hand, I believe in the shorter term, you could see a bit of weakness because it is expensive based on the revenues and the way it is performing in terms of execution. So if you want to hold one of the two, I would prefer Mazagon Dock. Otherwise, Garden Reach, for the longer term, it's okay. But for the shorter term, you're going to see some pain.
The next question is from the auto space, and this is from Mahalakshmi, who's from Hyderabad. She's holding 115 shares of JBM Auto at 1892 a piece and 100 shares of Electra Green Tech at 1830 a piece. And she's incurring loss right now in both of these counters. She wants to understand whether she should add some more from a longer term perspective, and if yes, which one is the better counter. One is an auto anch who caters to these buses, and one is an auto company which makes green energy buses. So I want to understand, Shahina, your view on both of these counters, and if she wants to add, which counter should she pick?
See, Electra Green looks like a better managed company. It has a very good promoter group. Only thing, it is a bit expensive. So I think at any dips, you can look to add Electra Green. JBM Auto, in my view, is it's a much smaller company. So I would prefer Electra Green.
All right. Blue Star, and this is an interesting question coming in from Amit, and I'm reading this out because it's quite insightful. Blue Star, let's pull up the intraday chart. It's down 7% practically. And he says, despite consistent growth, it has taken a bit of a nose dive. This is symptomatic of some other stocks as well, like Shriram Finance. Is this overall bearish sentiment, or are there any other currents that are playing in the space? And it is interesting, Shaina, because we're talking about the space that Blue Star operates in, whether or not it's an issue with consumption in the space that it is playing in. Are you reading signs that that is the case, or is this symptomatic of what we're seeing across the board right now?
We have seen some bit of weakness across the board, even for Voltas. We are likely to see some bit of softness that we've seen in the current quarter. But I think for the second half, there's pretty optimistic in terms of what is going to be there in terms of overall growth. So I would say that, these are companies that one can keep adding because the consumption story in India is going to, grow. And so I would say you can keep adding small quantities added to your portfolio.
The next question is from Victor, who's from Kolkata, and he wants a view on Bank of India. At present, he's purchased 350 in terms of quantity at 115.27 a piece, and he wants to know the target and stop loss for this particular counter. Kush, your view on Bank of India?
I'll assume a short-term time horizon of, let's say, 1 to 3 months, on this one. So a very good entry point. I think a support zone on this one is at 105 to 107. So, that zone could act as your stop loss. Now, the stock's seen a very good recovery on the back of good volumes and sustaining above, some of its key averages in a market like this. So on the whole, the reading is looking fairly positive. Now, on the way up, what are the levels that you're looking at? The first target that you could look for is 120. Because that's where a lot of supply zone comes in, and once that is taken out, you're looking at a 132 kind of a level. So these are the levels that you can take as targets on the way up, and as I said, on the way down, 105 to 107. That zone somewhere in between that could act as your stop loss.
All right, we've got a few more questions coming through. I believe we just did Bank of India. We've got Rico Auto, and Satya from Trichur is asking this question. He's bought at levels of 125 and he's looking to hold for another 6 to 12 months. Is there a chance to make a switch from here to something else? So he's incurring a bit of a loss. So Kush, are there any other opportunities that you would suggest for the next 6 to 12 months, or would you say that he should hold on to Rico Auto?
The move's not entirely encouraging, Alex. Now, the challenge is that even though the stock's rebounded and it's trading above the 20-day moving average, this seems more like a dead cat bounce because it's not as volume backed as we would have liked. And nevertheless, if it does sort of rebound, then you're looking at 110, 116 kind of levels on the upside. My suggestion would be to switch to something like an M&M, a bigger player. The stock's actually seen a bit of consolidation and also seen a rebound on, even if the data is mildly positive. My suggestion would be to stick to those, bigger names. Rico Auto at the moment, it just seems like a dead cat bounce. Perhaps an exit, is a better strategy, on this one.
Do stay with us, Shaina and Kush, and we'll come back on the other side to take a few more questions. Viewers also do stay tuned. Ask Profit continues on the other side of this very quick break.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable show.
If you want to be in the money.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed.
All right, welcome back. You're watching Ask Profit, and we promised you that we would get Saurabh Mukherjee into studio, and he is in fact here. He's going to be walking in just a couple of minutes. And what we're trying to do with this conversation is to give you some perspective through him of all the moving parts that could emerge in the coming few months. Of course, yesterday the big event was the election, the US presidential election, and where you've had the emergence of Donald Trump as the 47th president of the United States. And there's already been a lot of commentary and a lot of discussion about how this will impact India and what the implications are for global trade, what happens to commodities, where do yields head, and what should that mean for your strategy. So we'll get you all of those details in just a bit. In fact, that number that you see on your screen, that is where you can send a few questions to us as well. And depending on the quality of the question, I will supplement my questions with yours. So make sure you think about what you want to ask. In the meanwhile, I'd like to thank both Shahina Mukaddam as well as Akush Bora for joining in and for answering all the questions that you did today. Always a pleasure having you on the program. Let's very quickly take you through where the markets are right now, in fact, and let's see if we've had any recovery in the benchmark while we have Saurabh joining in next to me in just a bit. Let's pull up the Nifty 50 and see where it is at right now. And in fact, we've got cuts of about 1% or so. That's pretty much where we started this program about a half an hour back. You have the broader markets that are not looking too bad at this juncture, but muted nonetheless, down about 1/3% or so. The small cap index also down about 1/3%. By the way, we are speaking to Saurabh today, and he's going to give you context on what the US presidential election result means for you. But he's also got a new book out, and he's going to be speaking to Neeraj in just a bit about Behold the Leviathan. I have this in front of me, and I'm quite curious about what this book is about. I've read a couple of his other books. It says, Behold the Leviathan, the unusual rise of modern India. On that note, Saurabh, thanks so much for joining us in the studio.
Thank you for inviting me.
Pleasure having you. What did you make of the outcome of the presidential election? Did you expect it, first of all?
I think, look, one of the beauties about America is everything is bet on extensively. So by looking at the betting activity before the election, then it's easy to track it online. We loaded up our bets on US cyclical. So we have been running for several years now, a US portfolio, North American and European portfolio. And 48 hours before the election results, we had a little get together of the team, and the relevant fund manager decided to increase their weight on industrials in anticipation of a Trump victory. We were a little surprised by the margin. We didn't expect it to be as decisive as it was, but the expectation in the Marcellus office was of a Trump victory, and accordingly the weightage of our US cyclicals, US industrials investments was increased. And thankfully, on election day, as the results came out, we were up 2.5% yesterday, and there's further discussions happening in the office as I left the office about what more to do to benefit from the Trump victory.
Okay. Just a couple more questions from my end, and then Mahima, I'll give it to you. Sure. But so I'm curious about what you make of this. We've already seen commodities react somewhat. I mean, of course, crude has been relatively range bound within that $75 odd per barrel mark. I'm talking about Brent. there is an expectation that dollar will strengthen. There is an expectation that inflationary pressures will remain in the US. Yields will be elevated. There could be trade tensions with China. What does all of that mean for commodities as a whole, and how do you look at it from the lens of an Indian investor?
Okay. So I think there's two straightforward investment implications, and then I'll give you the one which is being tricky to figure out, right? So starting with the most straightforward one, given his historical hawkishness vis-a-vis China, given that he's said things like 60% tariffs and so on, I think it's reasonably straightforward that we increase our China plus one investments, and there's a fair bit of that in our Indian portfolio. So I'm sure those watching would have heard me talk about Divi's Labs over several years now. So it's been roughly 18 months since we tripled our investment in Divi's, and China plus one is working out nicely. There are smaller investments that we made on that theme, Polymedicure being another one of them, which is catheters, dialysis equipment, dialyzers, basically hospital equipment. China dominates the world in APIs. Hopefully Divi's will get a bigger chunk of that. China dominates the world in medical equipment. Hopefully Polymedicure will get a chunk of that, right? So there's a number of other such plays in India which should do well as Trump presses the China plus button that much harder. The second reasonably straightforward investment, I think, is American and North American cyclicals and North American industrials, to be specific, right? So we increase that exposure to that because he's been very clear that he wants North America, specifically USA, to industrialize further. So if USA industrializes further, then investments of ours such as Parker Hannifin, which is the industrial supplier, should benefit. And this seems to me to be these two bets, I think, are reasonably uncontroversial. Quick disclaimer, I'm invested in all of these names through Marcellus, so are my parents and my clients. The one that is proving harder to get a grip on is the call on inflation. Will Trump generate higher CPI inflation, or will Trump try to engineer a downshift in inflation, for example, by making sure that Russian oil comes back on stream, right? I don't have a decisive view. We're sort of debating that in the office. If you take the view that inflation is not going to suddenly jump up in the next 12 months, US long-term bond yields are not going to jump up, then you might be even more constructive on tech cyclicals. Okay. So, for example, ASML is the kind of base of the global semiconductor supply chain. ASML is a classic tech cyclical. If we end up believing that, hey, we shouldn't worry about a big jump in long-term bond yields in America, and we are in for a big jump in tech spending on semiconductors, then perhaps ASML or tech cyclicals is a broader semiconductor ecosystem. Perhaps we become constructive on that. But industrial cyclicals, I think, easier call, be more constructive. And then China plus one investments back in our own stock market in India, easier call, be more constructive, because I think the real China plus one story potentially begins now, as opposed to whatever we've seen in the last couple of years, which is just the kind of jhaki, the trailer. Abhi to asli picture baki hai.
But you don't have a view on where the bond yields are headed for now. It's 4.5 for the 10-year.
That's right. So if I had a decisive view on bond yields, I'll be able to give you a more decisive view on US cyclicals.
Right. Saurabh, I want to understand that all the policies point towards strengthening of dollars, be it import curves, be it tariff hikes. So I want to understand that if the dollar strengthens, the ideal way is that the gold will come down. So your view, if you have any on gold prices, how will they react in the medium term going forward?
Yeah, look, I've, both in the context of Indian equities and in the context of American equities, I've never been a fan of gold investments. Yeah. Like, just think about it, right? We're discussing the two best compounding markets in the world over the last 20 years. India's 20-year dollar compounding is 13%. America is, I think, 10%. Over the last 10 years, America is 13%. India is 10%. You got two of the world, these are literally the two best large markets in the world. 65% of the world's stock market wealth comes from these two markets. Even better, Sone pe suhaga, no pun intended. Sone pe suhaga, correlation between these two markets is very low. So when America fires, India might be asleep. When India fires, America might be asleep. You got two markets which perform really well, low correlation, giving you diversification, giving you safety. Why on earth would you want to go and buy gold, boss? I don't understand. Why on earth? Aapko return bhi kam milegi, lower returns, higher volatility. Why do people do it? Just beats me. So what we have done, and we've advocated for a long time, is build a portfolio which is partly America, partly India. You diversify. The two markets have low correlation, so your portfolio gets stability. And as I think most children in India now know, both markets give you 11, 12, there are 11 to 13% long-term dollar compounding, and therefore you're compounding at a decent rate with low volatility, free lunch. Why would you want to go and waste your energy on buying gold?
I've heard an argument that said that when this gentleman who was speaking to me said 25-30 years back when he went to a jewelry store, it was a small one.
Haji.
And then over the course of the next 10 years, they opened multiple branches. And then they went to multiple cities.
Sure.
So investing in the jewelry store might have
nice
actually
one.
been
So Titan last 20 years
Exactly.
is 1000x.
Yeah.
So you want to buy bars of gold, or you want to buy the biggest jeweler in the country? So we bought Titan. I wish I had bought it 20 years ago. Right?
All of us wish that.
Yeah, I only bought it 7 years ago. But yeah, jokes apart, I think this whole obsession about commodities, gold, I think is a little misplaced. If you're a professional commodity trader, or you're doing it as a hobby, thoda sa satte ke liye, you do commodity trading, right? It gives you a kick, then it's fine. But for serious investors, for people who are setting aside lifetime wealth, this whole speculation on commodities, gold, thoda sa I get a little perplexed by it, especially since the government in our country has done so much to make it easy for ordinary Indians to access overseas stock markets.
Since you spoke about Titan, and we've had this conversation, the two of us, quite a bit. She tracks Trent as well as Titan. Right. There is this whole conversation about the move to studded, the move towards lab-grown, the ease of access of this kind of jewelry. Are you studying that? Do you think that Trent is slated for better growth because of the kind of space that opens up for lab-grown and for studded?
Right. Look, I mean, we're big holders in Trent as well. I don't think LGD. I don't think lab-grown diamonds is a significant part of our earnings forecast for Trent. Okay. That being said, for Titan, for the last one year, for the last year or so, we've had constant discussions with them about what they plan to do about the space. I think it'll be fair to say we are concerned. So far, the concern has resulted in something 6-7 months ago, a reduction in our position size in Titan. It's still a chunky part of consistent compounders, but yes, LGD has warranted a reduction in our position size in Titan. Why haven't we sold Titan on the back of LGD? Because in the Western world, lab-grown diamonds hasn't turned out to be a big hit, right? In the Indian context, maybe it'll, because we are more price sensitive. Maybe in the Indian context, lab-grown diamonds might be a more potent issue for jewelers, but in the Western world it hasn't really worked out. Is it because of De Beers' marketing muscle? Is it something else? I don't know. But in the Indian context, we're keeping a watchful eye on the issue, and even all of that being said, even Titan's recent results suggest very strong demand for jewelry. In Trent's case, we haven't really baked it into the numbers. Trent is doing so much else, which I think will shoot the lights out. Trent is doing so much else which will shoot the lights out that we haven't really lost a lot of sleep on LGD for Trent.
I've asked our viewers to send questions, and one or two of them have sent their portfolios for Saurabh to review. That's not something that we can do. If you've got specific questions like Amit Uppal does, and this is an interesting one because this whole rhetoric, and we're talking largely about the presidential election, Trump has against renewable. And his specific question is, can Saurabh talk about the energy sector, especially the latest listing, Worry Energy? It is that renewable play, even if you don't have a specific view on Worry. Can you talk about the opportunities, if at all, in the energy space?
So look, I think the obsession around ESG is abating. I've seen it with our Western clients. The obsession around ESG is abating. I'm nobody to comment on should it abate, should it not, should we be more concerned about the environment, should we not. My job is to be realistic, and I can see amongst our Western client base, the institutional investors for whom we allocate money, their focus on ESG is clearly abated in the last couple of years. Given Trump's known stance on this issue, I suspect it will go down. The whole obsession about ESG will go down a couple of notches. Now, given that nobody wants to have their, the air around them, clogged up with noxious substances, and North India, where we know that pollution is a big issue, my reading is that the way the world will reconcile itself to saying we want cheap power, but we don't want day-to-day fumes. I think nuclear power will end up making a big comeback. It's already made a big comeback in America. You might have heard firms like Amazon have invested in captive nuclear power plants because the big data, sorry, the data centers require so much power that firms like Amazon have invested in captive nuclear power. And if that's the case, then and Trump is back, I think there's a good chance that nuclear power makes a comeback.
India has talked about modular nuclear.
Our government has talked about it. In our country's case, technology is a bit of an issue. But if the friendship between the two premiers, the Indian and the American premier, if the friendship escalates, then who knows, America might be willing to do technology sharing deals. So I'd be a little careful about getting too worked up about renewable, given that the main sponsors of renewables, the Western nations, are gradually and slowly throttling off on it, as evidenced by the clear rise of nuclear power in America over the last 18 months or so.
Right. We have one more question from SP Sinha, who's from Mumbai, and he wants a view on the auto space. He's listed a lot of auto stocks. I'll not name all of them, but overall, your view on the auto space, and he wants to know, what would be your top picks in the auto space?
If you do, yeah.
Look, I mean, what I've been telling my colleagues, what I've been telling us clients, what I've been telling other people who are interested in subjects is, I think after 3 great years of economic growth after COVID, we're in a cyclical downturn. There's nothing unusual about it. No country's economy goes up in a straight line. Right. So F22, F23, F24, India had 7% GDP growth, 18, 19, 20% EPS growth. I think we've entered a cyclical downturn. I don't think it's a multi-year issue. I think it's a multi-quarter issue. Given that we've entered a cyclical downturn, I think auto stocks will come off far more. In fact, en route to your office, we were having a lovely conference call on how much more will auto stocks come off. And when auto stocks come off far more, we're trying to identify some juicy bets that we will load up on. So I would suggest, if you are very enthusiastic about the auto sector today, I would just say temper your enthusiasm a little bit. Give it another couple of quarters of soft auto earnings, and then we should think about it. If someone wants to know what are we invested in auto, our biggest investment in auto today is Eicher Motors. Why? Because Royal Enfield tends to be less of a cyclical play, and Royal Enfield also has a significant rural angle. I think rural India is coming back. The numbers suggest, not just Royal Enfield numbers, generally two-wheeler numbers suggest, discussions with the FMCG companies suggest rural India is coming back. So Royal Enfield's done a terrific job on rural. Siddharth Lal and company have launched a range of bikes from the 1.5 lakh price point to the 4 lakh price point. I haven't seen too many competitors put up a credible show. I think if anybody has done a half decent job, it's the Yazdi Java people. They seem to be doing a decent job. Barring that, there's no real competition at the Royal Enfield end. Secondly, on exports, they've done a terrific job. Yeah. I'd gone to New York on work 3 weeks ago, and on 5th Avenue, saw a massive Royal Enfield ka sign, and felt really good as an Indian. On 5th Avenue, massive Royal Enfield ka motorbike. Yes. And the Volvo Eicher trucks piece also has come along nicely. So kudos to the folks at Eicher Motors. They've done a good job. All of that being said, I would suggest whoever's enthusiastic about auto, just be a little careful, because I think we'll have 2 to 3 quarters of soft numbers on the economy in general and auto in particular.
So New York is one, but I saw one very close to Denpasar airport not too long back, so that's pretty cool as well. Specific question from CA Uttam Kedia, and he insists on doing that, just like you do, Mahima. He's asking Saurabh about chemicals, specialty chemicals, in the context of China Plus One. You've kind of mentioned some sectors that could benefit, but speaking of soft earnings and bottoming out, do you think this one has?
Yeah, I think whilst I would love to believe that China will stop dumping, or Trump will make China stop dumping, or China will have a great economic recovery, there's many ways to think about it, or our country will impose a whole host of anti-dumping duties and so on. I think the general tone and tenor of chemical prices will be niche. So what we have tried to do is invest in companies which are in spec chem, but whose raw material comes from China, and therefore they benefit from Chinese dumping sasta stuff into India rather than being a casualty of the same. So again, Divi's would be a straightforward example. Divi's gets the KSM, the key starter materials for Divi's comes from China, and therefore as China makes the KSMs cheaper, Divi's margins have gone up a bit over the last 5-6 quarters, right? Similarly, in our small cap portfolio, there's a company that we've invested in a year and a bit ago, which is benefiting from the same dynamic. It's called AMI Organics. Yes. So AMI supplies to folks like Divi's. So AMI's raw materials go into Divi's as API, but AMI in turn gets raw materials from China, right? We've had alkylamines for a long time. Alkylamines, as is well known, they have requested the government to put ADD on acetonitrile. I don't know what will happen to that request. Alkyl is neither making a loss nor making a profit on acetonitrile, but thankfully for us and for all those who are alkyl shareholders watching, on methylamines and ethylamines, that can't be dumped from China, and therefore on methyl and ethyl, alkyl's numbers have blossomed nicely, and I think the numbers of the last 2 quarters, courtesy ethyl and methyl, alkyl is doing fine. So either look for companies who are not vulnerable to Chinese dumping, or look for companies like Divi's and Ami Organics who benefit from Chinese dumping. I think it'll be a little fanciful for me to sit here in BKC and see Chinese dumping kam ho jayega ya band ho jayega.
Yeah, all right. But Saurabh, a pleasure as always having you.
My pleasure.
In
Thank you for having me.
Thank you so much for joining in. I'm looking forward to your chat with Neeraj about your latest book. On that note, it's time to turn to earnings, and we are talking about Tata Steel. Remember, the numbers were better than expected. There was something to do with inventories that came into play that resulted in a widening of or an expansion in the margins. And we had a conversation with the management, with the Chief Executive Officer and the Managing Director of the company, TV Narendran. And here's what he had to say about the numbers.
So I think steel industry is a cyclical industry, and oftentimes the externalities are conspiring against us, so to speak, right? So I think we are going through a period where the market conditions have been quite tough, both in Europe and in India. So what we can do is take actions on things which are in our control, which is more to look at the costs, the efficiencies, the capital assets and things like that. So that's the work which is going on. In the last quarter, we commissioned the largest blast furnace in India in Kalinganagar. We shut down 2 of our blast furnaces in the UK, and we are working on taking out the fixed costs in UK. And in Netherlands, the production is back to where it used to be after the blast furnace relining that we did last year. Market conditions have been tougher, so steel prices have dropped across geographies. Coal prices have also dropped, and so we took some benefits on the coal side. But overall, yes, it's been a challenging quarter, but not a bad quarter.
The raw material costs for you have still come in higher on the reported quarter, and yet you've done very well on the EBITDA front. So how have you controlled the cost, and is this percolating into Q3 as well? Coupled with that, the other question is, I presume that raw material costs would be benign for Q3 at the very least. I don't think it's possible to predict beyond that.
So I think in Q2, we had a $20 advantage compared to Q1 on coal prices, and about $10 advantage on iron ore prices. That's more for Europe. In Q3, we are expecting another $20 advantage for coal prices, both in Europe, I mean in India for sure, and in Europe, I think it's about $10 to $15. So that's the range. So yes, raw material prices are still soft. Let's say coking coal price around $200. But we'll wait and see. I think if on the flip side, if steel prices start going up, I'm sure the raw material prices will also start picking up. But like I said, we focused a lot on many of the other operating efficiencies, and that's translated a bit into the bottom line as well.
Got it. The belief is, sir, that Q3 will have higher spreads and lower raw material costs. Would you believe both of these will happen in tandem for you?
Not necessarily. Steel prices have started going up, but if you really look at it in India, steel prices were quite high compared to July compared to September. Right? While from October, steel prices have started going up, I don't think it will reach July levels by December. Okay. So as a consequence, we are guiding that realizations in India in Q3 will be 2,000 rupees per ton lower than Q2. Okay. We also have the auto contracts, which are typically a half-yearly contract, which have come in. So again, in the first half of the year, you have the advantage of higher prices in April and May. So there are all these things which come in. So we're expecting on India realizations to be about 2,000 rupees lower in Q3 compared to Q2. In Europe as well, you will have lower realization. So I don't think we are out of the woods yet. I'll wait for another quarter before I can give more positive commentary.
Got it. So console spreads very likely could be under check. Would that be a fair assumption?
Absolutely.
Absolutely. Okay. What about demand, sir? I mean, would love to know both in India as well as globally now that the big events, so to say, surrounding the world, Indian elections, US elections are both behind us. How do you gauge the demand?
So in India, the demand has been strong. I think construction has been weaker than we thought, partly because monsoons is always a bad quarter for construction. But even otherwise, I think government spending was a bit low in the first half of the financial year because of elections, etc. But we're expecting that to pick up in the second half. Normally, January to June is the best period for construction. The festivals are behind us because that's when a lot of the workforce also goes back home to their homes. So I think we are expecting second half to be much better for construction. Auto started well but slipped a bit in the last couple of months. We are expecting that to revive if construction picks up. Two-wheelers continues to be reasonably strong. They were the weak part of auto for most of the last 3 years. But this year, they've been much stronger than they've been before. Motorcycle demand particularly, which means that the rural demand is reasonably strong. So I think across sectors, we are seeing demand is okay in India. The problem is more about margins in India because of the threat of imports and the international sentiments. As far as Europe is concerned, the biggest concern is Germany. Germany is struggling, and Germany is 25% of the GDP of Europe. France and Italy are another 25% of the GDP of Europe. They are doing okay. But the German economy needs to kickstart for Europe to do well. I do expect that post the election of President Trump, Europe will probably spend more in Europe to make sure that they can take care of their own destiny. I also believe that if the Ukraine war comes to an end, there will be a lot of reconstruction spend in Europe as well. So let's see how it plays out. But Germany is the country to watch out for in Europe.
Wow. So actually, two questions on demand before we wrap up, because I only have limited time with you, I understand. One is, Germany is struggling. Indian four-wheelers still looking not the best. I mean, conversations with auto companies seem to suggest that things are not really hunky-dory, at least on the passenger vehicle side. Could that be a big impediment to volume growth in Q3 and Q4 as things stand, sir?
So from a steel industry point of view, we more look at commercial vehicles. They are the most steel-intensive automotive.
But there too, the cycle doesn't seem to be strong except for tractors. Sorry for interjecting, but just I'm trying to understand.
Absolutely, you're right. Tractors continues to be strong. That's why I'm saying commercial vehicles depends a lot on construction and mining. Okay, and so I think construction, like I said, has been weaker than most people thought in the last 6 months. As construction picks up, I do expect commercial vehicles to have slightly better numbers. Passengers very important, but like I said, from a steel intensity point of view, commercial is most important, then passenger, then two-wheeler. But passenger also, let's wait and see how it plays out post-festivals.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable show.
If you want to be in the money.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide?
Good afternoon and welcome. You're watching Earnings Edge on NDTV Profit. I'm Harsh Saita. With me is Rucha Somaya as well as Punit Javeri. It's a packed house and we're in the thick of earnings. So let's first off quickly look at where markets are at. The Nifty still in the red. There's still some bit of pressure on the benchmark index at the very least. 1% is where we are holding for. That's a possible positive, if at all. There can be one at this point. But let's also look at in terms of contributors, because IT, of course, taking a bit of a knock in trade today. So you have an Infosys within the top 4 losers, but the heavyweights, Reliance as well as HDFC Bank, contributing as well in terms of the Nifty losers. ICICI Bank has slipped furthermore, around a 1.7% fall now, and therefore also accentuating the pain on the index. Let's look at some stocks on the Nifty, in fact, which are gaining in trade, because numbers are also having some part to play in the way the Nifty is moving. You're looking at a 6% on Apollo Hospitals. SBI is doing relatively well. Mind you, numbers coming out tomorrow for State Bank of India. So that one will also be on everyone's radar. Tata Steel doing relatively well as well, 0.5% higher on Tata Steel. The ones not doing as well, Hindalco on the back of Novelis numbers. You're seeing Trent down now 4.5%. And you're seeing Grasim, Tech Mahindra also taking a bit of a knock after the kind of move in IT that we saw yesterday. And let's pull up the Nifty IT index. You're seeing a bit of knock across the board on IT. So that's one space that, of course, we are monitoring. 1.25% lower on the Nifty IT pack. You're seeing 1.4% lower on the Nifty Auto as well. And we have Puneet with us, so we'll get some perspective on that. We have the Nifty Metal as well as the Nifty Pharma, which are down 1.6% each. So not doing well. But across the board, it's been a tough day. The Nifty PSU Bank insulating some bit of the fall, 0.33% higher in trade on a day like this, definitely positive. Let's pull up the advanced decline, try and see whether the volatility has at least come off, and it has. That the morning was tough, but it's come off now, and the advanced decline somewhere in parity, nearly 1:1, and therefore those sharp reversals that we saw early in the day have now led to a little more of stability at least. So that's decentish. Around 1% lower on the Nifty index, of course, and that's how the day is essentially playing out. But TeamLease Services and stock taking a bit of a knock, Rucha, in trade. Just give us a lowdown first off on the numbers before we go on and have a conversation with the CFO, Ramani Datti, who's joining us.
So, Harsh, revenue was up around 8.5%, but what is upsetting the street right now is, I think, the margins, because management had said that the margins would be good, and essentially it also said that BFSI will largely be muted, especially in the third quarter, is what the management said. And this is a major problem with IT sector, wherein most of its revenue comes from the north, from the US, as well as the banking space. And TeamLease yesterday on the call mentioned that BFSI will largely be muted in the third quarter. But again, coming back to the numbers, well, margins came in at about 1% this time versus 0.3% on a quarter-on-quarter basis. Well, net profit is up around 28%. So though the numbers look good, it's essentially the commentary which is, I think, is upsetting the street over here. Headcount was also healthy. The company added about 18,500 employees on a totality basis, which is up 6% on a quarter-to-quarter basis. But largely talking about the other highlights is that specialized staffing was also under pressure. But let's take more perspective from the CFO who's joining with us right now, Mr. Dathi, Miss Dathi. Pardon me about that. Well, thanks for joining us on the show. Can you give us some highlight as to what's your take on the results this time?
Sure. So this quarter, we have added a net headcount of close to 18,000. And for the first half of this year, we did add about 31,000 headcount between our staffing and apprenticeship business. And on a year-on-year basis, it's close to 48,000 net addition. So in terms of volume growth across all the sectors, we are seeing very good demand. BFSI, on the back of RBI regulations, especially regarding outsourcing of sales profiles, will have an effect on our BFSI headcount growth in Q3. So that's the reason we said BFSI can be muted in Q3. Having said that, be it in consumer vertical, retail, telecom, and manufacturing and other emerging verticals, we are seeing very good growth. And even net of BFSI drop, we believe that there should be at least 8 to 10,000 net headcount growth in Q3 as well. And by Q4, we expect recovery to bounce back, including BFSI across all other sectors, and we should be able to continue with a year-on-year growth of 18 to 20% headcount growth and revenue growth upwards of 20%.
Right, but let's talk about the BFSI vertical over here. Well, I guess BFSI is largely picking up even for other IT companies. So what's your take on the BFSI segment? Are you seeing more kind of hiring? Because more hiring will likely imply that the demand is now picking up for the IT sector as a whole.
Yeah. No, let me unpack this into two parts. So one is BFSI within our IT staffing and BFSI in our general staffing. So right now we are seeing some sort of headwinds on the non-IT side of BFSI related hiring, and that was specific to Q3. Again, starting Q4, we are expecting the numbers to come back in BFSI non-IT profiles. Now, coming back to IT profiles, actually, we are seeing very good growth within IT, mainly coming from the GCC segment. And we believe this hiring trend in GCC, BFSI, IT will continue even for Q3 and Q4. And in fact, we are expecting positive headcount recovery starting 1st of Jan, starting Q4 this year.
Mr. Mani, thank you so much for joining us today here, and season greetings to you and everybody at TeamLease. It's Puneet here. You did mention about the headcount addition expectations is strong for the second half as well. I just wanted to check on your new logos addition in this particular quarter. You've had decent additions as well. What's the outlook on that over the next 2 quarters for this fiscal year? And any kind of commentary that you can give us on that?
No, our new logo addition has been strong over the last 1.5 years, and we will continue that momentum even for second half of this year as well. We are focusing a lot on the manufacturing segment, auto and engineering segments, especially in terms of new logo acquisition, and we are seeing very good traction there. And again, within IT, a lot of new GCC clients are also getting onboarded. We have a good pipeline of new GCC customer addition even for second half of this year. So we are very positive to continue the current momentum of new client addition for the second half as well. Apart from our staffing businesses, even in our apprenticeship business, So we are acquiring a lot of ITES clients, because so far in our apprenticeship business, we used to have a lot of concentration with auto industry, and now we are building a lot of pipeline with IT and ITES clients as well for the apprenticeship business, which is very good because these clients tend to give us a higher learning component and higher realization for our apprenticeship business.
Right. Hi, Mr. Datti. This is Harsh here. Ma'am, just want to quickly understand from you, where does therefore top line go maybe 2 to 3 years from now, and where outside of GCC are the other pockets of opportunity that you're focusing on?
So for us, the revenue growth, we would like to maintain consistently warm between 20 to 25% of top line growth over the next 3 to 5 year time frame as well, but with a higher focus on margin expansion and absolute profit expansion, because we hit our rock bottom in Q1 of this year with all the impacts coming from be it IT staffing or apprenticeship business and other impacts. And now we are focusing on expanding our profits quarter on quarter. So this year we posted about 30% sequential growth, and we believe we should be able to maintain at least a 20% sequential growth in profits for the next quarters as well. And overall, for the next 3 to 5 years, we believe there will be a higher contribution coming from IT staffing and HR services, which have relatively a higher margin profile compared to general staffing, leading to the overall margin expansion at group level.
Right, Ms. Datti, one question on the specialized staffing services. Well, this one contributes about 5.1% to the total revenue in the second quarter, and the margins here have also, gotten a little better at 7.9% in terms of EBITDA versus 6.4% last time. But this has been a little under pressure, as the management had mentioned on the call, because of cautious demand in the IT vertical. So what's your sense on the specialized staffing? Do you think that this can be margin accretive and, grow in terms of volumes going ahead?
Yeah. For us, specialized staffing, as you rightly mentioned, gives us about 5% in revenue, but in terms of profit contribution, it gives almost 30% share. And right now, that particular vertical is under pressure because of the headwinds in IT industry, which we believe will continue till Q3. But starting Q4, we are expecting a recovery. And with the increase in top line and growth in the volume, even the EBITDA margins can be expanded further. So currently, we are at about 7.8, 7.9% EBITDA margin, which can be improved to 8.5 to 9% over the next 1 year time frame.
Okay, so you will see pressure in this vertical, but in terms of margin, can we expect Q3 margin in this segment to dilute in the next quarter?
We are not expecting any dilution in margin in this segment for next quarter. So we can maintain the current margin profile for next quarter as well.
Right. Okay. And in terms of the other HR services, which you mentioned, has kind of a good volume, and also the outlook is good over here. Well, when I look at the EBITDA margin, it was negative last quarter, and you've posted like a flat kind of margin this time. So good improvement over here. So do you expect this kind of positive EBITDA margin to sustain, or how is the EBITDA margin profile looking like in the other HR services segment?
Yeah. In other HR services, this year we should be able to maintain at least a 6% overall EBITDA margin. And mainly this contribution is coming from our EdTech business. A lot of new universities have been signed, and the billing has started in Q2, end of Q2 and Q3. We believe that the profitability will be much higher, both on a sequential basis as well as year-on-year basis. In fact, this year, 100% of our EdTech profits get booked in second half of the year. So that should give us a higher bump up in margins and absolute profits in H2.
Mr. Mani, just one final question from my side. In Q3, what is the expectation of sectoral growth that will be driven? And talk to us a little bit about BFSI as well. There has been some clampdown by the RBI in terms of guidelines as well in certain segments and pockets, which were, high hiring segments. So just talk us through which segments do you anticipate in the short term to grow for you in Q3 and Q4? I think consumers and telecom is something that you mentioned, but talk to us on BFSI as well. What is the outlook for the next 2 quarters?
Yeah. BFSI, as I mentioned, in non-IT profiles, Q3 can be muted, or in fact, there can be a slight drop in our BFSI headcount. So currently in our overall headcount, we have 20% exposure to BFSI. And here are the profiles that we are expecting that there can be a drop is mainly into sales, the BFSI sales, the credit card sales, loan recovery. These are the profiles where we are expecting some dip. But other than BFSI, be it consumer, retail, manufacturing, ITES, and other emerging sectors, telecom, we are seeing very good demand in Q3 and Q4 as well. Even within IT, the GCC segments, the demand for the profiles in IT and ITES is very good for Q3 and Q4.
Ms. Datti, one follow-on with regard to the EdTech EBITDA, which you were speaking about, likely to recover in H2. Could you give us some color on this? Could you give us an understanding? You said revenues will likely be recognized in Q3, Q4, and therefore margins will be much better, profitability will be much better in those quarters. Could you talk to us about where, therefore, what will be the impact on margins and give us context on this, please?
Yeah, sure. In our EdTech business, our billing cycle follows the student admission. And this year, specifically this year, UGC has given guidelines to all universities to realign their curriculum matching with the new education policy. So because of that, many universities have delayed the student admission cycle by 1 or 2 months. So that has to some extent deferred our revenue billing from Q2 to Q3. So even if you look at our Q2 performance in HR services last year, in terms of profit contribution, it gave almost close to 15% profit contribution at group level. But this time it's kind of muted because of this deferral in university revenue billing. However, Q3 and Q4, we are expecting between these 2 quarters close to a 15 crore of profit contribution coming from EdTech vertical alone.
Therefore, where should margins lie, ma'am? Q3, Q4? What should be the improvement?
Margin as a percentage, it's very difficult for us to give a guidance. Sure. But on absolute profits, we are expecting at least a 20% sequential growth on profits, on absolute profits.
Okay, understood. Thank you so much, ma'am. Been a pleasure chatting. Thanks so much for coming in and speaking with us.
Thank you.
Right, wee bit of pressure on TeamLease as we speak, 4.5% lower, but off the day's lows. So something that's recovering in some form or shape. But M&M came out with numbers. Puneet, Autopack also under pressure. If you can pull up the Nifty Auto, strong set from M&M. Stock down 2/3% thereabouts, but you're looking at Auto under pressure, 1% odd lower. Puneet, give us context. First, M&M's numbers and maybe a few lines on Auto. Just give us some context.
Yeah, definitely. So, M&M was expected to be strong and that's what they delivered, but the profits has come much higher than expectations. So, revenue was, of course, growing double digits in this particular quarter. That's come in very well. EBITDA as well, if we can see, the 21% growth year, and this includes, of course, the income and investments as well. Apart from that, profitability has been another aspect as well. 13% growth in this particular time frame to come in at 3,800 crores. And what's important of profitability is expected to be around 3,500 as per Bloomberg estimates. Now, just a quick line on volumes. In this particular quarter, we had 18% volume growth by the company. Was the expectation of 1 to 2% from Maruti and just flat volumes from Tata Motors as well. Just to watch out, there'll be 3 things. Order book of the Thar Rocks will be one of the things to watch out for in the management commentary. Apart from that, what is the current discount in the festive period? We had seen increased discounts for all players, but M&M also increased that as well. So we'll see what has been the impact of that in terms of Q3 volume, because October has been strong. And finally, the launch of the EV is going to be one of the most exciting things for M&M. The first, this first new born electric EV scheduled on November 26th. So these 3 aspects will be one of the key things to watch out for, Harsh. And I think, apart from that, Maruti already came out with numbers. Tata Motors is coming out tomorrow. So it's going to be a very strong week, I think, for autos in general.
Well, let's hope those numbers are strong for it to be a strong week, because currently auto is looking weak this week. But I want to quickly mark out Trent as well. That one is down 6% now on the back of numbers. We'll obviously get more perspective, but we're going to cut into another conversation. Mankind Pharma. It's recorded a 29% uptick in profits. Margins have expanded. Very strong numbers. Growth also good. We spoke with Vice Chairman and Managing Director Rajiv Juneja on the quarter gone by. Listen in to a slice of that conversation.
Export, our philosophy is totally clear. Whatever we export, we basically export complex, difficult to make kind of products. And if some opportunity comes, that really adds to the growth side. So nothing special we have done. It's a continuous, consistent kind of a work, which basically is happening, and that's giving us a double-digit kind of a growth in export side.
Got it. Now on BSV, now you'll start integrating the asset. What are the milestones that you have set, or what kind of margin you are targeting when it comes to BSV?
Objective of taking BSV is a bit different. Objective basically is what to bring entry barrier products. I mean, those products which have a patent, which can draw attention from the customer, the consumer, whether it's a India market or export market. And of course, when you have patent products, when you have very less competitive products, the margins are supposed to go up. So last year, if margin was 28%, this year its adjusted margins are 29%. Going forward, as this integration will happen, it's too early to say anything, but hopefully it will add a lot of value to mankind in every term.
Please go ahead.
In every term, I mean, in terms of value addition, in terms of giving us fantastic products, in terms of margins, because whatever margins we see, these margins are byproduct of some kind of a special thing in a product, some kind of a good marketing, some kind of efforts from the company side.
Got it. Also, your India formulation business, I just wanted to get a sense on how seasonality panned out this quarter, because it seems like obviously on the chronic side you've done a good thing, but is it fair to assume that the growth would have been higher, if we had a normal season? I mean, how did you perform versus your expectations?
One, our focus is towards chronic side, and that's one reason quarter after quarter, year after year, you see a lot of traction in chronic side. Our chronic is doing fantastic. There's no doubt about this. As far as the seasonality is concerned, it was good. It was okay. Sometimes the kind of numbers or the kind of growth you expect does not come, but these are intentional. Why I'm saying it? Because once in a while, once in 5 years, we bring commercial excellence in the company. We hire external agencies and make sure that whatever inefficient areas are there, whatever things are not really, moving as per our speed, are being identified, worked on. So we don't see short-term losses or short-term less growth. We always work for the future. And that's one reason the growth is a bit less than what we expected. Still, it is 1.1% to the industry growth. But miles to go, we are a more capable company than what we are projecting right now.
Right, all right. Also, on the consumer healthcare business, so we've seen growth of 20% there, which is kind of quite, strong performance. Now, how should we think about what is the sustainable growth that you are expecting here when it comes to your consumer business?
Consumer business, we have time and again said, is closest to our heart. We give our everything to consumer business. It does not mean we don't give everything to other business, but it has given us so much of name. So last year, we started the process of carving it out of main business so that we can bring right talent, right practices. It is carved out. It's a separate entity, 100% of Mankind. So you can see our confidence. We hope that OTC consumer business of Mankind would give us double-digit growth always, this year as well, and 18 to 20% EBITDA. That's the kind of expectations we carry in our head.
Got it. Now, we spoke about BSV, we spoke about your consumer business and India formulation business. Now, considering all this, what is the target that you have set when it comes to revenue and EBITDA for, say, FY25?
We always maintain one guidelines that we are supposed to perform better than the IPM, 1.3 to 1.4 times to the IPM. That we basically want to maintain. Plus, it's always good that you speak less and your action demonstrate more. It's always good. Market likes that, and we believe in that. That's the DNA of Mankind. Walk the talk.
Got it. Also, so you have raised 10,000 crores from non-convertible debentures and commercial papers. Now, basis the tenure, repayment tenure, what will be the overall cumulative debt that you are debt repayment annually you would be targeting in FY25 and 26?
In 3 years' time, we are supposed to, hopefully, we repay all the debt. Right now, the debt stands at 10,000 crore rupees. But naturally, in next few weeks, in the middle of December, hopefully, QIP will happen of 3,000 crore rupees. That would be one. Plus, we have some non-core asset to the tune of 600 crore rupees. They would be sold off, and the money will definitely go for the debt repayment. And we are pretty confident that in 3 years' time, we'll be able to pay our debts back. We are making a quite discipline that our debt to EBITDA should not be more than 2 times.
Oh, okay. Also on the Panacea brand, so I think last year you grew very well. Have you been able to maintain that kind of growth?
Yes, madam, absolutely. We are having a growth of 20-25% on Panacea brands. They're doing fantastic. We always believed in Panacea acquisition, where market said it is expensive, but we are very happy. Same kind of a confidence we have got in Bharat Serum, PSV.
Okay, on the current portfolio, if you can share what therapies you believe will offer headroom for improvement, maybe say in next 2 to 3 years.
In last couple of years, we have launched a lot of chronic therapy areas, approximately 10 divisions. They are in very infancy stage. They are on the cusp of becoming bigger and bigger. Right now, the PCPM is coming to the tune of 3.5 lakh rupees, 3 to 3.5 lakh rupees. We hope that, plus they're growing at 25% rate of growth. So once these will become bigger, so chronic share will increase. At the same time, we are focusing towards onco because we feel that cancer is becoming a next epidemic in India. Neuro is one because after COVID, a lot of mental problems have creeped in mankind in India, and we hope that these are certain areas. Apart from this, Gyna is there because now we have acquired IVF side of IVF products of BSV, and hope that these certain products therapy will give us a lot of good growth.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Well, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that'll help you move with the tide.
An unmissable trade.
If you want to be in the money.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The Wall Street deals, finance and policy news that
Profit booking in the market. Nifty and the Sensex fall after a stellar rally following Donald Trump's win. Heavyweights ICICI Bank and RIL drag the market. Rupee weakens further, hits a fresh low. A sea of red engulfs most sectors, with metal and pharma leading the declines. PSU banks and media, only sectors holding on to modest gains. In a major blow for Anil Ambani, our power is barred for 3 years as the government cancels solar bid over fake documents and fraudulent guarantees. Investor caution grows as Hindalco shares drop a staggering 7% following Novelis' weak Q2 earnings and a dull market outlook. Hello and welcome. You're watching Market IQ and I'm your host Pallavi Nahata. Let's take a quick look at the markets first. So after a stellar run up yesterday, we're clearly seeing some signs of profit booking on the Nifty 50 as well as the Sensex, both down by about 1%. On the Nifty 50, we're down by about 250 points and hovering around the 24,200 mark. On the Sensex, we're down by about 750 points and hovering close to the 79,600 mark. Let's also take a quick look at the key contributories on the Nifty 50. We're clearly seeing more declines with very few advances. ICICI Bank, RIL alone contributing almost 60 points to the decline on the benchmark. Trent and HDFC Bank among the other top losers. What's performing well is Apollo Hospitals on the back of a good set of numbers. SBI, L&T, HDFC Life providing a little bit of support but not all that much to the benchmark. We're actually closer to the low point on the Nifty 50, but let's also take a quick look at the sectoral indices and how those are performing. There again, we're seeing most sectors in the red, and it's actually Nifty PSU Bank as well as Nifty Media that are the only two sectors currently in the green, and that too by not so much. In case of Nifty PSU Bank, we're currently seeing it clock gains of just about 1/3%. Nifty Media almost flat, currently up by just about 1/10%. All other sectors continue to remain in the red, with Nifty Metal and Nifty Pharma along with Nifty Commodities down by over 1.5%, anywhere between 1.5% to 2.5%. But let's also take a quick look at the broader markets. While those are performing a tad bit better than the benchmarks, there again we're seeing underperformance on the Nifty Mid Cap 150, that's down by about 0.2%, and on the Nifty Small Cap 250, that's down by about 0.3%. What's also not been performing well, and that's for quite a few trading sessions, is the INR. We've continued to see the rupee hit consistent lows in course of trade almost for 5 straight sessions now. So for more on what to expect from the rupee going forward, I'm joined by KN Day, managing partner at United Financial Consultants. He joins us on the phone line. Mr. Day, thank you so much for taking time out for us.
Hi, good afternoon.
Mr. Day, I hope I'm audible to you.
Yeah, very well. Go ahead.
Okay, perfect. So, while we're seeing the rupee underperform, we broadly understand it's because of a strengthening dollar. We've seen the dollar index rise to 4-month lows. Consequently, most currencies, including emerging market currencies and the rupee, continue to weaken. That bias appears like it will continue for the next few sessions. I do want to understand what's the outlook going forward, and how long do you sort of see this trend panning out?
Hi. I think you rightly said that the episode of yesterday's Mr. Trump coming back to power on 28th of January has made the dollar index go up by almost 2% in one session, which had last happened somewhere in 2016 when the Brexit fell apart. So yesterday's and today's, when the rupee has breached to a new time low of 84.37, I think slowly as we go ahead, this thing may fade off a little bit. We may not see the run on the rupee to continue until unless there is some episode on the Iran-Israel side. Hopefully it can happen. Otherwise, I think the short run of the rupee to 37 or maybe towards 40 temporarily is capped. Thankfully, with Reserve Bank of India intervening at major levels to sustain any unwanted volatility in the market. As you said about the emerging markets, in last 4 or 5 working days of major emerging markets, the rupee has fallen only 0.33% from November 1st, whereas the CNY has fallen almost 0.87%. African rand has fallen 1%. If you go to other currency like Thailand, Thailand baht has fallen 1.75%. Korean won 2%. Indonesia rupiah more than 1%. These are all currencies which have fallen in last 3 or 4 days of trading, whereas rupee has only fallen 0.33% since 1st of November. So I think we are mostly controlled. As of now, it looks moreover under control. Maybe if after Mr. Trump takes over and if he starts imposing the what you call as the tariff war, that time again we could see some fall in the rupee. But as far as the dollar index and the U.S. elections are concerned, it's being taken inside. Maybe today's FOMC 25 basis rate hike is already being discounted. We may not see much fall from here. But yes, going ahead, we don't know what happens in the Middle East war. That could again give the spike on the rupee.
Right, we're already seeing some sorts of respite, in fact, on the rupee as well as on the dollar index. But, you did touch upon the currency wars that we might see in the months going ahead. I'm curious to understand in terms of the rupee as well, and more importantly, in case of several other global currencies, including the Chinese one. At this point, would it be sort of fair to say that FX wars will be the greatest asset class risk unfolding in the months to come?
Absolutely perfect. I think going forward, we will see more increasing volatility, especially when the new president comes in and hopefully doesn't speak much between today and the date he takes over on 20th of January. He has already said in his speech about the tariffs to be imposed in European countries, plus, of course, the major tariff in China. And once you saw about 8 years back when he imposed tariffs on Chinese imports, the Chinese currency is depreciated from 6.79 to around 7.2, 7.1. Similarly, if such tariff starts coming in, we will definitely see some tariff falling on impact on emerging market currencies. Though India may not be directly linked to the tariff concerns, but when other currencies fall, at least some part of that rupee will also have to be adjusted so that our exports exports would remain more competitive.
All right, I do have one last quick question before we can let you go. Given that there are a whole host of factors, that are sort of pushing and pulling onto the rupee, and while a lot of these factors, are still about to unfold, in the medium term, what is the range that we can expect on the rupee?
This is the most toughest question because to give a range on the rupee when we are sitting on a lifetime low today. As I said, maybe till January end we could see. I'm not seeing much fall. Hopefully there is no. Again, I keep my fingers crossed on the Middle East escalation. If that remains static and nothing will happen, I think 84.37 or 84.50 could be the topish. for the next up to say Jan end. Because again, also one thing I didn't mention is this going forward. Maybe by November end or December first week, we would see a lot of FIIs outflows on balance sheet management, which will also come into place, which will add some pressure on the rupee. So having said that, I see in the next 1 or 2 months, maybe rupee should be in the range of 84.08 to 84.45.50. And after 28th January, it's too difficult to say. At that point of time, we will see what happens. But as of now, 84.810 to 84.50 looks to be the range till 20th of January.
All right. Thank you so much, Mr. Dave, for taking time out to speak to us. Well, it's a whole host of factors at play in terms of the rupee. We're going to watch how the action unfolds in terms of the rupee as well as global currencies. But for now, let's move on to the latest updates coming in on Jet Airways. The Supreme Court has ordered Jet Airways into liquidation after finding that the winning bidder for the airline, the Jalan Kalrok Consortium, failed to implement its bankruptcy resolution plan. My colleague Varun brings us more details on this. Varun.
That's right. Hi, thanks. So yeah, in a big ruling in the aviation sector, the Supreme Court has used its extraordinary powers to order the liquidation of Jet Airways. Now, the top court made it clear that the Jalan Kalrok Consortium, which was the successful resolution applicant for the Jet Airways, failed to implement its resolution plan as per the terms mentioned in it, and said that since the resolution plan is incapable of implementation now, the court said that at least the avenue of liquidation must stay alive. The court flagged off the sanctity of timelines prescribed under the Insolvency and Bankruptcy Code of India and said that nearly 5 years have passed since the company was admitted into insolvency. However, no major inroads were made for the implementation of the plan by the consortium. As a result, the court has set aside the NCLAT order, which gave a go-ahead for Jet's transfer of ownership to the consortium, and said that the order was in flagrant violation of an earlier order of the top court. With this, the appeal by the State Bank of India, which was the primary lender in this case, has succeeded, and the NCLAT order, the amount of rupees 200 crore deposited by the Jalan Kalrok Consortium stands forfeited. Now, the liquidation process will now be taken over by the Mumbai bench of the NCLT, who will appoint a liquidator for the process.
All right, thanks a lot for that, Varun. We'll continue to bring more updates on that, but let's move on to some more stock-specific action. Now, Hindalco is the top loser in percentage terms on the Nifty 50. The stock has already cracked about 8% in today's day of trade, and that's after the US arm Novelis offered weak cues in the second quarter. For more details on that, let's get in my colleague Mihika. Mihika.
Two main reasons. So, and this is all related to its international subsidiary called Novelis. Now, Novelis reported its Q2 FY25 earnings, while net sales were up 5% year on year. Their adjusted EBITDA was down 5% to $462 million, and net profit was actually down 18% at $128 million versus $57 million a year ago. What impacted profits is a charge of $61 million due to the production interruptions of Sierre plant, and this was due to flooding in the area, and the impact of this shutdown will continue to the end of 2024 is what the company has said. Another factors that impacted the earnings were higher restructuring and impairment expenses as well as lower operating performance. And the one that stands out in terms of the commentary that the company has given is they've suspended their near-term margin guidance, and this is related to adjusted EBITDA per ton guidance, and they're going to wait until further clarity on metal markets, and they expect margins to contract sequentially in the second half of FY25, and this impacts Hindalco Industries as well as their overall growth for the second half of the year. Why has the guidance been suspended? Because of higher aluminum scrap prices, which have been rising due to intense competition on the back of China's policies, and Novelis products, around 60% of their content is from recycled content, and that's why their input costs will gain. And when you talk about why Novelis is important for Hindalco Industries, which is what we're seeing reacting today, well, Novelis accounted for 61% of Hindalco's consolidated FY24 revenues and it also accounted for around 56%, which is more than half of Hindalco's EBITDA in FY24 as well.
All right, thanks a lot for those insights, Mihika. Let's move on to an NDTV Profit exclusive. Sources say that gas ramp-up from ONGC's KG block may see more delays. Vishwanath joins us on the phone line. Vishy, what are you gathering from your sources? All right, I apologize for that. We have my colleague Vikas who joins us with more details on this exclusive. Vikas.
The thing is that this KG block was one of the largest discoveries by ONGC in the recent time, and it was launched by much fanfare in 2018. But since then, the ramp up that was expected in gas production, as of now, they are only producing 1.5 mmscmd. And this was expected to reach its peak capacity of 10 mmscmd by 2024. But because of various challenges that the company faced as far as supply issues were concerned for supply of their rigs or platforms, the company has not managed to get it from their Malaysian vendors. They were the bidders who got the contract for supplying the platform, but that has not received by ONGC yet, and this is likely to come only by March, April next year. So the company was expecting to reach at least 5 mmscmd by May this year. Now that 5 mmscmd will happen in May, June next year, and the company is hopeful of reaching 10 mmscmd only by December 2025. When we tried to reach the company spokesperson, they did not comment on the story as of now, but they told me that they will be giving their comments later during the day. So we'll be waiting for that. As far as this block is concerned, this block is having a reserve of 2 trillion cubic feet of gas, and once it produces at 10 mmscmd, it will contribute almost 7% of India's total requirement of gas consumption. India's total gas consumption is close to 187 mmscmd per year, and almost 53% of that was imported from abroad. So once this comes to peak production and also Reliance's contribution from nearby fields, India is likely to keep its imports to 45% in coming years. At least for next 2-3 years before the demand increases, India is likely to keep the imports at 45%. So this is likely to be a very good discovery, and once it comes to production, it will add to both the companies and India's overall requirements.
All right, thanks a lot for that, Vikas. Now, another stock that's in focus is Apollo Hospitals, and for all the right reasons. The stock is up almost 6.5% currently, which makes it the best performing stock on the Nifty 50, especially on a day when we're seeing most stocks in the red. This is largely on the back of a good set of numbers, and my colleague Varsha joins us to tell us more about it. Varsha.
So good show when it comes to Apollo Hospital numbers. Now let's see what led to these good numbers or fantastic numbers. If you see that healthcare services, which forms the major part of the revenue, grew over 14%. EBITDA growth was again 14%, and PAT growth was 16%, and the margins were 25%. Now there was good volume growth also. So they had a strong volume growth of 8% in healthcare, and they are continuing to see this volume growth going ahead. And the average revenue per occupied bed at Metro Hospital was 20% higher. Now when it comes to Apollo Healthco, this is the star for Apollo Hospital as a whole, wherein if you see the performance, revenue grew almost 17% year on year, and there was an EBITDA, they turned out to be an EBITDA positive of 52 crore versus loss of 38 crore last year. Margins were 2.2%, and PAT stood at 19 crore versus loss of 67 crore. So good show when it comes to Apollo Healthco. Overall occupancy for hospital, if I were to say, was 73% versus 68% last year. And Apollo Health and Lifestyle also, there also if you see, revenue grew 14%, EBITDA grew 30%, and there was a PAT loss of 4 crore versus loss of 13 crore last year. Now when it comes to expansion plans, they plan to set up 500-bed hospital in Worli, and their subsidiary aims to expand Lucknow facility from 300 beds to 500 beds. Total estimated project cost is at 6,100 crore, and over 1,700 crore has already been spent on land acquisition, security deposits and project development, and remaining 4,400 crore to be funded over the next 3 to 4 years through external funds and internal accruals.
All right, thanks a lot for that, Varsha. Moving on, MSCI's November rejig is in focus. The global index provider has added 5 Indian stocks in the November review. That will come into effect from the close of November 25th. Harsh joins us with the details. Harsh, walk us through these new additions.
2 weeks, $2.5 billion of flows likely expected into India, clear positive. You are seeing now the India composition of the emerging market index of MSCI at 19.8% versus 19.3% during the last rejig. So clearly positive in terms of trend as well. 27% is where China is at. And therefore, what Nuvama seems to highlight is that there is plenty of bandwidth more for more inclusions into the MSCI in coming months, years as well, and therefore positive India. In terms of specific inclusions, let's talk about some stocks. Small cap to mid cap change in terms of stocks. Kalyan Jewellers moves to mid cap, Voltus and BSE. All these three move from small cap to mid cap on the MSCI. Now in terms of new inclusions within the mid cap, you have Oberoi Realty and Alchem Labs, two new additions. You also have additions to the large cap, Shriram Finance, TVS Motors, CG Power, the three additions. You can see stock reactions as well on your screen. 9 additions on the MSCI India Domestic Index. You have Voltus, BSE, Prestige, followed by Kalyan, JSW Energy, Oberoi Realty, Alchem, Jindal Stainless and Oracle. You also have additions to the India Domestic Large Cap. Apart from the three originals, Shriram Finance, TVS Motors and CG Power, we also have Havells, Torrent Pharma and JSW Energy, which makes the cut on this one. You're seeing MSCI Global Index tweak weights, and a weight has been increased for HDFC Bank. 6.4 times the flows in terms of average daily volume to come into HDFC Bank. You have JSW Energy 2.7 times average daily volume to come in. Samvardhana Motherson 1.4 times, APL Apollo Tubes 1.3 times, and then you have PB Fintech and Tata Power 0.6 to 0.9 times average daily volume to come through from passive flows. Based on new inclusions, 5 stocks, and this is key: Alchem, Voltus, Oberoi, Kalyan Jewellers and BSE. In terms of weightage coming up on your screen, you'll see sharp amounts of flows going to come into Alchem and Voltus as well as Oberoi. Kalyan Jewellers also to see good flows coming through. You're going to also see fresh inclusions within the small cap, something like a Eureka Forbes, DCM Shriram and JSW Holdings, to see marked inflows. And you're also going to see flows on the Global Standard Index small cap. Rolex Rings, ZF Commercial Vehicles and KPR Mills are the new inclusions which are expected to see decent flows.
All right, thanks a lot for those updates, Harsh. But taking a step back from the markets, post-Diwali destruction in Delhi NCR continues, with air quality getting toxic. The pollution levels rose sharply in many places in the capital and its neighboring cities, with air quality still being in the very poor and severe categories. According to the Central Pollution Control Board data, Delhi's air quality index was recorded at 366 as of today morning. My colleague Anushka Gad brings us more details from the ground.
It is that time of year in Delhi NCR where people are left gasping for fresh air. Now, from several consecutive days, the AQI in Delhi has been recorded in very poor category. If we talk about today, the AQI has been recorded 366. That comes under the higher end of very poor category. Now, according to the IMD, the meteorological conditions are likely to be unfavorable till 12th of November, where wind speed will likely to be very slow. And also what we can see and what the IMD is predicting is that the fog-like situation can be seen till 12th of November. Now, post-Diwali, the AQI has remained in very poor category. That is raising a serious health problem for the people who are living in Delhi NCR. According to a new report from the CAC, it is being stated that the highest contributor in the air pollution in Delhi is the vehicular pollution. Because of that, the AQI in Delhi is likely to be deteriorating further also. And what the CAC has said is that year-round steps should be taken to put this air quality situation in control. Now the Delhi government had taken and introduced 21 focus point initiatives to tackle and mitigate the air pollution. But what we are seeing from ground is that all of those measures are failing because the AQI is not improving any further. And what we are seeing in the upcoming days, and as per the predictions of IMD also, is that the AQI, because of the meteorological factors, also will stay in the very severe category. And if the wind speeds get any slower, it is likely to reach the severe category as well. Now the local local factors are the ones which are contributing largely to the AQI and to the pollution that is being seen in Delhi in the winter season, and because of the meteorological reasons also, this is what people are facing. Severe health hazards can also be seen, respiratory problems that people are facing who are living in Delhi NCR. Now for people also, it is very important that they stay inside of their house. If there is no important work they have to attend to, and if they are going outside, if they use public transport, they can contribute a little to improve the air quality further.
All right, thanks a lot for that update, Anushka. But from some grim news to some good news, in this case for the startup community. A brand new startup accelerator program called Texpedite by Games 24/7 was recently launched in Bengaluru. Have a look at a special report.
Bengaluru was host to the launch roadshow event of Texpedite, a brand new startup accelerator program organized by Games 24/7, a tech company in the business of online gaming. The goal of this program is to provide support in terms of mentorship, networks, funds and infrastructure to budding Indian startups in the fields of artificial intelligence, gaming and inclusive and assistive technology. The program was endorsed by Shri Priyank Kharge, member of the Karnataka Legislative Assembly and Honorable Minister for Information Technology and Biotechnology.
This launch marks an important milestone in fostering innovation and technology advancement, and I'm thrilled to see Games 24/7's unwavering commitment to India's startup ecosystem.
Highlights of the launch included knowledge transfer and mentorship happening via the fireside chats and discussion panels held.
Technology being the front and center of everything that we're doing is what really gave rise to our thinking that, hey, yes, we're operating in the gaming space, but we're really building technology solutions, and therefore, why can't we use everything that we have learned to give back to the community?
Texpedite is a 60-day accelerator program, and the goal is to turn ideas that show promise into thriving and sustainable businesses.
The startups have the potential to really take the India story and transforming it, and also positioning India as a global leader in innovation.
With startups, business leaders, investors, VCs, policymakers and other influential industry players bringing energy and vision, discussions around innovations in digital India's expanding startup ecosystem were highly promising and full of potential.
I look at AI as a challenge and an opportunity in India, because a lot of India-centric problems which AI can help solve. For example, health.
We are a large country with unique problems, and we have the opportunity to find those solutions and then export them abroad.
If you are a startup, this could be the ideal platform to launch your journey and propel your ideas to new heights. Selected startups can avail exciting benefits like over 500K in tech credits, participation in a demo day, fundraising opportunities, and access to a powerful network of industry leaders. So if you're a startup in the AI, gaming, or inclusive tech domain, this could be the perfect launchpad for you to turn your vision into reality. Keep watching the NDTV network to find out about developments from Texpedite.
Right, and that's all we have on the show for now, but do stay tuned to NDTV Profit for more news and updates. Thank you for watching.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah and with me is Alex Matthew, and we are going to be talking about something that we believe is a development which should be observed. And then we'll of course try and talk about re-evaluation of your mutual fund portfolios annually, and what are the factors that you should keep in mind, or rather how is it that you should go about and re-evaluate your your portfolio annually to try and ensure that your returns are above par. But before that, Alex, a very important thing that you spotted this morning, I'm glad we spoke about it, and we are waiting for Mahindra & Mahindra to come in, so we'll cut to it as soon as the management starts speaking. Fabulous set of numbers. But Alex, what have you observed in terms of an announcement or a development that has just happened on from SEBI?
Yeah, you spotted it is right, because it's not very apparent on the face of it. There was a consultation paper that was issued overnight by the Securities and Exchange Board of India, and this was in fact related to skin in the game rules of mutual funds, which talked about the investments that should be made by employees of mutual funds. And there were certain suggestions that were made, but right at the end of that document, there was one suggestion that was made as part of this consultation paper, and it said that we should consider extending the stress test rules beyond just the mid-cap and the small-cap space. Of course, stress tests are being conducted for all of these schemes, but they aren't released to the public. So you only have access as an investor into these mutual fund schemes to the stress tests that are conducted for mid-cap and small-cap. What the SEBI is now suggesting is that you should release the results for all of the other categories as well. Now, Neeraj, the context is important to understand here. Because if you remember, in March was when the rules came into play for mid-cap and small-cap. In the run-up to that, you had humongous inflows into mid-cap and small-cap, and the regulator finally stepped in and said, perhaps we're a little concerned about the fact that a lot of these schemes are getting a lot of money. Maybe they're not allocating the most liquid counters, so there could be an issue going down the line. The interesting part is, and it was not mentioned anywhere in that consultation paper, but the interesting part is that a similar situation has emerged for sectoral and thematic funds. And if you point out the numbers, you've spoken to our viewers on the Mutual Fund Show, but just to put some of those numbers out there in case you've missed some of them, right? You have the category which has got the largest equity schemes with an inflow of 13,254 crore just in September. But since April of 2023, the industry as a whole has launched 68 new funds in the sectoral and thematic category, and that accounts for about 60% of the overall number of schemes launched in the industry. And what's more, retail investors' net flows into this sectoral and thematic space since April of 2023 has been to the extent of 1.42 lakh crore. As a result of which, for the last 3 months, it is now the single largest actively managed category, with assets under management at the end of September of as much as 4.67 lakh crore rupees. This is important, Neeraj, I think, because just like you have the small cap funds which were investing now in 150, 200, 203 stocks, with some of the smaller ones not as liquid, sectoral funds, and I was looking at one in particular, the top two have 19.5% of AUM and 17.8 or 17.9% of AUM in just two stocks. And that's a problem.
Yeah, it is a problem. And maybe, Alex, while we wait for Mahindra and Mahindra, let's try and pose those questions to our guests as well.
Yeah.
So Rohin Pakdiwala, founder of Pakdiwala Investments, joins us, as does Karthik Javeri, director of Transcend Capital. Both of you, thank you so much for joining in. And Rohin, let me start this conversation with you. We'll of course talk about reevaluating the portfolio in a moment, but something that Alex was just talking about, the caution signs or the overtures or the direct actions done by SEBI to try and ensure that right practices are followed. And what do you make of what Alex has just mentioned? We don't have concrete information of what it is intended for, but it seemingly is a shot against thematic funds, or not against thematic funds, but meant for thematic funds or sectoral funds. Rohin, your thoughts?
Firstly, thanks, Neeraj, for having me on the show again. I think it's a welcome move from my perspective as a distributor. I think any kind of enhanced transparency will be welcome. I think it's good to have a sense of how liquid the portfolio is, and therefore, if investors need to, in a situation where there's let's say, panic run on some of the funds or panic exits, then it's good to know how liquid those funds are. I'm not sure if it's let's say the target is thematic funds or the funds that have accumulated money, because some of those products are justified products. They are new innovations, and I think those are relevant in the times that we are. But I think in overall, I'm happy with the move. If we can disclose this in the fact sheets of the respective mutual fund schemes, and I think it's a good way for both investors and distributors to judge the liquidity of the product.
Okay, Karthik, I'm just curious, how much attention have you been paying over the last few months to the stress test results? Because in the first one that came out, there was a lot of excitement, everybody paid attention to it. I guess to a certain extent, less attention has been paid, and that might just be charitable to say. So how much attention are you paying to this?
Because here we have the assumption that the fund manager is doing his bit and they are making sure that they have enough.
Karthik, you'll have to allow me to cut you in out here. Sorry, but Anish Shah of Mahindra & Mahindra is speaking, so we'll need to cut across to that for a moment.
The right thing to grow the business the right way. And yes, in some quarters we may see low disbursements, but that's part of how we will grow this business. We're looking at expansion into the mortgage business to help our diversification agenda, which is one that we've talked about in the past as well. And again, you see a healthy profit growth here at the Mahindra Finance. Tech Mahindra, mixed demand outlook, overall positive, but there are some areas where industry demand is a little muted. BFSI deals have been a good win for TechM, focus on margins as I talked about, and here again, as I talked about earlier, profits up 2.5 times. A little deeper dive into our growth gems, logistics. We're starting to see some uptick in volume across the industry, and that's starting to help the logistics business. Cost efficiency initiatives are underway, and fully integrating the Rivigo acquisition for Express, which has been a drag in the past, but we're starting to see things turn around there well also. So you see revenue up 11%, EBITDA is up 40 basis points there. On hospitality, business is doing well. occupancy is at 77% flat versus last year, but this is despite a higher room inventory. The average unit realization is up, and we are seeing some softness in Europe for the holiday club business that we have. But overall business is on a good track. Real estate is actually on a very solid track. We are starting to see significant growth there, both in terms of profitability as well as land acquisition, which is something that will drive future growth for that business, and a healthy pipeline in our industrial cities as well. And with some of the recent government announcements, that opens up a new vista of growth for this business. So I'll end by saying we continue to deliver on our commitments. ROE stays above 18%. EPS growth continues to be strong. As we look at it from F22, which we had promised, it's 40% compounded annual growth since then. And let me then hand it over to Rajesh to have him talk about what are some of the key things that have driven this performance. Rajesh, over to you.
Hi, good afternoon, everyone. Let me just build a little bit on how the farm business is done and talk about that to begin with. We've seen that the volume has gone up 4% and exports have gone up 27% for Q2. The good story here is the gain in market share, which we've seen consistently, and you'll see that on the next chart as well. This has been our highest ever Q2 market share, but that's got followed up with a very strong October market share as well in tractors, where we've got to a market share of 44.5%, taking our cumulative for the year up to 40.
And Mahindra, of course, and you'll hear from the management tomorrow at about 9:40. So you may want to tune in for that. But I had to cut across Karthik talking about how much attention is being paid to the stress test. Karthik, quick thoughts here before we move on to the topic for the day.
Yes, Nikunj, thanks. So I think, when the stress test initial circular came out, I'm sure all the mutual fund managers would have started preparing for expecting this thing all across the board. So as a distributor of financial products, should you be so much worried? Not really, because obviously the mutual fund companies and the managers are taking their job very, very seriously. And what we've seen of late is even categories like small cap and mid caps, the percentage of authentic small cap has reduced and the mid cap and the large caps have gone up also because of inclusion, but plus with the market appreciation, capitalizations have gone up, right? So from all these point of view, there is enough liquidity, and I think fund managers are very, very confident that from small caps and mid caps and all, they can really exit. It's nice to have this diktat across all other funds. But the only area of surprise or, might be interesting to know would be sectoral funds. Now, obviously, there's a lot of concentration of investor money there. But in the last 1 year, with the sectors picking up, especially the public sector and all of that, I think there's a lot of money flowing down that side as well. Investor interest is very high. So it would be nice to know the stress test results. And as long as you can come out of it in 2-3 days, there shouldn't be another, Templeton scenario repeating ever.
Got it. Okay. Now, let's try and get to the topic at hand. And Rohin, very important, we were talking about this briefly yesterday, about the need and the ability of a DIY investor, let's say, or any investor, even if has an advisor, but to do the thing herself or himself, which is analyze the portfolio, maybe once per annum, and try and take suitable adjustments to the portfolio to ensure optimal performance. Now, please tell us, Rohin, how do you do it for your personal portfolio? What are the things to keep in mind? And how do you judge what factor is telling you to make changes?
Sure. So I think the prime consideration here is what's your original plan, right? When you build a portfolio, I'm assuming the most DIY investors will have some plan that they have in mind. Whether those are concretely defined, mathematically done, or even if they're generally, most people may have some sense. So for example, somebody has to save for a down payment for a house. Somebody else wants to just simply build wealth. Somebody else is retiring in a few years. So whatever that plan is, the first step, I think, is to review the outcomes of your portfolio against that plan, right? So let's say somebody's looking for early retirement and has a certain corpus in mind. If given the way markets have performed, if the portfolio is already, let's say, ahead of that plan, then maybe a course of action is to rebalance and reduce the risk in your portfolio. So because you're already ahead of the plan. Okay, that's just giving you an example, but there are several such cases. So first step, look at your plan. How are you doing against it? Second step, again, an offshoot of the plan that you originally had, is look at your asset allocation, right? So let's say in my case, I typically have had a 70-75% equity allocation, and the rest is in fixed income and gold, right? Is the asset allocation of the investor same as what was originally conceived? If not, is there, let's say, in general, most people, let's say if they've started with some equity allocation, that equity allocation would have increased because of simple growth in valuations and the market growth. So maybe there's time for them to reduce the equity allocation. So come back to what was your original asset allocation plan or model that you had in mind. Third step, maybe look at performance of the funds. Sorry, not maybe. This is a necessary step. Look at the performance of the funds. There will be cases where some funds in any portfolio will underperform. That does not mean you churn them out or you exit them. But if there's consistent underperformance, and consistent underperformance could be maybe 6-8 quarters of continuous bottom half performance, then maybe it's time for you to review those funds and maybe even consider exiting them. Right? In case investors have, let's say, thematic funds in their portfolio, and several investors and I get a lot of queries from investors for thematic funds, while we generally tend to reduce the exposure to thematic funds. In case you do have exposure, let's say somebody's got exposure to, let's say, energy as a sector or mining as a sector, and if those sectors have already run up, then maybe it's time for you to review the valuations and then consider an exit from that sector as well. So like this, there are several steps that one needs to take methodically and look at rebalancing the portfolio. And another way is to even go drill deep down and look at category-wise allocation. So let's say large cap, small cap, mid cap exposure. Again, if your plan was, let's say, have 20% in small caps, if that's now gone to, let's say, 30% by simple market growth, then it's time to maybe reduce and come back to the 20% or even go below, because valuations are already very high.
Yeah, point well taken. Karthik, how do you go about doing this for yourself, for your family, or maybe key clients?
Rohin's covered most of the points. We focus on performance. So within the equity portion of the portfolio, within that, there will be large caps and there will be mid caps and small caps, right? So within each of those categories, yes, we would like to do an annual check as to the fund that we are invested in. Is it part of the top 10, top 15, or is it really lagging behind and it's in the, the bottom 5 or the bottom 10? Now, sometimes we know rankings have changed. One of the key things that I show a lot of investors when I'm talking to them about investing is I show them my own holding days. Then my holding days are 4,300, 5,600. So if I have held a fund for 12 years and 15 years, there's obviously no reason for even you to switch around or do something which is going to, adversely affect your financial plan and your goals, etc. So a lot of times funds do go up and down, but there is not so much of an intense pressure to change it. I have been very successful, still having a CAGR of about 18, 19, 21% as we speak today, in a little bit of a down market. A few days back, it was even higher. And these CAGRs have been going on for the last 10, 12, 15 years, 18 years that I've been investing. So that's happening on personal portfolios, happening on a lot of client portfolios. So yes, you do a check within subsectors. The other thing sometimes we even discuss and we should talk about this thing to clients is, it's easy to identify some sort of pitfalls if you see consistent down performance for multiple quarters, like 3-4 quarters. And sometimes you can even get early signs. If you can do a little bit of chart reading on technicals, then you can see that there are clearly trend breaks happening, clearly a reversal happening, and you are seeing that this is happening for a few weeks. It's only then you decide to say that, well, the rally in this sector is now over. But that's only for sectors. Broad-based, the India growth story, everything being intact, everything going fine, you can completely depend on fundamental attributes, your advanced tax collections, your GST collections, GDP growth. You can look at all of that and, decide the direction of the markets, and you will have 10, 12, 15% bumps on the way. But other than that, you're good as long as you're in the top 10. Even top 20 for that matter is not a problem. If the difference between the topmost and the 20th one is not more than 2 or 3 percentage points. There will be outliers. We have seen that happening, but exclude the outliers. If broadly your funds are within the range of 2 or 3% and top 20, I think you are good and you can continue. So try and not switch around too much because it adds a little bit of stress also to your life and to everybody else. Plus you have to pay tax now. Remember, everything is taxable. Nothing is tax-free anymore. So that's the other major consideration. You can postpone as much as you can.
Okay, interestingly, and just okay, before I get to queries though, and this is a good enough answer, thanks both of you, but Rohin, interestingly, you mentioned, and did I get that right, that you're saying that book a minimum of, what, 1 lakh rupees worth of investments every year. Did I read that correct? Why is that the case?
Yeah, because it's equity MFs, there's 1 lakh tax-free capital gains every year, right? So I think it makes sense, and with the assumption here is that the government will continue to increase capital gains tax every year. We've seen that happen last year from 10% to 12.5%. So I think it makes sense to book at least 1 lakh capital gains tax in your investment portfolio every year without fail. If you've got some losses elsewhere, then obviously you offset those losses with some gains in some other part of your investment portfolio. But yes, I would say that must book at least 1 lakh capital gains.
Purely from a taxation perspective as well. But
purely from taxation perspective.
And viewers, in some sense, not bad advice. And this is, of course, presuming that your mutual fund portfolio is substantially higher than that number that Rohin is talking about. So bear that in mind. If you've just started off, if your portfolio is small, fledgling, 50,000, 70,000, 80,000, then be careful of those numbers. But by and large, it should serve as a bit of a yardstick. Okay, I have time for some queries, so I'm going to take that because a lot of people write to us that it would be great to get in some queries responded to. So the query number 1, and Karthik, I'll start with you on this one, is coming in from Sumit. Sumit is aged 31 years. Sumit says that he's investing 50,000 rupees per month through SIPs with a horizon of 14 to 15 years. Corpus target is 3 crore. And he's requesting for a review of the portfolio. The portfolio has an SIP in ICICI Nifty Alpha Low Volatility Fund, about 8,000 odd bucks. Edelweiss Mid Cap, about 10,000 odd rupees. Invesco India Small Cap, about 8,000 odd rupees. And Kotak Multi Cap, 14,000, as well as Trust MF Flexi Cap to the tune of about 10,000. Well, fair degree of broader market participation. But Karthik, would you want to review this?
So, a couple of things I'd like to tell Sumit. Firstly, 3 crores is very easy. That will happen. That I don't think is a problem. And because he's got 14, 15 years in hand, he's investing at the rate of 6 lakhs a year, 50,000 SIP a month. Absolutely fine. That's not a problem. That should go through well. The other thing is that he's got a lot of flexi cap, multi cap going. And now flexi cap, multi cap also, the point to understand is they have large cap, they have mid cap, they have small caps. And where is the growth going to happen? The growth is obviously going to happen in the stock number 201 to stock number 600 of the market, which essentially is your mid cap and small cap. So if you are going to be too much into low volatility of 8,000 and multi cap of 14, that's 22, and another 10, 32,000, 60% of your investments, and within that about half of it being in large caps, there's a lot of money in large caps. So large caps are like good, beautiful fixed deposits, which earn about 12 to 15%, but they don't give you the kind of growth which is a life-changing growth. That will happen only through mid-cap and small-cap funds. And new companies will keep entering mid-caps. New companies will keep entering the small-cap space. So I don't think you need to worry about that. Trust the professional judgment of the managers. And I think you need to have at least about 30 to 35% of your portfolio into small and another 35 into mid, and then the remaining 40 into large. I mean, that's talking about the 100 rupees of your money that is going into equity mutual funds. So that split, if you do it in this fashion, you might be far better off and your wealth will look much better. And instead of 3, you might land up with 4 or 5 crores also.
Okay. So that's the first piece of advice. I'll move on to the second query because we only have that much time. So Rohin, I'll come to you on this. Amit Bhandare, age 38 years. Again, a review of a portfolio and advise if he should add a small cap fund for 7-8 years or opt for a thematic fund instead, because the portfolio has, an SIP in ICICI Value Discovery, Parag Parikh Financial or Flexi Cap, and Quant Active, as well as Edelweiss Mid Cap and UTI Nifty. also a quant absolute. So about 6 odd funds. Rohin, slightly difficult, but if you were able to understand me, could you review this and answer the question?
Sure. Yeah. So, yes, I think to answer his question very directly, yes, he should add a small cap fund. I would prefer a small cap over a thematic, simply because small caps diversified. Thematic might be more targeted. So over a period of 7 to 8 years, I think a small cap fund would be better off. I think he can add Nippon small cap to the portfolio. Or quant small cap, but quant, since he already has 2 funds from the same AMC, I would suggest Nippon small cap. I would also suggest that if he was open to maybe relook at the value discovery fund. I'm personally not a big fan of value funds, simply because they give performance. They give very cyclical performance, like they have done in the last 3-4 years. But but growth funds are generally what I'd prefer. So yeah, so 2 suggestions: add a Nippon small cap and maybe rethink of the value discovery.
Okay, well, as pointed as it can be, and I hope that helped you. The final query, and that is coming in from Nitin, age 24 years. Is it the right time to make lump sum investment in a flexi cap fund, given the current market conditions? It's a question that I can ask both of you a minute each. Karthik, I'll start with you first.
See, it's never a good idea to do a lump sum investment, because you don't want to enter with all your money on a particular day. You always want to split it. Now, if you're aggressive, then you split it into maybe 5 or 6 little slices. If you're a little more conservative, then switch it into 12 slices. So you can, if it's a larger quantum of money, come into a debt fund, go through an STP route and do it. If you want to be aggressive, come into a debt fund, do an STP, a weekly STP kind of a thing, and move it to the equity fund. But all said and done, don't put it in lump sum unless you are 100% sure of what you're doing and you don't mind seeing a 15-20% drawdown. It may not happen, but it's always nice to be ready. You see a 20% drawdown happening, then you will be in a better position to enjoy the 200% upside when it happens. So that's the key point to remember. Go easy based on your level of aggression, or go a little slow, go moderate, go over 6 months. Very, very simple.
Mm-hmm. Okay, Rohin, your answer differs.
Yes, slightly. I think given that there's been a maybe 7-10% correction already, I think lump sum might be okay to do. Flexi cap, especially since he wants to do it in flexi cap funds. This is a slightly aggressive take, assuming that he's going to hold the money for a long time.
Okay, so if you are indeed an aggressive investor, maybe you go ahead with Rohin's thought, though. As Karthik said, that if you're aggressive, you can still have a smaller burst of SIPs just in order to spread it out. So depending on what advice you like, I think both options could be on the table. In the long run, it may not really matter too much, to be very honest. A little bit, yes, but not too much. So bear that in mind. But gentlemen, both of you, thank you so much for taking the time out and being with us. And to you and yours, wishing you a fabulous new Samvat. But that's all the time that we have on this leg of the Mutual Fund Show. Viewers, thanks so much for tuning in.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit.
Hello and welcome. You are watching Latch Trades. I am Agam Vakil, and in this show we take you through all the stocks that are buzzing in trade on account of bulk deals, block deals and volumes. But before that, we take a look at how markets are faring at this point in time, and we are looking at a little bit of weakness returning to markets given the Nifty is currently under pressure. That is in fact down by as much as 1%, and we have the Bank Nifty also declining by nearly as much. What about the broader markets? Are they moving in tandem with the benchmarks? The mid-cap index is actually marginally in the red. So outperformance, relative outperformance is the same for the small cap index. It does seem like at the moment we have the large caps which are under a little bit more pressure as compared to many of these broader market indices. But moving on to the key contributors, coming down to the Nifty, again, that's where we are looking at, ICICI Bank providing the bulk of the declines coming through. And then, of course, we have Reliance Industries, Trent, as well as Hindalco, largely weighing down on the benchmarks. Trent is the one where, of course, along with Hindalco, are two of the biggest losers on the Nifty 50 today. And on the other hand, to counter whatever it can with its relatively smaller weight, Apollo Hospitals advancing and being the top gainer on the index today. But all in all, it's certainly another day of trade where we are seeing continued weakness. In general, let's also take a look at your big movers when it comes to the broader markets. What we do tend to see here is that because of the fact that there has been a 0.3% advance, or rather 0.3% decline for the broader markets, and you do have names like KIOCL, which is advancing. Swan Energy up around 11%, ITI as well as KC International, all of them advancing by around 7%. Apollo Hospitals, DCM, Shriram, among other companies which are looking up. And of course, what's weighing down in the indices is something like an Adani Energy, We've spoken about Hindalco and Trent, but Glenmark Pharma and Blue Star, among others, which aren't exactly doing there well. But that's as far as your broader markets are concerned. Let's put the spotlight on a handful of names that we want to address. Right at the top is the nifty top gainer of the day, Apollo Hospitals. We had the earnings come through overnight, and we now have Varsha to tell us about everything that we can take away from here, given why we are looking at such surge in not just price but also volumes in the share price. Varsha, good afternoon.
So good show when it comes to Apollo Hospital numbers. Now let's see what led to these good numbers or fantastic numbers. If you see that healthcare services, which forms the major part of the revenue, grew over 14%. EBITDA growth was again 14%, and PAT growth was 16%, and the margins were 25%. Now there was good volume growth also. So they had a strong volume growth of 8% in healthcare, and they are continuing to see this volume growth going ahead. And the average revenue per occupied bed at Metro Hospital was 20% higher. Now when it comes to Apollo Healthco, this is the star for Apollo Hospital as a whole, wherein if you see the performance, revenue grew almost 17% year on year, and there was a EBITDA, they turned out to be an EBITDA positive of 52 crore versus loss of 38 crore last year. Margins were 2.2%, and PAT stood at 19 crore versus loss of 67 crore. So good show when it comes to Apollo Healthco. Overall occupancy for hospital, if I were to say, was 73% versus 68% last year. And Apollo Health and Lifestyle also, there also if you see, revenue grew 14%, EBITDA grew 30%, and there was a PAT loss of 4 crore versus loss of 13 crore last year. Now when it comes to expansion plans, they plan to set up 500-bed hospital in Worli, and their subsidiary aims to expand Lucknow facility from 300 beds to 500 beds. Total estimated project cost is at 6,100 crore, and over 1,700 crore has already been spent on land acquisition, security deposits and project development, and remaining 4,400 crore to be funded over the next 3 to 4 years through external funds and internal accruals.
Varsha, thank you so much for getting us those updates on Apollo Hospitals. But moving on to, well, a breaking story, we have Shrimi who joins us to give us an exclusive on the direct tax review. Shrimi, good afternoon.
Good afternoon. Income tax review, which is undergoing and expected to, be presented in the upcoming February budget. What we are picking up from our sources that most of the provisions and sections before assessment year 2012-2013 could be declared redundant. These sections spread across major segments and sectors, including telecom, capital gains, and many more. In fact, these section could be removed completely from the IT Act. However, there are certain exemptions also which you could see in the review exercise of Income Tax Act, where they are saying that those section which is related to investments, related to searches, notices will continue, particularly the tax-free bond, the provisions which is related to tax-free bond will continue and will not be considered as redundant, is what we are getting sense from our tax sources. So government so far, the panel under V.K. Gupta, senior tax official, has asked for a report from all across the official. They have made 22 sub-panels which are going to submit their reports by month end, where they are going to suggest what all section will be removed, how those will be simplified, and that will be the part of the comprehensive review of Income Tax Act.
Amy, thank you for getting us all those details with respect to the direct tax review there. But we put the spotlight back on stocks, and the next one on our radar is Avalon Tech. We've had earnings coming through, and we now have Puneet with us to tell us about how the quarter's gone by and why we was looking at a sharp 19% up move here. Puneet.
Yeah, definitely. It's the results were decent, about 36% revenue growth, but the EBITDA as well as the profitability has grown more than 140% in this particular quarter. This is also the first quarter over the last 6 quarters that they have shown a really strong revenue growth. And for an EMS company, while that's not alien, for someone like an Avalon Tech, that has been one of the key concern points as well. So we did speak about margins growing by roughly 470 basis points in this particular quarter, coming at 10.9%. And the key highlights that include that they've built a strong order book, about 1,485 odd crores revenue. It's also the first company that has a manufacturing plant in the US. So revenue is coming from India is about 41%, while client service in the US is around 59%. They also have manufacturing of about 89% here in India localized, while the rest 11% is done at one of their plants in the USA. They also have a strong asset turnover over 8 times. But the segments that the company operates in is one of the most differential factors. There are like 5 key segments that they offer services in. The first one is, of course, clean energy, which are around 1/5 of the total revenues, while industrial segment has the highest revenue share of about 29%, which is also a very high margin business as well. The mobile and transportation business is another key aspect, 26% of revenue growth from this particular segment, while communication and medical is the other 2 verticals as well. Now, apart from the company's performance has been quite stellar in this particular quarter, but the last 6 quarters, as I mentioned, growth has largely been absent, and they actually reported a degrowth in revenue in FY24. So when you look at the 2 key differentiators for the stock is, of course, it's the only EMS company having a manufacturing plant outside India, and they are also not present in the low margin consumer business with the likes of Dixon, Keynes, and the others are. So while the revenue growth for the company is lower, around 36% versus 80% of that are Dixon, Keynes, or Amber, the profitability is much higher than those peers. And the other key factor is that because the earnings have not come over the last 6 quarters, the PE is around 100 times currently. But overall, if the outlook keeps continuing, the valuation should come more in a better range going forward. So overall, keep this small cap EMS company on track. Performance as well as commentary in management's con call at 3:30 today will be something to watch out for.
Absolutely. Well, Puneet, thank you so much for getting us all those updates on Avalon Technologies. As Puneet has already pointed out, it's a relatively smaller company, but the kind of numbers that we're seeing is staggering, and it does seem like it's near its 20% upper circuit mark. It's still away from it. 707 precisely is where it will hit its 20% upper circuit. But with that, we move on and talk about TeamLease. This one is also in focus on account of earnings, but towards the downside. We have Rucha joining us to give us more details. Rucha.
Thanks, Agam. So TeamLease Services hit an intraday low of about 10.5%, and volumes are at around 16.5%. While the company reported its second quarter results, the numbers were good. Revenue was up about 8%. Margin came in at around 1% versus 0.3% on a quarter-on-quarter basis. Net profit was also up 28%. But what has disappointed the street is largely the management commentary which happened in the conference call yesterday. The management mentioned that 3Q, that is the third quarter, will largely be soft because of the banking space, and the specialized staffing this time also was under pressure, largely due to cautious demand in the IT vertical. Now remember that IT has been doing really well after the US elections outcome, but it has been seeing profit booking since the start of the day today. But talking about TeamLease again, well, the HR services growth attribute is attributable to seasonality. While talking about the HR growth, the HR services growth actually in terms of revenue, well, it was flat, but margin saw a little bit of dip this time. But when we spoke to the management in the noon today, she said that the HR services segment will revive in the second half as well. Well, let's talk about what Nuvama believes. Well, Nuvama believes that the company will continue to deliver robust revenue growth, largely on the back of headcount addition. Now, the headcount addition this time has been around 18,500 employees, which is up around 6% on a quarter-on-quarter basis. Well, Nuvama also believes that margin improvement is slower than expected. So, though the numbers were good, it was largely below expectations. Well, Nuvama has maintained a buy rating on the stock with a target price of 4,350 rupees versus an earlier target of 4,060 rupees. In terms of valuation, Nuvama gives it a 35 times value based on the price to earnings ratio.
Okay, Rucha, thank you for getting us all those updates with respect to TeamLease. And from there on, we talk about KC International. Let's pull up the stock and see where this one is currently trading at. Well, for now, of course, we have plenty of updates here. But we have Anushi, who joins us to tell us about why this one is buzzing in trade. Anushi, over to you.
Okay, so KEC International is in focus today. Higher volumes that we are seeing in this counter, volumes up to about 10 times today compared to its 30-day average, while the stock has hit an intraday high of about 10.2%. Now, the company just came out with its results a few days back. We just go through what has happened since then. They've reported a 14% of a revenue growth, while margins stood at mainly the same levels as last year, that is in the 6% range. The company has been posting a similar kind of margin level since the last couple of quarters. Net profit, however, saw about a 53% of a growth at 85 crores. But in other key highlights, the company order intake stood at about 13,482 crore, which is a 50% of growth from last year, and they maintained their order inflow guidance as well of that is about 25,000 crore for the overall FY25. Coming to the order book value, that stood at about 34,000 crore, and this is with an with an additional L1, that is the lowest bidder position of about 8,500 crore. What one should be looking out for now is the expected T&D pickup that should take place in H2. T&D's transmission distribution business, which was impacted by heavy rainfalls or monsoon, this along with elections in the first half. So higher pickup and execution on that remains as a focal point. Margin shifting to 7.5% level in the FY25 guidance that the company has given is another focal point, because 6% has been what the company has been posting since the last couple of quarters. Other than that, they also expect their margins to go to a further 9% to 8.5 to 9% by FY26. So that is what is happening. Other than that, on the segment side, while transmission distribution remains on the stronger side, expected recovery in railway business is another factor that should be watched out. So this is what is overall happening in KEC International.
All right, Anushi, thank you so much for getting us all those details with respect to KEC International. A lot of visibility coming through on account of the order book. But we move on to another, story. This one is an interesting one. Fake email IDs, fraudulent bank guarantees, bid processes cancelled by the government. This is the fallout of Anil Ambani's Our Power attempting to hoodwink the government and win a bid for a solar power project. They have been disbarred from participating in future bids for the next 3 years, and my colleague Vishwanath Nair has more details of how this scam was exposed. Vishy, over to you.
Right, Agam. So what has happened here is that essentially Reliance Power, which is an Anil Ambani-owned company, has been exposed for participating in a bid process with unclean hands, essentially. What they have done is that they've submitted certain documents which proved to be false. Now, I'll take you through what exactly happened in this entire story. Essentially, the Solar Energy Corporation of India, SECI, which conducts all the tenders for the government with respect to solar power projects, had conducted an entire bid process back in June of 2024. After that, essentially, certain discrepancies were found with Reliance Power subsidiary and the way that they have submitted the bid. What exactly they did was that they submitted a foreign bank guarantee as part of the earnest money deposit that they have to do. This foreign bank guarantee was supported by SBI. That's what Reliance Power subsidiary had claimed. What SECI in its investigation found out was that there was a specific email ID through which an email was sent from SBI supporting this bid. However, that email ID turned out to be fake. Now you can see in this in the graphics on the screen, the email says S-BI, which is a very clear indicator that this was probably a fake ID. Next, what happens is that SECI pulls up the company. What it does is goes to SBI, and SBI confirms that this email ID was fake, that they have not supported the foreign bank guarantee that the Reliance Power subsidiary submitted as part of the bidding process. Next, SECI essentially decides to cancel the entire tender process because there were issues with the way a bidder had participated in this entire process. What sources are telling us also is that Reliance Power had actually won this bid, and after that, this has been cancelled and that bid has been pulled back. Reliance Power has on its part blamed a third-party arranger, saying that they had given them the fake bank guarantee in place, and the company did not know what actually happened on ground. But SECI has, of course, barred Reliance Power and all of its subsidiaries from participating in any future tenders for 3 consecutive years. So that's an important sort of announcement that coming from SECI this morning. They put out this notification on the website saying that Reliance Power and its subsidiaries will be completely barred. This is an important move specifically because you can see the comment that SECI made in its notice. It said that what it had discovered is that as part of the tender requirements, the endorsement of the bank guarantee against it was fake, and that was an issue. What they've also pointed out is that they have concluded, and it's logical to conclude that any action by the subsidiary of Reliance Power would have been done on the orders of Reliance Power, and therefore they had to bar the parent company as well. Important simply because Reliance Group, the Anil Ambani Reliance Group altogether, has been facing a lot of setbacks on most fronts, actually. If you were to look at an order by the Securities and Exchanges Board of India, they have barred Anil Ambani and certain other members with the Reliance Group from the securities market for 5 years. They had also levied a 25 crore penalty, which was, of course, removed by SAT. That case is still ongoing. Apart from that, you've had insolvencies of multiple Reliance Group-owned companies, specifically Reliance Communications, Reliance Capital, as well as Pipavav Defence, or what is now known as Reliance Naval and Engineering. So all of these companies are already under insolvency. This is another major setback for Anil Ambani.
Right, Rishi, thanks you so much for getting us all those details. A very, very interesting story, and perhaps also an unfortunate one here. But we move on to, well, what used to be the darling of Indian stock markets in this year seems to have fallen out of favor. And this is after the company has posted strong earnings. We have Mahima, who's now joining us, to give us an idea about what transpired in the quarter gone by for Trent and why has it been falling. Mahima, after you.
Right, Agam, just a brief about numbers before I tell why the stock is falling specifically. Revenue was up 39%, EBITDA was up 41%, margins have slightly improved from 15.3 to 15.5%, and net profit was up 47%. Now, couple of reasons why the stock is falling. First of all, Trent this time has seen a revenue uptick of 39%. In the past 4 quarters, the revenue growth for Trent has been over 50%. So, possible reason could be this. And overall, in terms of the management commentary also coming in remains weak. Now, in terms of key highlights, management has said that subdued consumer market is there, and this is being faced by all retailers. They've opened around 7 Westside stores, 34 Zudio stores, including 1 in Dubai and across 27 cities. The gross margin profile for Westside and Zudio remains consistent, and emerging categories overall now contribute around 20% to their total business. Their Star Bazaar revenue is up 27%, and online reach contributes around 5% to total Westside's revenue, and like-for-like growth was at 14%. Now, in terms of what Noel Tata has said about Trent performance, what he said is consumer sentiment remained relatively muted. Weak consumer demand seasonality led to headwinds for retail business, and they seek to explore additional avenues of revenue growth, and Star Bazaar is seeing strong customer traction on the back of Trent's playbook. And lastly, he's also mentioned that success of own branded products augurs well for the Star business. So overall, I think it's the weak commentary, and of course the numbers missing the analyst estimates are the 2 reasons why the stock is falling so much.
All right, point taken. But with that, we move on to Engineers India, and which reported its Q2 numbers, and the company saw a 21% fall in profits while margins contracted. My colleague Anushi caught up with the management on the quarter gone by. Listen in.
The H1 for this financial year is we've in fact maintained the Q1 and Q2 top line and enhanced our bottom line. Our business segment from the consultancy has a good margin of about 19%. In fact, our margin of the LSTK also has improved to about 6.5%, 7%. Moving forward, since we are a consultancy, our order book position is actually reflected in our turnover. And we have enhanced the order book and order inflow tremendously in this financial year, which is an outcome of relentless effort into diversification in various geographies across all sectors over the past 2.5 years. The order inflow this year, as of now, is about 6,800 crores. In fact, in the complete of last financial year, it was about 3,400 crores. So we have substantially enhanced our inflow, which will be reflected in the H2 of this financial year, as well as in the FY 25-26 as well. So it's a very healthy order book position that we have, one of the all-time high order book of about 12,500 crores. And we are hopeful of growing this further and close this financial year on a very, very good note.
You spoke about the order book that stands at about 12,000 crore. I want to understand how much do you plan to execute in the next half, the remaining portion remaining for FY25, and from there onwards, what is the order book that you envision for the next 1 to 2 years?
So Anushi, sorry for that.
No worries.
I'm not able to hear very well out here. But our order book is into 3 large segments. One is when we work internationally, we do a lot of engineering assignments, like from Abu Dhabi office with our ADNOC group of companies. And that conversion of order book into turnover is having a time scale of 10 to 12 months. So a lot of the inflow of orders out here in the Middle East is going to be converted on the top line this financial year. The second piece of our business lies in the infrastructure segment, wherein we have substantial inflow last year as well as this year. Again, the time cycle of these projects is significantly shorter than the oil and gas sector, which is a long gestation as a long implementation, more complex. So something like 20 to 30% of the conversion of the inflow of orders of the infrastructure segment is also going to be realized in this financial year. Insofar as the petchem space, the petrochemical, the oil and gas space is concerned, the business is, the projects executed are having a time frame of about 36 months to 40 months. And that inflow that we have received this year and we will subsequently receive in the balance of year will probably reflect in the end of FY 25-26. And moving on, it will show a healthier top line in the years to come.
Okay, so we expect a ramp up in H2 onwards. So with the expected ramp up in the order book that is expected to take place, do you maintain the 3,500 crore of the revenue guidance for this year? That's my first question. And along with this, of this order book, wherein are you seeing more opportunities? Is it from the consultancy business or the turnkey business? If you can just give us a perspective on that.
Sure. Now, I do see a definite maintaining of the revenue. In fact, we are hoping to enhance that. A number would be difficult for me to give you right now. We are hopeful of going beyond what we did last year, last 2 years. In fact, we maintained our position, on the same numbers largely. And going forward, what we see in the business front is a very exciting phase in both the petrochemical space. In fact, today we are executing 4 of the major petrochemical investment projects which are happening in India. And we are hopeful of garnering more work because the refinery section is moving on to more complex petrochemical segments. We are also looking at complex infrastructure projects which have, footprint in building and designing and implementing as consultants the data centers, the campuses for academia, industry campuses. And this is our kind of vision to give the complex competency to our clients, wherein we have a differentiation factor, in comparison to the others.
With that, we're out of time on this edition of Last Trades, but do stay tuned to NDTV Profit. India Market Close comes up next.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hand.
Thanks so much for tuning into India Market Close, and we've kind of been in that 1% downtick range for the benchmarks now for a while. I mean, just look at the Nifty intraday or the Sensex intraday as the case may be, and you will see that the market has just been lying low with almost no attempt to bounce back. We should get the intraday chart on the screen. There's been virtually no attempt to bounce back today, so that's the telling point really. Look at this. It's just been in this very narrow band throughout the trading day today. So, bit of a pullback, nothing untoward really. 1% is ordinary correction any given day, and after such a sharp up move, yes, you would probably see this happen as well. A day of profit booking expiry. Let's see what tomorrow brings. IT isn't quite performing as well as yesterday, obviously so. So that is the other issue, if you will, in the session today. Mid caps and small caps have fared better actually. So Tamanna might have a slightly more favorable list to talk to as opposed to mine. But let me start with the heat map and show you what's moved at the large cap end of the spectrum, because there's a lot more red than what it was, and look at the cuts that have come into some of the results disappointments. So Hindalco started off 5% lower, is down 8.5%. Arguably the stock of the day, though you could argue that even Trent could be it. because Trent is down 7.5% after being 20% off from the highs, all-time highs. So if you just look at the Trent chart over the last 1 month, it's coming off as swiftly as it had gone higher. Then the Shriram Finance, Grasim, Tech Mahindra, etc. are all Adani Enterprises, Tata Motors. Very few winners. Actually, only one notable one, which is Apollo Hospitals, which is up 6%. So yes, Tamanna, you would have a lot more to talk about, but the reactions on some of the large caps are fairly exaggerated today.
You know, yeah, and actually Trent and Hindalco is something that I'll talk a bit about as well. But you're absolutely right that the beating down on bad numbers, and Trent numbers were not even bad. It's perhaps a mix of expectations, missed estimates first time in 3 years, and Noel Tata's commentary, which has hurt Trent more than anything else. It's also the first time in several quarters that the top line has grown, say, in the 40s range versus the 50s range. So a mix of those factors that has seen Trent down about 14%. But we should pull up the advanced decline ratio just to get you a sense of what the market breadth is like as well. And that's where the pain point becomes very apparent, 1286 versus 846. Let's pull up the sectoral indices just for a second, because there is a bit of pain. I would say that the Trump trade has reversed. We've moved to other concerns, including what the Fed will do tonight. Remember, 12:30 onwards, live on NDTV Profit, you can watch the Federal Reserve's commentary. Jerome Powell, possibly his last meeting and press conferences will be streamed live by us, so don't forget to catch that. Nifty Metal becomes a key story to track. Nifty Metal about 3% down. We should pull up the internals of the Nifty Metal as well, because is this a China play which is beginning to hurt? Reports this morning that the Chinese government's key committee, which was to decide on measures to improve the economy, seems to have postponed that decision. Are they waiting to see what Trump does? Hindalco, of course, is the biggest reason. So let's come to the specific stocks that are on our focus this afternoon, and Hindalco is one of them. Hindalco, because of Novelis's results, the Novelis result impact has hit Hindalco badly. That's why you're seeing that stock about 8.5% down. But the others that we're looking at, we spoke extensively about Trent, so we let that go. But Blue Star, you know, Blue Star is an interesting story because the numbers are actually pretty decent. Despite that, 5.5% down on Blue Star. Avalon Technologies is the other one that we should look at, and even if Bajaj Electricals, we can quickly make good results on Avalon. Stock is 20% up. Bajaj Electricals, on the other side, on the other hand, the numbers actually on the face of it look fairly bad, but the stock was doing okay. So Bajaj Electricals is the other one that we should see. There you go with Bajaj Electricals, 2.5% up. The numbers actually bad. The profits are down nearly 80%, but perhaps not as per expectations. PB Fintech is just the other one that I would point out. A target price hike from Citi has seen the stock spurt about 4.5%. But tough to pick up those winners because you are seeing pressure otherwise across most stocks and sectors.
Yes, and today we can't single auto out, but let's get in Abhishek Gaushinde, Deputy VP Research at Sharekhan by BNP Paribas, to talk about some of those as well while we try and address some of the other top market stories. But Abhishek, good having you. Thanks for joining in. What have you made of the numbers thus far, and are maybe the winners are few and far in between, but relative to expectations as well, what was even more disappointing for you?
In which you're talking about M&M or?
I just thought I'll start off with the overall thing and then get to M&M.
Okay, so in auto sector widely, you can what we can say that so far we have seen the numbers are in line with the expectations, but the stock reactions, whatever we are seeing, is not on this particular numbers only, but on this festive numbers and the seasonal sector. That as we are entering into the lean period, so post festive we have now 2 months compared to previous year we have only 45 days, and the inventories situation, especially in the PV segment and the slowdown in the CV segment, has been impacting the stock prices. But on terms of a number, if you can say that so far, except I think the Maruti's EBITDA margin, most of the companies have reported operating profitability either in line with the estimates or close to the estimates.
Hi, Tamanna here. Just trying to understand, let's come to M&M because those are the numbers that have been posted today, and standalone profits 3,840. Consolidated actually looks slightly better. Tell us why there is a bit of pressure on the stock today. What do you think? Are there any concerns in the numbers as you see them?
See, again, I can say that the numbers are almost in line with the estimates. I can say that given that this is a seasonally weak quarter for a tractor segment, despite that the company has been holding 14% plus kind of EBITDA margin, and that is mainly because of the underlying improvement in its EBITDA margin or the profitability in the both segments. Given that historically the performance of the company was completely dependent on the tractor segment, but now the auto segment has been contributing to the profitability, and that has been reflected in its performance where it has been holding the higher margin. Now your second question is on the pressure on the stock price. So I can say that it's not on the reaction to the numbers, even that I have been seen in the media that the company has increased the volume growth guidance for the tractor segment in this particular financial year from 5% to 6 to 6.8%, and it has been outperforming the PV segment. So whatever the reaction we are seeing is of two things. One is the market, and second overall market-wide reaction, and second is that the industry itself is entering into the lean period after the festive season. So once this lean period will be over, I think the potential price points would come back. I don't think that any earning cut down would happen after this result.
What would be your call, Abhishek, on the M&M stock right now? Because a lot happening for them. Their new EV, their first born EV, as they call it, from the ground up, is going to also be launched. Would you say that this is a stock that you would be constructive on right now, positive on? The stock has so far been delivering as per the investment thesis. Even though at the beginning of the year it was known that the tractor cycle would not do well, albeit it has been doing well, but we were hypothesizing that it would continue to maintain its market share or gain some point of a market share. So that has been happening. The second point that we were saying that even though the PV segment would not do well in this particular financial year, but M&M would outperform the PV industry because of the availability of the new capacity and a positive response to its new products. That has also been happening. And third, that which I have recently shared, that it would reduce its dependence for the profitability on the tractor segment, and the auto segment would start contributing. That has also been happening. Now, your second question is on the EV side. So it was known that it was expected that the beginning of the early part of the next year that company would launch its BEVs. So that has been happening, I think, by the end of this month, which is broadly in line with the initial expectations or the guidance given by the company earlier. So if I were to ask you, Abhishek, to look at all the PV players right now, passenger vehicle players, let's look at M&M. Hyundai is also now a listed company. Let's look at Maruti. Let's look at Tata Motors. How would you compare them?
See, with comparison, if you compare the Honda and Maruti, that is a good comparison. But for M&M, which is completely pure SUV play, as I have said in the beginning, that it was expected from the beginning of the financial year that it would outperform the PV industry in PV industry growth in FY25, and that has been happening. So if you build up a pecking order, then Mahindra and Mahindra will remain at the top in terms of the growth part in this particular financial year in the PV segment. And I think that is now a consensus view on the Mahindra and Mahindra at the overall PV segment.
Abhishek, okay, if I were to ask you the same question in two-wheelers and let's rank them, what is your top pick amongst the two-wheelers right now?
Even in the two-wheeler case, it has been outperforming the overall PV segment, or overall automobile sector in this financial year, and that story will hold up in the coming or the rest of the financial year also. So in terms of the pecking order, we have been positive on the Hero MotoCorp. At this point of time, valuation is also supporting, and essentially it has said that it has in festive season, it has reported almost 13% kind of a growth on a YOY basis. So what we see that based on these numbers, the volume estimates for this year would be measured up, and beyond that, its new product launch cycle is also doing well in domestic as well as on the global front. And third is that in the street was concerned on the Hero MotoCorp because of its lack of presence in the electric vehicle segment, where it has also been doing well. So most of the boxes are getting ticked. So our top pick in the two-wheeler segment is the Hero MotoCorp. After that, we consider that it's a lean period for other players. So the performance would be visible, or the potential performance would be visible more from the quarter four onwards. We don't see any significant upgrades in this quarter, and similarly in the quarter three also.
Okay, Abhishek, leave it at that. Thanks so much for taking the time out and being with us. Really appreciate your time. Let's get across to Rajesh Palvia, SVP Technical and Derivative Research at Axis. Rajesh, it's not as bad, but it looks slightly wobbly today, more so because yesterday was such a rah-rah move that it seems as if it's an oh my god move, but it's just about 1% down on the large caps, less than 0.5% for the mid caps and small caps. How would you trade the benchmark indices today?
Good afternoon. So the major pain which we are seeing in the market, that is in the derivative universe. The most of the derivative stocks or F&O universe stocks are under supply pressure. Though it's a weekly expiry for Nifty contract option. So I think here we may see further more pressure as we are almost trading near to 24,200 important support area based on the put concentration. I think if we slip further below 24,180, 24,175, that may create further more pressure in the Nifty, and possible down move can extend to 24,150 to 24,100. That's the next major and important critical support area for this pullback, which we have seen from the recent low of 23,800 kind of zone. So I think if we slip below to 24,100, I think then there is a possibility that we may break previous low also. So at this juncture, 24,100 is the key level to watch for in the next 1 or 2 trading session. If we able to defend this level, then some pullback action, as again near-term indicators are in the oversold trajectory. So I think if we defend this level, then some pullback towards 24,350, 400 we might see next couple of days. So for today, 24,150, 24,100 is the important level. If it comes, then buy. At this moment, I think I'll avoid to buy Nifty. For Bank Nifty, 52,000 was the important level for Bank Nifty spot, and that we have already broken. So if we remain below to 52,000 level, some pressure towards 51,600 to 500 we can see. That's the next level for the Nifty or Bank Nifty on the lower side. That level needs to watch for next 1 or 2 trading session. If we able to hold out, some pullback we might see in Bank Nifty also around those levels. But at this moment, there is no trade for both the indices. We believe that let the market to correct further towards the important support area, then try to buy for pullback action.
Rajesh, hi, good afternoon. Tamanna here. What would be your top trading calls this afternoon?
So again, both stocks from the mid-cap universe. First one is Wellspun Corporation. That stock managed to give breakout of its previous swing high and series of higher top, higher bottom formation. Very strong buying action in last couple of weeks. Looking at the overall structure, we believe that Wellcorp may continue further more upside. Possible target towards 840 we could see in short term. So one can buy this stock with stop loss of 788. The stock is comfortably holding above all its important moving averages, and stock is almost trading near to its all-time high trajectory. So this stock is looking promising. Another stock that we like at this juncture, that is again Polyplex. This is the second consecutive week where we are seeing that stock is showing strength, and looking at the near-term, short-term structure, stock managed to be breakout of its previous swing high. Stock is comfortably holding about to all its 20, 50, 100-day moving average. That is clearly giving us sign of strength on the near-term structure. So Polyplex is a buy for upside target of 1270. So one can buy and accumulate with stop loss of 1200 for Polyplex.
All right. Stay on with us, Rajesh. The other stock that we need to focus on really it is the stock of the day's Trent, which has dropped as the company's missed its Q2 estimates. Stock now 8% down. So a couple of factors that have led to Trent's fall. But Mahima is joining us for more. Mahima, the question with Trent is that optically it is a good set of numbers. It's a good pair of numbers on revenue, EBITDA, margins, everything. Why the fall?
Right, Tamanna. So as you rightly mentioned, we've seen a growth of 39% in revenue, 41% growth in EBITDA. Margins have improved a tad bit, and net profit has seen a 47% growth. But a couple of reasons why Trent is falling so much in trade today. First of all, the commentary that is coming on from the management has been weak. Secondly, it has missed estimates on all fronts. The street was expecting a better performance from Trent, which is why the stock is also falling. Thirdly, revenue growth in the past 4 quarters has been over 50%, but this quarter it has been around 39%, which is why the street is upset. Even in terms of the like-for-like growth, this time it has been around 14%, but if we check the past 4 quarters, it has been around and over 20%, which is why, which is one of the reasons why Trent is falling so much in trade today. And in terms of weak commentary coming in from management, Noel Tata has said that weak consumer demand and seasonality has led to headwinds for the retail business, and they're seeking to explore additional avenues for growth going forward. And in terms of the stores opened also, the street was expecting more store additions in terms of Zudio and Westside as well, but that has also come off as per the street expectation. And Star Bazaar, which was posting a good strong growth, which has posted a strong growth in the past quarter, this quarter comparatively has not grown so much. So these are the couple of reasons why Trent has seen so much fall in trade today. And of course, Trent overall, if we see in the past 2 to 3 weeks, has fallen over 22%. So it's if we can say the darling of the street has seen a lot of fall in the past 2-3 weeks itself.
Darling of the street cooling off a bit, and perhaps Noel Tata's commentary is part of it. Neeraj, I think toppling under the weight of its expectations largely, and maybe a negative sentiment overall.
Yeah, but probably has to be just what you said. And it's a serious disappointment for a stock. In the last 1 month, down 14%, but from the peak it would be about 20 odd percent. So the stock has fallen 20%, and that includes the 8% fall today. So certainly looking wobbly. I wonder, Rajesh, fundamentals notwithstanding, and at some point of time it will recoup. But from a trade perspective, if you don't have an existing trade in Trent, would you take one now?
So Neeraj, Trent has shown very strong really last 12 month, and we have seen one way upward momentum for the stock. Now this is the second consecutive month. Now we are seeing that some profit taking on a sustained basis. This is the 4th consecutive week where stock is making lower high low formation. That clearly showing that some serious profit taking is happening in the stock, and in this process now stock is slipped below to its 50-day moving average as well as 100-day moving average. So I think some more corrective move we could witness in this stock. Maybe stock may slip towards 6,000 level. That is the next level we are seeing based on the monthly structure. So I think 6,000 would be the next level where one should review it. If it's able to hold out around 6,000 level, then only try to buy some quantity. Don't buy in one go. Buy in staggered manner. Because looking at the market condition, I think if it slips below to 6,000 level, then furthermore downside could open towards 5,600 level also. So I think at this juncture, I think one should wait, let the stock to correct further towards 6,000 level.
Okay. Rajesh, stay on. Let's get in a fundamental voice. Rupen Rajguru, Head Equity Investments and Strategy at Julius Baer, joins in on the show as well. Rupen, been a while. Good having you. Thanks for taking the time out. How are you guys thinking of what to do in a market like India after the big development in the US yesterday?
Okay, hi. Afternoon, Neeraj. Pleasure to be on your show.
Thank you.
From an Indian market standpoint, in fact, everybody has been expecting some bit of correction because while till beginning of October there was a one-way up rally which we had seen in the market, and I think this is a good pause. Coming to your point on the global development, if you look through, if you just cut across the noise and the enthusiasm which is currently there, there is no major significant impact on Indian markets per se. It can come through by way of flows, because what has been the trade so far, where a Donald Trump trade, so to say, it has been going long on dollars and short on the treasuries, and also long on US equities. And that is what actually yesterday we saw the pinnacle of that, wherein the indices were up 3% and the Russell was up almost 5%. So that is one. But to some extent, there can be impact on the flows of emerging market. But if you see, India this year hardly has got any flows. YTD, we are negative after the huge sell-off in the month of October. So Indian market will move probably on its own fundamentals, and we will look through. We had seen a phenomenal run up. The key concern for Indian market has been elevated valuation and high growth expectations. So now we are seeing the quarterly earnings not being up to the mark, and some bit of readjustment happening there. So I think the correction which we are seeing in the Indian market, I think it's a very good and healthy correction. And I would say it's more now going ahead. It will be business as usual. We look through the earnings, and then that will determine the movement in the stock market.
Rupen, hi, this is Tamanna here, and so glad to have you on the show. You started by saying that the turnaround in India was expected, obviously as a reaction to the one-way movement up. In the context of the Trump win and a spectacular win that we've seen in the US, what is the impact, say, for Indian equity?
So, Tamanna, hi, good afternoon. As I mentioned, from an Indian equity standpoint, the direct impact would come through by way of strong dollar. We have already seen the dollar index up almost 5% in last 1 month, which is in anticipation of Trump's win. And so that will potentially can have an impact on the flows. So that ideally 5 years, 6 years back, when foreign flows were determining the movement in the Indian market, this would have been a really big thing. But here currently, the impact from a flows is minimal. Sector-wise, there might be some impact. While yesterday IT sector rejoiced basis the expectation that the US corporates are going to do well and there will be uptick in the discretionary spending. But on the other hand, we have to wait and see what kind of immigration policy Mr. Trump announces, and that can also have an impact directly on the cost side from an IT company perspective. But other than that, there is no major. In a way, Trump, who's known to be, tariff king, as he himself calls. So, what kind of behavior he will have towards China? Whether in his earlier speech he had mentioned 60% not tariffs towards China and blanket 10 to 20% tariff across all countries. So that will lead to trade disruption. But at a margin, China's loss can be India's gain. So, to put it simply, no major direct impact apart from the flows, which I said the domestic flows are more than enough right now to absorb all the FPI pressure.
All right. Thank you so much, Rupen. Always great to have you on, and look forward to more conversations with you here at NDTV Profit. Rupen Rajguru, Head Equity Investment and Strategy at Julius Baer there, talking about the impact for equity markets in India of the Trump trade. But programming reminder, we have a classroom for you with none other than the Mark Mobius, where you can send in your questions to us. Those numbers are on your screen. Anything that you want to ask Mark Mobius in the context of what the Trump presidency means for India across the board, for stocks, for sectors, for equity markets, or in any other way, do send in your questions. Those numbers on your screen, and we are glad to get Mark Mobius to answer them for you. Meanwhile, let's look at what's happening in the markets. One thing that we need to understand is the banking play. And Rajesh, while you talked about Nifty, just at these levels, with the bank Nifty really flailing, would you stick your neck out on any kind of a long call on the bank Nifty, or you'd stay miles away? What about some of the key banking names like an HDFC Bank?
So, Tamanna, still, if I compare with the Bank Nifty and Nifty, so I think Bank Nifty is still one place better compared to the Nifty in terms of technical structure. Though there is a pressure on Bank Nifty also, as the broader market is witnessing profit taking or supply pressure. But I think 51,600, as we discussed in our opening remarks. So I think 51,600 is 51,600 is the key level for Bank Nifty. I think if it's able to hold out, some possibility of pullback in the Bank Nifty is there. The first stock that I like from the banking basket is from the PSU, that is SBI, and I think it's numbers are awaited. But the way SBI is showing strength in the PSU basket, I think there is a possibility if post number, if it's able to defend 835, 840 zone, I think there is a possibility that some surprise move towards 890, 900 we could see in SBI. So I think here one can deploy some long trade, those who can take some risk ahead of numbers. 840 should be your stop loss. Another stock from banking pack that we like, that is again mid cap, not will give impact to the major on the indices, but Federal Bank is also looking very attractive. Technical structure is very bullish for Federal Bank, and the way Federal Bank is holding the ground for this second consecutive week on the higher side, we believe that in recovery phase of market, I think Federal Bank can extend its gain towards 220, 225. So here also one can deploy some trade on the long side with stop loss of 199. And the third again is Bank of Baroda. This stock is also looking very promising. After almost consolidation of 15-week, stock managed to give breakout of this consolidation. So here also there is a possibility of up move to continue towards 275. So Bank of Baroda is also on our buying list. One can buy with stop loss of 255.
Okay, Rajesh, stay on. We'll take a quick break. On the other side, while we get you the top BTST ideas, we also get you the classroom with Mark Mobius. You can't afford to miss this. Stay tuned.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay
We're back with India market close right here on NDTV Profit, and some stocks should be marked. So, Hindalco is seriously facing some pressure, and we'll talk about that. There is weakness today in Glenmark Pharma, which is down about 6.5%. Blue Star is down about 4.5%. Adani Green 4% down in trade. Vedanta is sluggish, and I wonder if it's a smart trade to be so negative metals, considering that the Chinese NPC data will come out tomorrow, and we don't quite know what China will say. On the flip side, though, Swan Energy has had a good move, as has JSW Energy, 4.5% higher. PB Fintech, Nykaa, and ITI is up 14% in trade. So really strong show by that one as well. Actually, on a losing day, for some stocks to have done so well is quite interesting. What has not done well, though, as I said, is Hindalco, and we should talk about that for a moment, because that stock is cracked after Novelis came out with numbers which were a bit sluggish. More importantly, they refrained from giving an EBITDA per ton guidance for the near term. Is that the reason? Mihika comes in with more details about why Novelis is sulking, or why Hindalco is sulking.
Two main reasons. So, and this is all related to its international subsidiary called Novelis. Now, Novelis reported its Q2 FY25 earnings, while net sales were up 5% year on year. Their adjusted EBITDA was down 5% to $462 million, and net profit was actually down 18% at $128 million versus $57 million a year ago. What impacted profits is a charge of $61 million due to the production interruptions of Sierre plant, and this was due to flooding in the area, and the impact of this shutdown will continue to the end of 2024 is what the company has said. Another factors that impacted the earnings were higher restructuring and impairment expenses, as well as lower operating performance. And the one that stands out in terms of the commentary that the company has given is they've suspended their near-term margin guidance, and this is related to adjusted EBITDA per ton guidance, and they're going to wait until further clarity on metal markets, and they expect margins to contract sequentially in the second half of FY25, and this impacts Hindalco Industries as well as their overall growth for the second half of the year. Why has the guidance been suspended? Because of higher aluminum scrap prices, which have been rising due to intense competition on the back of China's policies. And Novelis products, around 60% of their content is from recycled content, and that's why their input costs will gain. And when you talk about why Novelis is important for Hindalco Industries, which is what we're seeing reacting today, well, Novelis accounted for 61% of Hindalco's consolidated FY24 revenues and it also accounted for around 56%, which is more than half of Hindalco's EBITDA in FY24 as well.
So that's really what has hit Hindalco. Basically, an acquisition of theirs called Novelis, which accounts for half of their earnings, has lowered its outlook, its guidance for its profitability. So that's the long and short of the story. Very, very painful situation there. Rajesh Palvia, are you seeing a floor for the Hindalco stock price where you would be interested in coming in?
I think the way stock has given a breakdown on a weekly chart, stock was in uptrend, but looking at the breakdown on the upsloping trend line support on the weekly chart, that clearly shows that the trend has turned slightly on the bearish side. In this process, stock has now broken the 50-day and as well as 100-day moving average support area also. most of the metal stocks are witnessing some profit taking in today's session also. We believe that, the way stock is now sustaining below to 660 level, I think if it remains below to 660, possible down move can extend. And we could see a level towards 625 to 610 on the downside for Hindalco. So I think further more room for correction to extend in this stock. So wait for the correction around 610.
I was trying to look at stocks which might have moved a bit. I think Praveg has had a really good move the last 2 days. So some stocks which have bounced. So Praveg, look at that one, up about 4% today, but up was about 7-8% yesterday as well. The other one is Marathon Next Gen, 6.5% up today after being up about 3-4% in trade yesterday as well. A couple of these which have had a decent up move. Any thoughts here, Rajesh?
So Marathon, I'm just checking on the daily and weekly chart. Stock after correction, stock has formed a base at around 550 zone, and now stock has shown some recovery in last couple of week. And looking at this recovery, we believe that if it's able to sustain above 600 level, I think there could be some furthermore follow-up buying towards 650 we can witness in near-term perspective. So keep a stop loss of 600, those who have already bought it lower side for upside target of 650.
Okay. So Marathon next, look at Carousel. Carousel numbers out, profits up about 9%, revenue up about 26%. No real hope for the stock right now, still getting beaten down a fair bit. This trajectory has been seen all day today, and we saw it with a Blue Star, some others as well. Reaction to the results has been very, very volatile, and if it's any kind of a concern, then the beating that the stocks have got is really quite astonishing to see. But one stock which has really been doing well and surging in trade is Avalon, again on the back of strong earnings. But Puneet, have we seen these kind of numbers from Avalon that deserves a 20% jump in the stock price today?
Well, there's one thing that this is the first meaningful gain in terms of profits and revenue for the first time over the last 6 quarters since it's listed back in April of 2023. And that's why there's a very strong reaction to this particular stock. Now, revenues, as you said, grew 36%. And while the growth is, definitely good, but it's very low compared to someone like a Dixon Technologies or Keynes, which have roughly 60 to 80% revenue growth as well. But profits for Avalon is coming at 140% growth compared to the same time last year. That's a positive. When you look at the key highlights, of course, the very strong order book, roughly 1,400 odd crores. That's roughly a year's order book that they have currently. Revenue currently is also roughly 41% from India and 59% from the USA. And also they have a manufacturing plant also in the USA as well. And that's one of the key differentiators as well. Just want to talk about. So the two key differentiators for someone like an Avalon Tech compared to the other key EMS players is, of course, that it's the only EMS player to have a manufacturing plant outside India. So it can give onshore manufacturing operations to clients in the USA. And the second thing is that it's not present in the consumer business basically. And we spoke about Sirma yesterday as well, that the consumer business is a low margin business but very high revenue growth as well. So that's one of the key differentiators for someone like an Avalon. They are present in sectors like industrial, automation, EVs, clean energy, and those are very high margin businesses but low volume as well. So over the last 6 quarters, company was marred with lower revenue growth, and I think going forward the company is expected to give a better result as well. So conference call is scheduled at 3:30 today. We'll see what company guides for the next second half as well as for the next year in terms of growth. And I think that's going to be one of the key things to watch out for the stock, because it's not cheap. It's at 100 times current price to earnings, and that's largely because the earnings have been missing for the last 6 quarters. So it is seeing a valuation re-rating, but a growth commentary, according to me, is going to be one of the key things to watch out for.
Growth commentary we will watch out for. Meanwhile, Avalon Tech at 20% up move. Rajesh, thank you so much for joining us today on the show, even as we wind down. But time for a very, very exciting segment. We have with us none other than Mark Mobius, Chairman of Mobius Emerging Opportunities Fund. Mark, great to speak with you here at NDTV Profit. And the reason why the segment is also exciting, because we're calling it the Classroom with Mark. We've invited queries from our viewers. We've invited their questions on what Donald Trump's presidency means for investments, for stocks, and of course for India. So thank you so much for joining us and taking some of those questions. But Mark, let me begin. Before we get to all of our questions, let me begin with your take. Were you expecting this expanse of victory?
I expected a victory, but not this strong. As you know, the American media has been very misleading in its reporting of what will happen during the election, and they've been favoring Kamala Harris and the Democratic candidates. So it was difficult to decipher what was actually happening. But I did know that Trump was in a strong position, would probably win, but not by the kind of margin that he has won. And most importantly, and most significantly, it looks like the Republicans will have control of both the House and the Senate. And that is very, very important because it means that a lot of the reforms that Trump wants to put in place will be enabled with Congress's support, with the Republicans in power. So it's a very, very significant situation that we see in America today.
What do you think is going to be the impact? Now, you know, whenever there is such a polarized kind of a campaign and then finally a victory, everyone waits to see what the candidate will actually do versus what they said. In your view, what does a Trump presidency look like right now for global markets and for emerging markets like India?
Well, first of all, you will see a U.S. economy resurging, and there will be a strong U.S. economy. And the reason is that Trump will institute significant reforms, particularly deregulation. The thing that has held back many American companies, and for that matter, foreign companies operating in America, is the high degree of regulation around the environment, around safety, around money, particularly money flows have been very, very restricted as a result of the implementation of anti-money laundering and all the other ways that the government has tried to restrict the flow of money. In fact, they've weaponized the US dollar. And that has been bad for the US dollar, by the way, because at the end of the day, you're seeing the BRIC countries say, oh, we don't want to use the US dollar anymore because it's so restrictive. We can't do anything. Now, Trump is going to try to end that because he realizes that a dollar that can be used globally and is successful and popular globally is very good for the US economy. So I think you're going to see a lot of deregulation that will help the governors govern these companies. And also you're going to see a much more stronger environment for innovation, which is so important to the American economy.
Mark, the usual things notwithstanding, which is maybe looser regulations for crypto, so on and so forth, but there's a belief that it could hurt areas like Europe, China, the measures given out by Donald Trump, but some of the competitive export economies might actually benefit out of the tariffs as well. How do you think about this aspect?
Yeah, it's very important. Let's assume that the U.S. imposes a very high tariff, 60% on Chinese goods and 10% for the rest of the world. Obviously, what will happen is a lot of the manufacturing will move to those countries with a lower tariff. India, of course, benefits from that situation. The other thing that can happen is that once a very high tariff is imposed on China, the Chinese, of course, will have to take action. They will do a number of things. The first thing they will probably do is reduce the value of the renminbi. They devalue the renminbi by 10% or more. And that means, again, that Chinese exporters will be able to go into a lot of countries with a more competitive price. And of course, they'll go into the US. They won't be able to beat a 60% tariff, but at least they will be a little more competitive. But more importantly, they will move the manufacturing to places like India and particularly in Southeast Asia, Mexico, et cetera, et cetera. So, initially it seems that these tariffs will kill the global economy. It will not, because the global economy is very flexible. Supply chains have been established all over the world. And if you look at the history, you'll find that one of the benefits of a high tariff for the US, at least, is that it brings more income to the federal government, which means that the federal government can begin to pay off the incredible debt that built up over the years, particularly under the democratic environment. So we're in a situation where it's very, very positive in so many directions. Most importantly is the deregulation aspect and the fact that the US economy is going to be growing at a better pace, faster pace, which will be good. Remember, the US economy is the largest in the world. So what's good for America often is good for the rest of the world in many ways.
Okay. Well, Mark, as we said, there are a lot of people who've written in to try and understand how you think about it. So I'm going to ask you the first of the many queries that have come in, and it's coming in from a gentleman called Jayesh from New Delhi. And Jayesh asks whether Trump's America First approach is good for the Indian export sector. Now, you partly answered this, but specifically for the export-oriented companies, would that be good or would it not be?
I think it will be fine. I think the Indian export sector will do well, particularly if Trump imposes a 60% tariff on China. Obviously, the next logical place for people to manufacture would be India, because you've got the population, you've got low-cost labor, you've got software companies that are doing very well, and you're going to see a lot more manufacturing in the hardware sector, particularly semiconductors. So I think actually this is very good for India in particular.
Okay, so it is good for India. Do we have a question coming from Karishma, who says, will Trump's win increase the chances of more mergers and acquisitions for Indian tech stocks? Very interesting question. So how tech stocks have been responding, Mark, is on day one, that is yesterday, complete surge, insane all-round surge in tech stocks. Today there's been a pullback, and a fairly sharp pullback. What is the kind of impact you see on Indian tech companies because of Trump's possible policies?
Well, the interesting thing that's happening is that going unrecognized is the fact that the software sector in India has been progressing very, very rapidly towards semiconductor software. In other words, designing the software for semiconductors. This has been going on for quite some time, but it's sort of been hidden from the public. Nobody really has been realizing. We know, of course, you've got companies like Tata, Infosys, doing normal software for enterprises around the world. But this is the first time that you've recognized the situation. What that means, of course, is that more and more American companies, Intel, all the rest of it, NVIDIA, they will be doing more and more software in India because the talent is there, the knowledge is there, the capability is there, and the cost, low cost is there. Now, in terms of mergers in India, of course, that will depend on regulatory environment in India, but it does make sense for some of these large software companies in India to merge and be big enough to tackle some of the huge challenges that they have in creating software for the semiconductor industry. So you might see that happening.
Okay, so in terms of opportunities for the semiconductor industry, we see that for sure, Mark, but what are the other sectors from an Indian perspective which could benefit? For example, do you see any clear benefit for Indian pharmaceutical companies if the Trump administration wants to go hard on China?
That's a very good point. In fact, one of the sectors I was thinking of mentioning was the pharma sector. As you know, India has a very strong pharma sector, and Indian companies have been particularly good in doing the intermediate chemicals that end up in the final pharmaceutical product. I think going forward, you'll see more and more of these companies promoting branded finished products globally, not only in India, but globally, and particularly in the US. And of course, the Indian companies have been fairly good at getting FDA approvals. And with deregulation in America, this might even become easier. So it'll be an interesting point to look at in terms of what the pharma sector will do. But I would say that's one sector we're looking at and very favorable towards as a result of this change that's taking place.
Okay. Mark, so one of the queries is whether how would gold and gold stocks perform now that Donald Trump has won? And it's been a very interesting move in that a Trump trade or a pre-Trump trade, you saw gold really moving up, and now that he's come and the strengthening dollar has meant gold has started to come off a little bit. So what's your view on gold and gold stocks as well?
Well, my view of gold is still bullish. I believe that you should have gold in your portfolio, physical gold, at least 10% or maybe even more. But one of the reasons why I'm particularly bullish on gold is because of India. As you all know, Indians love gold. They believe in gold. They believe gold is really currency, is something they should have for safekeeping. And as per capita incomes in India rise, of course, the demand in India for gold will increase. So that's one side. The other side, of course, is that central banks around the world have been increasing their gold holdings, despite they all say, well, our currency is not backed by gold, but in fact, they have been buying gold. And the reason, of course, is that they're worrying about the global environment, the dollar, what Trump will do, what he won't do or will do, et cetera, et cetera. So I think the demand for gold will still be there. Of course, there'll be fluctuations. As the dollar gets stronger, of course, gold will weaken. But I think we're now in a situation where there's still more strength coming in the US dollar, but not that much more.
Okay. Mark, somebody would be curious that if you're looking at India, and I know you look at India very closely, invest into India as well. You may not be able to talk stocks, but themes or what sector should one invest in? Because there is a query that has come in from Kolkata from a gentleman called Yash. Or which sector should he invest in for the next 4 years?
Well, first of all, the software side, particularly those companies that are becoming much more expert in semiconductor software. That's one area. The other area would be infrastructure. As you know, there's a lot of infrastructure building going on in India, but there's a lot more that has to be done. If we compare the situation in India compared to China, India has a long way to go to build more roads, high-speed railways, et cetera, et cetera. So I think that's one sector. And of course, the sector is very wide. You can go anywhere from the equipment suppliers to the companies that actually build the infrastructure. So I think it's one sector you've got to look at very, very carefully. And of course, at the end of the day, consumers, as I mentioned, in India are becoming wealthier. Per capita incomes are going up. And that means not only consumer goods, but particularly housing, because the demand for housing, which, by the way, goes along with the infrastructure area, is very important. So I would look at those sectors to begin with.
I'm just trying to understand, Mark, and we've been talking about impact of Trump on India, but if I look at Indian markets on its own, right now, a bit of a rough patch. I would say the last two trading sessions was a relief rally in a sense, fueled by what's happening globally, etc. Do you think that valuations is becoming a concern as far as India goes, or will we see a turnaround and a return in foreign flows?
Well, yes, there's no question. A lot of people are concerned about valuations. And when they talk about valuations, they normally talk about PE, price earnings ratio. Unfortunately, price earnings ratios are not a very good measure of value because the market discounts the future. So the P is there, but the E is not there. We don't know what the earnings are going to be going. And many people, in order to make an estimate, look through the back door. They look backwards. They don't look forward. And in India, as you know, with an economy growing at this fast pace, let's say if the economy is growing at 7%, companies will be growing at double that. Their earnings growth will be double. So if you take that into consideration, you're better off looking at return on capital and other measures, which will look at the future rather than the past. Considering that, I believe that the Indian market is still quite fairly valued. And of course, you'll see corrections along the way, but this will be an opportunity to buy rather than to sell.
So that is the FI mood, but Mark, we're also speaking just ahead of the Fed meet. And it's very unlikely Jerome Powell will come out and actually say anything about the Trump presidency. But then that's the big question, isn't it? Will Trump's moves increase inflation? Will we see a reversal in the kind of rate cut outlook we had? How are you seeing it?
Well, one of the favorable things that's going with Trump is that the money supply is actually stagnant and, in fact, going down. In other words, the growth rate is stagnant and the amount is decreasing. And of course, when you see a money supply in that situation, that means that inflation is going to be stymied, or at least going sideways and maybe even going down. So that's going to be favorable for Trump because he, of course, wants to see the inflation rate moving down, particularly for the typical household goods, food, gasoline, that sort of thing, which is why he wants to drill. He wants to have much more oil production because he realizes that at the end of the day, a lot of the prices are driven by fuel prices because you've got to transport these goods, et cetera, et cetera. So I believe that at the end of the day, you're going to see a Fed which will not be very aggressive. It's certainly not raising rates and probably maybe even be more aggressive in lowering rates. But that will take care of itself. The Fed is sort of the situation where they have to comply with what the numbers are telling them. And very often they're too late. The numbers are looking backwards, not looking forwards.
Okay, Mark Mobius, such a pleasure talking to you on this classroom. Thank you for taking our queries as well and the queries of our viewers too. Really appreciate your time. Well, that's the view from the indomitable Mark Mobius. But as we speak and as we shut shop, just the same way it was, Tamanna, and just get the heat map very quickly before we mark individual stocks, because I don't think the large caps will have changed too much.
Nope.
No, they haven't. It's Apollo Hospital 6.5% higher, Hindalco and Trent, and then a few others which are down in trade.
Just look at the difference between the first and the second highest stock on the Nifty. Apollo Hospital 6.5% higher, then you have SBI barely 0.5% up. So that's really telling you the market mood overall. And just pull up the breadth very quickly, the advanced decline ratio, and then let's look at the broader markets. Yeah, that's actually widened a little bit. So no real hope over there in the sense of a turnaround. Maybe tomorrow will be a better day. Remember, expiry pressure has also built in today. So keep that in mind. 0.5% down on the Nifty mid-cap, and the small-cap stocks also looking a little shaky, over 0.5% down. Let's pull up sectoral indices very, very quickly. Just a couple of minutes, I think, before we shut. And yeah, there you have it. Adani Energy actually taking a bit of a beating because of the MSCI re-rating, I assume.
Non-inclusion, yeah.
Yeah, and Hindalco stock hit because of Novelis. Trent, one of the top losers today. Glenmark Pharma also feeling the pain on the upside. DCM Shriram has been on a tear after its numbers. And Apollo Hospitals Nykaa is the interesting one here. KC International also responding very well. No clear reason though. But its numbers came a couple of days ago.
Yes, they did.
Yeah, but KC International doing well. So a mix of factors perhaps, but overall no big trend that we're seeing. The biggest hit though on Nifty Metals. Tomorrow's going to be a big day. So much happening in the next 12 hours or so that it's difficult to gauge what kind of a morning we'll have tomorrow.
Yeah, very, very difficult. We'll get FOMC, we'll get the NPC outcome and more, and we'll of course cover all of that. But for now, from Tamanna, me and the team that has put India Market Close together, thanks so much for tuning in.
When the whole day passes like a blur, the news just whizzes past. and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Well, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Thanks for tuning into Talking Point. I'm your host, Neeraj Shah, and our guest today is the founder of Envision Capital, Nilesh Shah. Nilesh, such a pleasure talking to you. Thanks so much for taking the time out and being with us today.
Thank you so much, Neeraj, for having me on the show, and festive greetings to you and all the viewers, and wish all a great year ahead.
Yep, and from all of us to you and your team and family as well, Nilesh. It's a new year and it's a new world order of sorts, if you will, after what's happened yesterday. What's the most important thing that you believe will be your hypothesis about a new Donald Trump presidency coinciding with the 5-year term, third term of the NDA as well?
So, Neeraj, I think in the first place, the most important impact that yesterday's election outcome in the United States will have is perhaps on geopolitics. The world has been a lot more troubled on the geopolitical front for the last almost 3 calendar years, right from early 22, then going on to 23 and the entire 24. And we have a few pockets around the world where there has been some really escalated conflicts going on. And it's expected that that with this change in the presidency in the United States, it's expected that we're going to see a lot more normalcy on the geopolitical front. So I clearly believe that's going to be the first big impact that I envisage. The second is more less of disruptions on global trade, movement of cargo, movement of goods, and we've seen that's led to a lot of delays, heightened freight costs, challenges in the global supply chain. So this is the second big impact that I see directly from an economy point of view. In terms of what impact it will have between the US-India ties, I clearly believe that this again augurs well for US-India's strategic ties. I mean, it's pretty well known that both the leaders, which is President Trump and Prime Minister Modi, both have a very good equation between the two of them, and these very good personal equation should translate into really strong strategic as well as business, economic, and trade ties between the two of the world's largest economies. So I clearly think, on the whole, this event yesterday augurs well for the world and for the global economy and for India in particular.
Okay. Nilesh, it's not that, well, the first term of Donald Trump, India and US had fabulous ties. It's not that the ties withered too much. There were some things here and there, but there were some large events in those 4 years as well that the Democrats were there in power. Is there a step up or a step down shift that you anticipate in any of individual policies which might have an impact? Or is it continuation of the recent ties that India and US seem to have developed, with US wanting to ensure that it doesn't antagonize both India and China at the same time, if you will?
So I clearly believe what is the most widely expected policy move by the Trump administration is likely to be a significant spike in tariffs and other trade barriers for China. That's something which has already been very widely debated and expected as well. And therefore, the China plus imperative becomes even more important for all global players. And I believe that this China plus imperative will actually become an India plus kind of a policy thrust, meaning thereby that it's going to become more expensive and less competitive for US companies to import from China. And I believe in the process that's going to directly benefit India, and India is expected to have a larger share of the import basket of the United States. So I think this augurs really well, particularly for the manufacturing sector. So that's really the big thing that I expect, that we will have to see what are the policy initiatives that can materialize in terms of directly the US-India side, but clearly believe that there is going to be a lot of collateral benefit which Indian economy and India's manufacturing sector in particular, which it can gain. Keep in mind, Neeraj, that in the last few years, we have been unrolling various initiatives to promote the electronic ecosystem, the semiconductor ecosystem, manufacturing of chips. And it's quite possible that in the next couple of years, we are going to make significant strides. And I think once we have an ecosystem on the electronic side, on the semiconductor side, which is beginning to take off, I think the US-India ties essentially will provide strong tailwinds for India not being able to just take care of its own domestic requirements, but probably being a meaningful player in the global arena. So I clearly believe that whole China plus or China plus should be seen more as India plus.
Noted. Okay. Yesterday, but just before I come back to manufacturing, yesterday, tech was the most sought after index, Nilesh. One, of course, it was a reactionary move, but was it a false reaction, or do you believe there is some method to that madness over a 6-month period, or that maybe corporate tax cuts and thereby some more spending, or maybe a stronger dollar and a weaker rupee, or a combination of these things plus just the cycle? What's your sense there on IT services or even ER&D and product companies?
That's honestly a great question, and probably the most relevant topic going forward. And why I say this is that when we kind of talk about IT services, we need to essentially kind of, bifurcate them into two buckets. One is really the top 4-5 companies, which you could call them as the large caps, mega caps. And then there are a whole bunch of smaller companies, which you could call them as tier 2 to maybe tier 4 companies. And that's a pretty large universe. Now, at the first level, in terms of what happened with the surge in stock prices across the board for the IT services sector, I probably think that was more like kind of a response to a strengthening of the dollar. And basically the Indian tech sector is going to be a direct beneficiary of that. It's not necessarily that all those benefits come in, but it can be material enough because the big IT services companies are probably growing at about maybe 4-5%. And so if you have another 2-3% coming in because of the dollar appreciation, it means a lot in terms of lifting the growth rate. But having said that, that's about it. That's really not the growth pocket or the growth bastion. The real growth lies in the other bucket, which is the tier 2 to tier 4 companies. And why I feel so strongly about this space, it's because, Neeraj, globally, the kind of investments which are expected in artificial intelligence is simply mind-blowing. And just to kind of put some things in perspective, for this year alone or for the next 1 year, just the big 4 technology companies globally are going to be spending $200 billion in just one single year on artificial intelligence. Versus that, the entire exports of IT services from India is about $250 billion. Okay, that's the kind of step up. Now, yes, the larger companies will have some role to play, but it won't move the needle materially for them. Whereas the tier 2, tier 3, tier 4 companies, they will benefit disproportionately from this. So whether we talk about companies which are specialized in ER&D or companies which are into providing AI, ML applications or providing big data applications or providing big data analytics, these are companies which probably today are at maybe $100-200 million in terms of revenues, but could potentially gravitate towards $500 million or maybe $1 billion revenues in maybe the next 5 or 10 years. Masayumi Som himself has said that, I don't know if that number was right also, Neeraj, but he thinks over the next 10 to 15 years, as the world tries to develop an ASI, which is artificial super intelligence, which is going to be 10,000 times more powerful than the human brain, he probably dished out a number like $900 trillion. Now, I don't know whether you forget $900 trillion, even if it's $9 trillion, that's a massive number. And the big beneficiaries would really be companies outside the top 5 or 6 companies in India.
Nilesh, I'm not asking, you know we never talk stock recommendations here, but just so that we can crystallize our thoughts, where within the Indian IT landscape do you find managements which are doing this? And by the way, I'm not asking you to name an exclusive list. It's not an exhaustive list, but is it mid-cap IT, the likes of Persistence, Emphasis, LTI is no longer mid-cap, excuse me. Is it that bucket? Is it ER&D stocks like Tata Technologies or KPIT or LTI? Where is it that you find this opportunity, or is it completely different companies that don't come into mainstream conversation nowadays?
It's all of these companies which you mentioned, Neeraj. It's going to be all of these companies which you took. But I just want to drive home a point or make an important point that as you probably go down the pecking order in terms of the size of these companies, maybe that's where the impact would be the highest. So Neeraj, the winning mantra is going to be to really kind of carve out this universe of companies and then look out for companies which probably, the names like the names which you kind of alluded to have probably got significantly re-rated. But I still think below this very list of names, down below would be a bit of the companies which are relatively smaller than the 4 or 5 names that you mentioned. And within that, if you can spot companies which are going to have a disproportionate amount of their revenues from these newer areas versus the legacy areas, those are the kind of companies which will benefit. So typically, Neeraj, it would be essentially kind of trying to figure out the companies which would probably kind of grow at a hyper pace over maybe the next 5 years. And when I say hyperpace, which means if the larger IT companies are going to grow at 5%, the names that you took are probably going to grow at 10, 12%, but there are likely to be companies which will probably grow north of 20%. In terms of the revenues and maybe be in a position to even expand margins. And that's really where a lot of the delta will creep in. And that's really what is going to result into alpha for investors.
Interesting. Okay. So that's as far as services go. Nilesh, the other point is, and then I want to get in my colleague Mihika to talk about manufacturing in Hindalco, because the China NPC thing is the other thing. But just on this topic, until recently, Nilesh, the belief was for a lot of people that look at the inward facing sectors, because domestic is a lot more predictable than global. Has yesterday's move, coupled with the fact that domestic is going through a bit of a slowdown as well, has that changed it, that maybe the portfolio should be evenly balanced and you should have enough presence of the outward facing sectors as well, be it technology, be it pharmaceuticals, be it chemicals, or maybe some of the manufacturing companies which are catering to the global markets?
Sure, Neeraj. Again, yeah, that's massively pertinent, especially in context of what's happening. Clearly, the domestic-driven businesses essentially have very strong tailwinds. I mean, undoubtedly. Okay, and it's going to be a mix of both the domestic-facing businesses as well as the export-oriented businesses. But clearly believe that the universe on the domestic side is significantly larger than the universe on essentially the global side. And if I were to kind of look at three big opportunities, Neeraj, as we as investors, I think one is going to be around the conventional consumer stuff. And when I say conventional, I mean the opportunity consumer. I'm not talking about the conventional companies. The second is around fintech, and the third is essentially around artificial intelligence. And the one around AI is something which we just kind of discussed. And that to me is the most attractive opportunity from a global perspective in terms of the global market. I think back home, keep in mind that India and the Indian economy, and I think this is not just going to be relevant for the next 2-3 years, but maybe for the next 5, 10, 15, 20 years, I think it's a generational opportunity, which is around urbanization and around digitization. These two essentially are going to be the most powerful themes, which will play out in India over the next few years and maybe over the next couple of decades. And therefore, domestic facing businesses which are able to kind of ride this wave of urbanization and this wave of digitization are going to be the challengers to the incumbents, and therefore they will be the winners of today and tomorrow. And therefore, I think it's important that when you kind of look at any domestic facing business, be it financials, be it consumer, the most relevant question that we as investors need to ask is this business a challenger, or is this a business which is going to get disrupted? And I think the big players in this space essentially are already getting challenged by smaller but more agile players who are able to embrace technology, embrace digitization, and provide cutting-edge solutions to the consumer segment, and are becoming category-defining companies. I think that's really where a fantastic opportunity lies ahead for us as investors.
Yeah, actually, maybe just one follow-up on that, and then I go to metals, which is the talking point today. Mihika, I request you to stay on for a moment, but I want to ask Nilesh this one more question. Nilesh, for years now, FMCG has enjoyed very strong return ratios, great multiples, great margins. I think you were making the point earlier that at some point of time, companies outside will see these numbers and come to dent those numbers because they would want a piece of the pie as well. We've seen e-commerce companies maybe do some bit of that, category defining companies maybe in consumption. I don't know if you're referring to FMCG disruptors, but maybe some of those companies have done that too. Do you see more of this happening? And therefore, would pure play FMCG, the HULs, Nestle's, Daburs of the world, are they under a bit of a cloud, if not for earnings downtake, then valuation downticks over the course of the next 3-5 years?
Absolutely, Neeraj. I mean, there's clearly no doubt in our mind about this to happen. It's almost a very predictable and almost a certain event, and that's because these are kind of very companies which have essentially enjoyed benefits in the past because of their distribution reach Now that distribution reach is no longer a moat. It is an era of D2C companies where smaller, smarter, agile companies, well-funded companies essentially are coming in, identifying the niche and essentially coming and challenging the incumbents and the very large players in every segment. So if you look at the conventional FMCG companies, Neeraj, traditionally, I mean, over the last 10 years, several of these companies have just grown between 5 to 8% in terms of their revenues. And if you adjust for inflation, then in real terms, there's probably been very little growth. And if you again strip out any growth which is coming from acquisitions, then the organic volume growth has probably not been there in a significant manner over a period as long as the last 10 years. So I think one has to keep in mind, and still, I think if we look at each one of these categories, and I'm not restricting oneself to just FMCG, but consumer as a pack, I think we have had some homegrown companies which have either recently IPO'd themselves or who've been around for a while, which are challenging some of these multinationals, the very large multinationals who probably dominated the Indian consumer market for maybe the last 3 to 4 decades. And I think that's really where the opportunities. Look at alcoholic beverages. We have the 2 big global giants who probably are growing in single digit, and then we have a couple of homegrown players which are growing in double digit. You look at biscuits as a category, okay? You look at dairy as a category. Some of these categories essentially are where you have individual category defining companies, and that's really where the opportunity. Again, BPC, I mean beauty personal care as a segment, again, that is a very promising segment. And again, out there you have a smaller player who's come in and challenging and disrupting the established brands and the incumbent brands, and that's really where the opportunity is. So I don't think one should write off consumer and FMCG. In fact, it remains a very exciting kind of area, but that whole approach of just going out there and buying the big boys, I don't think that approach has worked, and I don't think it will work going forward as well for the foreseeable future. Really, I think the key lies in stock picking and doing a bit of cherry picking there.
By the way, the wellness industry, viewers, is probably now bigger than the sports or the pharmaceutical industries. It was probably big in 2023 itself, and might be bigger, and all of these come into that bucket too. Okay, let me get in Mihika to talk about the big mover of trade today as well, because that's going to be my next focal point, the China NPC meet and what it could do to metals. But Hindalco is down for reasons of its own today, Mihika. Sharp gash today.
Good morning, Neeraj. So 2 main reasons. So, and this is all related to its international subsidiary called Novelis. Now, Novelis reported its Q2 FY25 earnings, while net sales were up 5% year on year. Their adjusted EBITDA was down 5% to $462 million, and net profit was actually down 18% at $128 million versus $57 million a year ago. What impacted profits is a charge of $61 million due to the production interruptions of Sierre plant, and this was due to flooding in the area, and the impact of this shutdown will continue to the end of 2024 is what the company has said. Another factors that impacted the earnings were higher restructuring and impairment expenses as well as lower operating performance. And the one that stands out in terms of the commentary that the company has given is they've suspended their near-term margin guidance, and this is related to adjusted EBITDA per ton guidance, and they're going to wait until further clarity on metal markets, and they expect margins to contract sequentially in the second half of FY25, and this impacts Hindalco Industries as well as their overall growth for the second half of the year. Why has the guidance been suspended? Because of higher aluminum scrap prices, which have been rising due to intense competition on the back of China's policies. And Novelis products, around 60% of their content is from recycled content, and that's why their input costs will gain. And when you talk about why Novelis is important for Hindalco Industries, which is what we're seeing reacting today, well, Novelis accounted for 61% of Hindalco's consolidated FY24 revenues and and it also accounted for around 56%, which is more than half of Hindalco's EBITDA in FY24 as well.
Okay, thanks, Mihika, for that. And Nilesh, come in here. I mean, an EBITDA guidance pullback notwithstanding, we have this big Chinese NPC meet underway as well. With Donald Trump in the saddle, would China be forced to give out a much larger stimulus than otherwise anticipated? Could it be positive for metals? Is it just a tactical call, or is there fundamental merit in trying to own any metal names?
Neeraj, we've not been very big believers in metals. These are very cyclical industries which get governed a lot by policy changes, interest rate movements, And at best, they are a bit of a catch-up on inflation. So I think we just think of these as basically an inflation catch-up trade and nothing more than that. And so to that extent, we are not very enthused by the space unless there might be an individual company or an individual player which is undergoing some bit of restructuring, which essentially can be a bit more of value enhancing kind of opportunity or a special situation. But beyond that, we're not very big believers in owning commodity stocks. We just believe that their managements have very little role to play apart from driving efficiency, but they really are in no way to control their realization. So I think, honestly, apart from being any kind of tactical or trading opportunities, we really are not big believers in owning metal stocks for the very long term. Well, let's see how things play out. But I think we've already seen some run up in metal prices over the last few years. So I really don't think there's kind of more potential from here on. And keep in mind, the other thing is the dollar is strengthening, the dollar X is strengthening. And when that happens, typically metals tend to kind of weaken a bit. So one needs to just kind of be a little cautious on there.
Last question, Nilesh, and that's on because you alluded to manufacturing in some fashion. But yesterday, the EMS stocks really got a big shout out. Now, because I know you at times, or most of the times, think about things not from a 1 year, 2 year perspective, but a really long perspective. To an average Joe, EMS stocks started the rally in 2020, have rallied significantly, और क्या होगा? I would like to know if you think about it that way, or do you think that the best is yet to come?
No, Neeraj, I think by and large they've run course, the EMS companies, especially the kind of valuations at which they are trading in. Keep in mind that yes, there is still top line growth, but the margins still are kind of relatively low, and the pace at which they will have to continue to grow, they will need a lot of capital. And when businesses need a lot of capital, they don't end up being great businesses over the long term. And especially at these kind of valuations where maybe some of these are trading at some 100, 200 PE, I don't think it's a great place to be in. I probably think that there are better opportunities on the manufacturing side, and especially areas like decarbonization and energy transition are where valuations are still kind of meaningful in context of the kind of growth which lies ahead. So probably that's a better pocket to bet on today versus the EMS space.
Nilesh, take a moment to thank you for joining in today. Really appreciate your time, and have a great new Samvat.
Thank you so much, Neeraj, and wishing you too a great Samvat, you and all your team and the entire viewers and their families. Thank you so much.
Thank you. Really appreciate your time, and viewers, thanks for tuning into this edition of The Talking Point.
Co-powered by Canara Bank. Together we can.
Nifty Sensex snapped two-day rally and settled over 1% lower on profit booking. All sectoral indices ended in the red, with metal dipping nearly 3%. Westside operator Trent falls 9% despite 47% surge in net profit in Q2 earnings. Chairman Noel Tata says retail business has taken a hit. Mahindra & Mahindra reports strong second quarter earnings, margin expands, profit surges 13%, beating estimates. Jet Airways' last hope for revival extinguishes as Supreme Court orders the airline into liquidation, rejects takeover bid by Jalan Kalror Consortium. In a major blow for Anil Ambani, R-Power is barred for 3 years as government cancels solar bid over fake documents and fraudulent guarantees. Most tax provisions before assessment year 2012 to 2013 could be declared redundant. Provisions for exemptions and deductions could be eliminated from the IT Act. It's an NDTV Profit exclusive. After Salman Khan, film star Shah Rukh Khan gets threatening call. Mumbai police registers case, reaches Raipur in Chhattisgarh to trace the caller. US Federal Reserve is set to announce its interest rate decision today. A second straight rate cut expected after the Fed's decrease in September. Hello and welcome. This is Profit 360 on NDTV Profit and I'm your host Himakshi Bahuguna. Along the next half an hour, we'll bring you the latest on the markets as well as national and international news. So Nifty Sensex snapped a two-day rally and settled over 1% lower on profit booking. All sectoral indices ended in the red, with metal dipping nearly 3%. Neeraj joins in with a wrap of all the action of the bourses.
Aptly, a day of profit booking. There's nothing too untoward about this. A 1% corrective move can happen on any given day, and that it's happened a day after the Indian markets had such a strong up move, and the fact that the world markets by and large this morning, except for the US markets, had a negative Q. This is probably acceptable. Just that the nature of the quantum of falls that have come into some of the stocks make you believe that the gashes would be much deeper. So I'll come to that in a moment. Mid caps and small caps did okay, by the way. They didn't do as badly. Let's put it that way. 0.5% for the mid cap index, small caps 0.62%, not as bad as the large caps. In fact, maybe this worsened a bit because until about 2:30 p.m., the small cap index was down maybe 0.26% or thereabouts. The breadth was weak and widened, as I said, during the last half an hour to 1 hour of trade. Now bring up the heat map and look at the quantum of red and look at the gashes, and you would feel that the index would have been down maybe a couple of percentage points. It wasn't. Lightweights cracking. Hindalco on the back of Novelis numbers down 8%. Trend on the back of its own numbers down about 6%. Shriram Finance, Grasim, Adani Enterprises, Tech Mahindra, Tata Consumer, fairly varied. But just look at the quantum of red here, and then contrast that with maybe the gainers. The first one is Apollo Hospital, 6.5%. The next one, SBI, just 0.4%. Just went to show that there was no zeal in the market. Apollo had only a result reaction to it. Otherwise, the markets were absolutely flat. Now, mid caps and BSE 500 winners and losers list will come up on your screen. And we're not quite seeing the same dichotomy in the sense that there are enough large caps or enough mid caps which have gained well too. Look at ITI, look at DCM, Shriram, it's been on a bit of a roll. Swan Energy moved today off the highs of the day. Eureka, Forbes, Nykaa moved about 6% today on a brokerage note. Stocks like Trent fell. Adani Energy fell because it was not included in the MSCI index. Blue Star on the back of the numbers, and a few others like Alembic and FTC2 correcting. But it's a day of expiry, so to be taken with both hands. Tomorrow very likely will be a slightly different day.
What should your Trump trade be? Saurabh Mukherjee of Marcellus Investment Managers spoke about the select IT stocks that you could look at.
Given his historical hawkishness vis-a-vis China, given that he's said things like 60% tariffs and so on, I think it's reasonably straightforward that we increase our China plus one investments, and there's a fair bit of that in our Indian portfolio. So I'm sure those watching would have heard me talk about Divi's Labs over several years now. So it's been roughly 18 months since we tripled our investment in Divi's, and China plus one is working out nicely. There are smaller investments that we made on that theme, Polymedicure being another one of them, which is catheters, dialysis equipment, dialyzers, basically hospital equipment. China dominates the world in APIs. Hopefully Divi's will get a bigger chunk of that. China dominates the world in medical equipment. Hopefully Polymedicure will get a chunk of that, right? So there's a number of other such plays in India which should do well as Trump presses the China plus button that much harder. The second reasonably straightforward investment, I think, is American and North American cyclicals and North American industrials, to be specific, right? So we increase our exposure to that because he's been very clear that he wants North America, specifically USA, to industrialize further. So if USA industrializes further, then investments of ours such as Parker Hannifin, which is the industrial supplier, should benefit. And this seems to me to be these two bets, I think, are reasonably uncontroversial. Quick disclaimer, I'm invested in all of these names through Marcellus, so are my parents and my clients.
Here's investor Mark Mobius speaking about what's expected from the Trump administration in terms of policy changes and its impact.
U.S. economy resurging. There will be a strong U.S. economy. And the reason is that Trump will institute significant reforms, particularly deregulation. The thing that has held back many American companies, and for that matter, foreign companies operating in America, is the high degree of regulation around the environment, around safety, around money, particularly money flows have been very, very restricted as a result of the implementation of anti-money laundering and all the other ways that the government has tried to restrict the flow of money. In fact, they've weaponized the U.S. dollar. And that has been bad for the U.S. dollar, by the way, because at the end of the day, you're seeing the BRIC countries say, oh, we don't want to use the U.S. dollar anymore because it's so restrictive. We can't do anything. Now, Trump is going to try to end that because he realizes that a dollar that can be used globally and is successful and popular globally is very good for the U.S. economy.
Trent reported its Q2 earnings but saw fall in trade as company missed its Q2 analyst estimates. Even Noel Tata, chairman of Trent, also commented on company's weak Q2 performance. To know what triggered this fall, my colleague Mahima joins in with more details.
We've seen a growth of 39% in revenue, 41% growth in EBITDA. Margins have improved a tad bit, and net profit has seen a 47% growth. But a couple of reasons why Trent is falling so much in trade today. First of all, the commentary that is coming on from the management has been weak. Secondly, it has missed estimates on all fronts. The street was expecting a better performance from Trent, which is why the stock is also falling. Thirdly, revenue growth in the past 4 quarters has been over 50%, but this quarter it has been around 39%. Which is why the street is upset. Even in terms of the like-for-like growth, this time it has been around 14%, but if we check the past 4 quarters, it has been around and over 20%, which is why, which is one of the reasons why Trent is falling so much in trade today. And in terms of weak commentary coming in from management, Noel Tata has said that weak consumer demand and seasonality has led to headwinds for the retail business, and they're seeking to explore additional avenues for growth going forward. And in terms of, the stores opened also, the street was expecting more store additions in terms of Zudio and Westside as well. But that has also, come off as per the street expectation. And Star Bazaar, which was posting a good strong growth, which has posted a strong growth in the past quarter, this quarter comparatively has not grown so much. So these are the couple of reasons why Trent has seen so much fall in trade today. And of course, Trent overall, if we see in the past 2 to 3 weeks, has fallen over 22%. So it's if we can say the darling of the street has seen a lot of fall in the past 2-3 weeks itself.
Mahindra & Mahindra reported Q2 earnings and the profit has clocked growth on the back of higher sales of SUVs. My colleague Puneet joins in with more details.
Mahindra & Mahindra was buzzing in trade today on the back of a strong Q2 earnings that the company reported. Now, it reported roughly 13% of revenue growth on a standalone basis, with its EBITDA growing by 30% in this particular quarter. Margins also came in at roughly about 14.2% compared to 12.3% in the same time last year, as well as beating Bloomberg estimates of about 13.8%, while net profits also grew by 13%, coming in at roughly 3,800 odd crores versus Bloomberg estimates of about 3,500 crores. Now, in this particular quarter, it sold about 1.3 lakh passenger vehicle cars, which is the four-wheeler cars, on the back of strong demand, which was up 18% compared to the same quarter last year, while its farm equipment business, which is the tractor business, reported numbers of about 93,000 units sold in this particular quarter, a growth of 4%. Now, in terms of guidance, the company has guided for a mid to high teen growth for a full year guidance, and they've also said that the inventory after this particular quarter and the festive period is at a very good festival offtake and is at a very maintainable level below the 30 days. That's one of the key factors because the PV industry has been grappling with high inventory, so definitely a big positive on numbers as well as inventory picture as well.
Onto a primary market update, the IPO frenzy seems to have calmed down a little, starting with Swiggy. The public offering is seeing muted demand, with it being subscribed 34% as of 4 p.m. on day 2. Sagility's IPO has been subscribed 3.14 times as of now on its final day. Aquis Solar Holdings IPO was subscribed 66% on day 2, and Niva Bupa Healthcare, whose IPO opened today, saw subscriptions of 64% as of now. Global index provider and research firm MSCI's changes into its indices are likely to bring passive inflows to the tune of $2.5 billion to India after the latest tweaks come into effect on 25th November. Consequently, India's weight in the emerging market index is expected to increase to 19.6% from 19.3%. Among stocks, key changes include 5 company inclusions and no exclusions. These names include Shriram Finance, TVS Motor and CG Power to MSCI India's large index, and Oberoi Realty and Alchem Labs included in MSCI Index Mid-Cap Index. HDFC Bank holds the highest weightage among Indian stocks in MSCI indices at 7.08%. The last hope of revival for Jet Airways has vanished as the Supreme Court ordered Jet Airways into liquidation after finding that the winning bidder for the airline, the Jalan Kalrock Consortium, failed to implement its bankruptcy resolution plan. My colleague Varun Gakar joins in with a detailed report on the case.
In a big ruling in the aviation sector, the Supreme Court has used its extraordinary powers to order the liquidation of Jet Airways. Now, the top court made it clear that the Jalan Kalrock Consortium, which was the successful resolution applicant for the Jet Airways, failed to implement its resolution plan as per the terms mentioned in it, and said that since the resolution plan is incapable of implementation now, the court said that at least the avenue of liquidation must stay alive. The court flagged off the sanctity of timelines prescribed under the Insolvency and Bankruptcy Code of India and said that nearly 5 years have passed since the company was admitted into insolvency. However, no major inroads were made for the implementation of the plan by the consortium. As a result, the court has set aside the NCLAT order, which gave a go-ahead for Jet's transfer of ownership to the consortium, and said that the order was in flagrant violation of an earlier order of the top court. With this, the appeal by the State Bank of India, which was the primary lender in this case, has succeeded, and the NCLAT order, the amount of rupees 200 crore deposited by the Jalan Kalrock Consortium, stands forfeited. Now, the liquidation process will now be taken over by the Mumbai bench of the NCLT, who will appoint a liquidator for the process.
In a major setback for Anil Ambani's Reliance Power, the government has cancelled their bid for a solar power project after it was revealed that the company submitted fake email IDs and fraudulent bank guarantees. The bid manipulation attempt has led to R Power being disbarred from participating in future government tenders for the next 3 years. My colleague Vishwanath Nair joins in with a detailed report.
So what has happened here is that essentially Reliance Power, which is an Anil Ambani-owned company, has been exposed for participating in a bid process with unclean hands, essentially. What they have done is that they've submitted certain documents which prove to be false. Now, I'll take you through what exactly happened in this entire story. Essentially, the Solar Energy Corporation of India, SECI, which conducts all the tenders for the government with respect to solar power projects, had conducted an entire bid process back in June of 2024. After that, essentially, certain discrepancies were found with Reliance Power's subsidiary and the way that they have submitted the bid. What exactly they did was that they submitted a foreign bank guarantee as part of the earnest money deposit that they have to do. This foreign bank guarantee was supported by SBI. That's what Reliance Power subsidiary had claimed. What SECI in its investigation found out was that there was a specific email ID through which an email was sent from SBI supporting this bid. However, that email ID turned out to be fake. Now you can see in this in the graphics on the screen, the email says S-BI, which is a very clear indicator that this was probably a fake ID. Next, what happens is that SECI pulls up the company. What it does is goes to SBI, and SBI confirms that this email ID was fake, that they have not supported the foreign bank guarantee that the Reliance Power subsidiary submitted as part of the bidding process. Next, SECI essentially decides to cancel the entire tender process because there were issues with the way a bidder had participated in this entire process. What sources are telling us also is that Reliance Power had actually won this bid, and after that, this has been cancelled and that bid has been pulled back. Reliance Power has on its part blamed a third-party arranger, saying that they had given them the fake bank guarantee in place, and the company did not know what actually happened on ground. But SECI has, of course, barred Reliance Power and all of its subsidiaries from participating in any future tenders for 3 consecutive years. So that's an important sort of announcement that coming from SECI this morning. They put out this notification on the website saying that Reliance Power and its subsidiaries will be completely barred. This is an important move specifically because you can see the comment that SECI made in its notice. It said that what it had discovered is that as part of the tender requirements, the endorsement of the bank guarantee against it was fake, and that was an issue. What they've also pointed out is that they have concluded, and it's logical to conclude that any action by the subsidiary of Reliance Power would have been done on the orders of Reliance Power, and therefore they had to bar the parent company as well. Important simply because Reliance Group, the Anil Ambani Reliance Group altogether, has been facing a lot of setbacks on most fronts, actually. If you were to look at an order by the Securities and Exchanges Board of India, they have barred Anil Ambani and certain other members with the Reliance Group from the securities market for 5 years. They had also levied a 25 crore penalty, which was, of course, removed by SAT. That case is still ongoing. Apart from that, you've had insolvencies of multiple Reliance Group-owned companies, specifically Reliance Communications, Reliance Capital, as well as Pipavav Defence, or what is now known as Reliance Naval and Engineering. So all of these companies are already under insolvency. This is another major setback for Anil Ambani.
Sources exclusively tell NDTV Profit that a comprehensive review of India's direct tax framework is in progress, with major changes coming up. Provisions in the Income Tax Act, especially from before 2012 to 2013, may soon be dismissed. The government panel has also formed 22 subcommittees to gather suggestions from stakeholders by month's end. My colleague Shrimi joins in with a detailed report. Shrimi, so could we be on a brink of a tax system overhaul?
Income tax review, which is undergoing and expected to, be presented in the upcoming February budget. What we are picking up from our sources that most of the provisions and sections before assessment year 2012-2013 could be declared redundant. These sections spread across major segments and sectors, including telecom, capital gains, and many more. In fact, these section could be removed completely from the IT Act. However, there are certain exemptions also which you could see in the review exercise of Income Tax Act, where they are saying that those sections which is related to investments, related to searches, notices will continue, particularly the tax-free bond, the provisions which is related to tax-free bond will continue and will not be considered as redundant, is what we are getting sense from our tax sources. So government so far, the panel under V.K. Gupta, senior tax official, has asked for a report from all across the official. They have made 22 sub-panels which are going to submit their reports by month end, where they are going to suggest what all section will be removed, how those will be simplified, and that will be the part of the comprehensive review of Income Tax Act.
Onto the NDTV Profit exclusive, sources say that gas ramp up from ONGC's KG block may see more delays. Vikas, tell us what are you really gathering from your sources?
The thing is that this KG block was one of the largest discoveries by ONGC in the recent time, and it was launched by much fanfare in 2018. But since then, the ramp up that was expected in gas production, as of now, they are only producing 1.5 MMSCMD, and this was expected to reach its peak capacity of 10 MMSCMD by 2024. But because of various challenges that the company faced as far as supply issues were concerned for supply of their rigs or platforms, the company has not managed to get it from their Malaysian vendors. They were the bidders who got the contract for supplying the platform, but that has not received by ONGC yet, and this is likely to come only by March, April next year. So the company was expecting to reach at least 5 MMSCMD by May this year. Now that 5 MMSCMD will happen in May, June next year, and the company is hopeful of reaching 10 MMSCMD only by December 2025. When we tried to reach the company spokesperson, they did not comment on the story as of now, but they told me that they will be giving their comments later during the day. So we'll be waiting for that. As far as this block is concerned, this block is having a reserve of 2 trillion cubic feet of gas, and once it produces at 10 MMSCMD, it will contribute almost 7% of India's total requirement of gas consumption. India's total gas consumption is close to 187 MMSCMD per year, and almost 53% of that was imported from abroad. So once this comes to peak production and also Reliance's contribution from nearby fields, India is likely to keep its imports to 45% in coming years. At least for next 2-3 years before the demand increases, India is likely to keep the imports at 45%. So this is likely to be a very good discovery, and once it comes to production, it will add to both the companies and India's overall requirements.
US Federal Reserve is set to announce its interest rate decision today. A second straight rate cut is expected after the Fed's decrease in September. Pallavi joins in with what can be expected.
The US Federal Reserve is expected to cut rates by 25 basis points this time around. That's compared to a 50 basis points rate cut we saw at its last meet. Now, since the central bank has kicked off its much awaited easing cycle, news on the economy has broadly been strong, though we have occasionally seen mixed indicators as well. However, given the scenario currently, what's also important is what Donald Trump believes in terms of interest rates and his views on the Federal Reserve. He has been fairly vocal about these in earlier instances, and he does think that the president should be able to at least tell the Fed what he thinks in terms of the interest rate trajectory the Fed should opt for. Now, just to be clear, the Fed chair and the other 6 members of its board of governors are nominated by the president and are subject to confirmation by the Senate. In his past term, we did see President Trump nearly pushing the Fed for easier money, even demanding negative interest rates once rates sat near zero.
The Jammu and Kashmir Assembly saw stormy scenes as a fist fight broke out. The scuffle took place after Khurshid Ahmed Sheikh, the brother of jailed Baramulla Lok Sabha MP engineer Rashid, displayed a banner demanding the restoration of Article 370. This incident happened amid the ongoing 5-day session of the Jammu and Kashmir Assembly. This assembly commenced on Monday for the first time after a gap of 6 years. Bollywood actor Shah Rukh Khan has also received a death threat over a phone call. Mumbai police filed an FIR and traced the number. The Mumbai police has reached Raipur, where the actor received a threat call from a youth named Faizan. This incident follows a series of death threats and extortion attempts aimed at Salman Khan earlier this month. Now let's turn to some exciting news for the startup community. A brand new startup accelerator program called Tech Expedite by Games 24/7 was recently launched in Bengaluru. Here's a special report.
Bengaluru was host to the launch roadshow event of Techspedite, a brand new startup accelerator program organized by Games 24/7, a tech company in the business of online gaming. The goal of this program is to provide support in terms of mentorship, networks, funds, and infrastructure to budding Indian startups in the fields of artificial intelligence, gaming, and inclusive and assistive technology. The program was endorsed by Shri Priyank Kharge, member of the Karnataka Legislative Assembly and Honorable Minister for Information Technology and Biotechnology.
This launch marks an important milestone in fostering innovation and technology advancement, and I'm thrilled to see Games 24/7's unwavering commitment to India's startup ecosystem.
Highlights of the launch included knowledge transfer and mentorship happening via the fireside chats and discussion panels held.
Technology being the front and center of everything that we're doing is what really gave rise to our thinking that, hey, yes, we're operating in the gaming space, but we're really building technology solutions. And therefore, why can't we use everything that we have learned to give back to the community?
Techspedite is a 60-day accelerator program, and the goal is to turn ideas that show promise into thriving and sustainable businesses.
The startups have the potential to really take the India story and transforming it, and also positioning India as a global leader in innovation.
With startups, business leaders, investors, VCs, policymakers, and other influential industry players bringing energy and vision, discussions around innovations in digital India's expanding startup ecosystem were highly promising and full of potential.
I look at AI as a challenge and an opportunity in India, because a lot of India-centric problems which AI can help solve. For example, health.
We are a large country with unique problems, and we have the opportunity to find those solutions and then export them abroad.
If you are a startup, this could be the ideal platform to launch your journey and propel your ideas to new heights. Selected startups can avail exciting benefits like over 500K in tech credits, participation in a demo day, fundraising opportunities, and access to a powerful network of industry leaders. So if you're a startup in the AI, gaming, or inclusive tech domain, this could be the perfect launchpad for you to turn your vision into reality. Keep watching the NDTV network to find out about developments from Techspedite.
That's all the time we had on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Well, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards...
Simplifying futures and options trading.
Don't worry about the future.
Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. Over the next 25 minutes, we'll talk all about mutual funds. But first, we have an exclusive story for you. October retail flows into mutual funds have stayed the course, or in fact have gone up higher. My colleague Sajid Johnson with all the details. Sajid.
I've been talking to the mutual fund industry, and they've been saying very categorically that net inflows into equity schemes have been to the tune of 30 to 35,000 crores in October. Now, this is similar to what we have seen in September and August, and that number continues to be there, and there is no disturbance to this net inflows coming in because of the correction we have seen. Now the indices, to give a perspective, indices have fallen by nearly 10% from their tops, and a lot of volatility has happened. But retail investors have continued to pour in money into mutual funds. On a gross level, it's around 60-65,000 crores which have come in. There has been redemptions which have been at par with every month of 25 to 30,000 crores, and net flows which is coming in is around 30 to 35,000 crores. Now, AMFI will come out with the numbers in the next couple of days, but what we understand is that this flows continues. And what is important is that SIPs are continuing. Say 40 to 45 lakh new registrations are happening every month, and that continues in October as well. And the spread of the SIPs or the flows which are coming into into the industry or mutual funds is across the month. So it's not that that is happening in the first 10 days or 15 days of the month, and that's the reason why the flows have come in, but it's spread across. A lot of digital channels have been used, and so the money is coming in as we speak. We also understand that of this 35,000 crores, 1/3 have gone to sectoral and thematic funds, which is the theme for the last couple of months, which has been there, and then followed by multi-caps, flexi, small cap and mid caps, which have seen it. Now, to give a perspective, we had nearly 33 NFOs that came in the month of October. 2/3 of them, around 22 of them, were index fund NFOs which came in. So, thematic wise, there hasn't been many equity fund launches which have happened, but you adjust for that NFOs which are coming in and the flows which are coming because of the NFOs, the fund flows have been normal as compared to, there's no disruption to the retail flows.
Sure.
In perspective, DIS invested 1.07 lakh crores, and mutual funds alone invested 94,000 crores in the month of October. That's 3 times what we saw in August or July or something.
Okay, Sajid, you may have questions for our guests. Stay on for a bit. Let's get in. Saloni Sanghvi, founder of My Wealth Guide, and Santosh Joseph, founder of Germinate Investor Services, on the show. And to both of you, thanks so much for joining in. Happy New Year, of course. And a lot of people say that investors should be handheld during tough times. I think that would have done with finesse by people like you, because the inflows, as Sajid has figured out, into October, which was considered to be a pivotal month, considering that they've been very volatile, the markets, the inflows look rock solid. So kudos on that. Just a bit of this before we get to our topic of how to design funds. Saloni, I'll start with you. Did your set of investors or people that you are your clients, did this show some thoughts of stopping their SIPs or redeeming some of the funds because the markets were volatile in the month of October, or not really?
So I think what has happened is a lot of investors, have started their investing journey in 2020. So, what they've seen is even if the markets have fallen, they've recovered pretty quickly. So I think what the mindset has changed in the sense that if markets are falling, it's a good time to actually add funds. So a lot of our clients have actually amount of funds to take advantage of the market fall.
Okay. Santosh, what about you? What's your experience been? Did investors show the propensity to take money off the table, and did you have to handhold them very carefully, or was it behavior as usual?
Hi Neeraj, quite the contrary. I'm brimming with happiness to tell you, October 2024 has actually been one of our best months ever in terms of net inflows and net investments. Now, initially, we were also a little, worried about how investors would behave considering how October started. And, you have too much going in the markets in terms of news flows and volatility and war and, the American elections at hand. But we registered one of the best months in recent months and years. So therefore, we've seen great exemplary activity by investors to, number one, stay put, number two, stay strong, and three, to add more.
This is music to the ears, and this is music to the ears simply because it shows the behavior of the Indian mutual fund investor. And I think, a lot of people talk about whether there is, at what point of time will the Indians be over-invested in equities. I think we are multiple years away from that, so no issues right now. But having said that, because it's been a volatile month, I think it becomes important to try and understand how should people design a mutual fund portfolio for the current times. I mean, should there be changes made relative to what has been the case in the recent past? Now, Saloni, I'll start with you. It's impossible to predict whether we will have a V-shaped recovery again or no. It may happen, it may not. So therefore, for somebody who is coming to you right now, Saloni, and asking how would you design a portfolio of funds to suit the current times as they are right now, and keeping an eye in the future, of course, what would your advice be?
If somebody comes to me now with their portfolio saying that this is it, what should I do? Should I make changes? I strongly believe that one should invest basis their asset allocation, which is derived from the amount of risk they're comfortable taking and the time that they're going to stay invested. So the time that they will need to withdraw the funds. So it is very important to kind of make sure that you stay within that asset allocation, because equity is not a short-term investment. When you're looking at an equity investment, you're looking for at least a 5-year horizon, if not longer. So just to give you a sense, say if someone has a more conservative risk-taking, ability, and they're looking at a 5 to 10-year kind of horizon, then maybe they should stick to, large cap, flexi cap, or index funds. For someone who has a more balanced risk-taking capacity, they can also look at adding mid-cap funds to that. And only for those who are extremely aggressive and have a 5 or a 7-year plus kind of horizon, then, we can also add a little bit of small cap in that case. So I think the investment strategy and the portfolio has to be driven by each person's risk-taking capacity and the time, rather than simply just what is happening in the markets around. Because if you look at the markets around, we saw the Russia-Ukraine war, we're seeing a lot of geopolitical events happening right now. And that happens every single year. There's always something happening. So you cannot make portfolio decisions basis that.
Okay. So that's the opening amble, and I'll come to specifics as well. But Santosh, I'll come to you with the same topic. Would the strategy of building a mutual fund portfolio currently be different as of now versus what it may have been, say, 12 months ago? Why or why not?
So Neeraj, interestingly, October 2023 was also a very volatile month. It started on the 7th of October when the Israel-Hamas war started, and it peaked out on 23rd of October. We had a 10 to 12% correction, so identical to how October last year and this year has been. Now, your question is extremely good for all our viewers, because in moments like these, where you have so much of news flow and so much of volatility, it is going to be most appreciated to ask that question: how do we build a portfolio? While I absolutely agree with just what Saloni so wonderfully put it together, saying that irrespective of the events and market activity, you build your portfolio based on your individual risk and reward profile along with the time. Now, it's a nice reminder in events like this that you stick to the basics. That is, do not let the news and the immediate actions change your investment behavior. Stick to the fundamental aspects of asset allocation, knowing for what you're investing and the risk category and the asset quality. Now, Only in times like these will we pay attention. If the markets were buoyant and if the markets were extremely exuberant, like how it was a little before the last month and a half, there was no caution to any of these metrics. But today, I think people will appreciate and understand it better. For all you know, maybe November, December, like the way it happened last year, markets can, in what you were trying to say, could be a V shape, may not be a V shape. That doesn't change how we build robust portfolios.
So now I'm going to ask you pointed questions. Santosh, I'll start with you. Add hybrid funds, yes or no?
Absolute yes.
Why so?
See, hybrid funds today give investors, whether old or new, the opportunity of getting asset allocation pre-mixed into their investment. Having some bit of fixed income today or any given point of time is good. You can decide in the hybrid funds what type of fixed income exposure and what percentage, and if it's going to be dynamically managed or not. Building hybrid funds is the good way to do it, because even if you don't buy a hybrid fund, you at any point will have to build a hybrid portfolio of mix between equity and fixed income, or maybe a third asset class. So therefore, an absolute yes on hybrid. You choose the hybrid breakup for your convenience.
Okay. Saloni, is that the better way to do debt allocation in the portfolio, or would you add directly debt funds, pure debt funds? Why or why not? Also, Saloni, the timing, considering that the Fed may do what it does, the Indian RBI may do what it does, should one add debt funds at the current juncture?
So ideally, people should invest basis their asset allocation. So, the mix of debt and equity. But what happens in reality is a lot of investors don't follow asset allocation because they may not know how, or they lack the discipline to rebalance the portfolio. So I think hybrid funds are a great idea in that case. They help you get equity exposure. They'll give you higher returns than debt, and they'll help you navigate the market volatility. Obviously, since these funds have a larger percentage in equity, barring the conservative hybrid funds, one should definitely look at least a 3 to 5 year holding period when one is investing in hybrid funds. In terms of debt funds, I wouldn't recommend adding debt funds simply because the markets have fallen and people are expecting a correction. Debt funds, they have certain roles basically for conservative investors, those who don't want to take higher risks that equity comes with, or for people who want regular income, or individuals who want to park short-term money with higher liquidity. So, or you want to diversify, you already have a lot of equity and you're looking to add a cushion, in that case, then debt funds are a great option. Again, as you said that, RBI may look at cutting rates. We've been expecting that for a while, so in that case, debt funds will definitely gain advantage because obviously if RBI cuts interest rates, your return on debt funds will be slightly higher.
Noted. Okay. Santosh, should one reduce the intensity of the SMID or the small and mid cap SIPs in favor of large cap funds at the current juncture? Why or why not?
My answer is no, because the product, the nature of investing in SMIDs through SIP is actually the main purpose of why you invest for long term in small and mid cap. In fact, anytime between choosing a lump sum versus a SIP, in an SIP, you are approaching the small and mid caps in a better format. Therefore, do not reduce the intensity. If your time horizon is long enough, I think you should continue. And if ever you're looking at some reallocation, only then it's an opportunity. Otherwise, my answer would be plain and simple. There's no need to reduce the intensity, but just ensure the time horizon for which you have predetermined is kept in mind, or hold it for longer.
Saloni, your answer differs, and it's okay to be different, of course, but does your answer differ?
I agree with Santosh on this. Obviously, we've seen a lot of investment in small and mid cap over the last 6 years, and there has been a lot of concern. And large cap companies, especially in times of volatility, tend to be far more resilient. But what we've seen is, interestingly, in the recent sell-off by FIIs, they've actually impacted large cap funds more than mid and small cap. So I would recommend redeeming or reducing your SIPs only and only if the proportion has become much higher than you need to have in your portfolio. Only then, to rebalance your portfolio, can you look at either stopping or, redeeming the funds from that segment. Otherwise, again, stick to your asset allocation, and invest basis that. Another thing, again, as you said, I would avoid lump sum investments in the segment currently and look at either an SIP or an STP, spreading it over a few months. And just a disclaimer, small cap investments especially should be done for at least a 7+ year horizon.
Okay. So that's, an interesting one out there too. So that's the view on whether or not you should change the mix of your SMID funds, specifically small and mid cap funds, and hence brings me to my last question, which is what to do with multi-cap funds. And viewers, then we'll answer your queries as well, but multi-cap funds important too, because there is a distinction. 50% is large caps or what have you, but there is a minimum 50% in mid caps and small caps, unlike a flexi cap fund. And therefore, for people who are doing an SIP in the multi-cap route, Santosh, should people stay with it?
In fact, my personal favorite for most investors for an all-weather equity fund is the multi-cap. Now, you just brought about that important, large cap allocation. Now, the multi-caps are possibly the only diversified equity category where you have a minimum that you need to maintain in medium, small, and large cap. Therefore, it eliminates the need to have separate or unique line items of small cap and mid cap, which is what was your previous question. Should we reduce the intensity? In a multi cap, that issue doesn't arise over here, because in a multi cap, you've got all the three, a little bit of discretion to the fund manager to increase or decrease the allocations to small and mids if they feel the valuations are stretched or it's overheated. But from a long-term investor perspective, I would personally choose multi-cap slightly above even a flexi cap, thanks to flexi cap having a large cap exposure, because this gives you a well-rounded exposure to large, mid and small cap, and therefore large caps being the biggest part and mid and small caps being well represented. It also gives you the luxury that this is the category where if you hold for a long time, you get rewarded across mid cap and large cap and small cap, not worrying that you missed out the bus. For example, the last 2 to 3 years, missing out on small and mid cap in a large cap fund or in any other fund would have put you back. But multi-cap, if you notice, has been extremely good in capturing the market momentum, especially in the play across market caps. So it's one of my favorite diversified equity teams and all-weather category in equity.
Okay. So that's the long and short of the questions that I had. Now, a bunch of queries, and Saloni, I'd like to start this with you. By the way, I don't know, sorry, Saloni, quick 30 seconds. Do you differ on the multi-cap view before we get to queries?
I have a slightly different view, because the multi-cap requires a minimum of 25% across large, mid, and small. I feel it may be an aggressive strategy and not suitable for all investors. So, it would depend on the risk-taking ability. I feel, flexi cap funds have more flexibility of investing across the 3 segments and maybe a better option for most investors, depending on their risk profile. Most flexi cap funds have a large cap bias. So in case if people need a higher mid or small cap exposure, I would recommend adding that with a separate fund rather than using a multi-cap fund, for their investment.
Okay, fair call. And horses for courses, depending on whose view gels better with you, viewers, you can go with that. Remember, there are not necessarily, there's not just a route A or route B. Both could work for you depending on how your psyche is as well. And it's great to have an advisor, by the way, to guide you through these things and not necessarily always do it yourself. But if you are a DIY investor, tune into our show. We'll try and answer as many queries as we can. So let's get the first one going. It's from Mike. Mike is aged 22 years. Saloni, Mike says it's currently invested in SBI small cap, Quant small cap, UTI 50 and Quant Flexi, and started this year and is planning to hold it for the next 10-12 years. Should Mike continue the SIP when markets are down like this?
So I would break this up into two. One is in terms of the selection of the funds. I don't know the exact amount going to each SIP, but it seems like it's extremely biased towards the small cap category. So I think that is something that definitely would need a relook, and adding maybe some more of large cap allocation as well. In terms of continuing the SIP, yes, I definitely think, because he's fairly young, he has a lot of time ahead of him. And the volatility significantly reduces over longer periods of time, So for a 1 to 3 year period, it'll be far more volatile. But if you look at a 7 to 10 year period, the volatility definitely reduces. So you should continue with your SIPs, but maybe relook at the funds that you're investing in to ensure that you have the right asset allocation.
Okay, the second question is from Bhagya. Again, 22 years. We have a lot of young investors today, which is a good thing. So Bhagya wants to start a 10% step-up SIP of 5,000 per month. Goal is to be financially independent by the age of 45. That's 23 years out. Santosh, how should Bhagya change the strategy on the current conditions? Currently, he's invested in the UTI Nifty 50 index to the tune of 1,500 rupees. Parag Parikh Flexi Cap 1,500 rupees and Nippon India Small Cap 2,000. That's how he makes up his 5,000.
So the good thing is, must appreciate the young investors. Number one, putting up a nice portfolio together. I'm guessing this is largely DIY. The second thing is to have a long-term view. In fact, starting at 22 and to have a 23-year view is phenomenal. I think, again, appreciation for Bhagya. And the third and the most important appreciation is the SIP amount to have a 10% step up, is phenomenal. And as I read it right, it's per month. And I'm just, wondering how such a good thought has come about that you keep your SIP increasing at 10% rate, because the numbers are going to be staggering by the time Bhagya is 45. And I will not pick any holes on the selection of the funds, because there's an index, there's a flexi cap, and there's also a small cap. And if you're going to be invested for 23 years, I'm sure the returns are going to be rewarding and commensurate with your time and the risk that you take. And not to forget, the winner is going to be your time and the scale up of the SIP, because those are going to be magical when power of compounding kicks in. So I am giving a double thumbs up to this.
Okay, we have about 70 seconds left on the show, so I'm going to make it quick. Saloni, Akhilesh Sinha at the other end, age 62, 35 lakh rupees in ICICI Pru Balance Advantage Fund, wants to invest another 15 lakhs into the same fund and then leave it for 5 years, after which start a SWP. Is it whether to invest 15 lakhs in a lump sum or through a staggered process?
So I think since it represents a substantially large portion, of his net worth, I would recommend investing it over the next 3 to 6 months because there is a lot of volatility that is there currently. I think it's a great option because he is looking at hybrid funds, which will give him a good balance of debt and equity, and also adjust basis what the fund manager thinks, the market view is going to be. So I think it's a great plan, but maybe look at investing the 15 lakhs over a 3 to 6 months period.
Got it. Okay, both of you, thank you so much for taking the time out and being with us on the show and giving us your thoughts. Really appreciate your time.
Thank you so much, Neeraj, for having us.
Right, thanks, Neeraj.
All right, and that's all on this leg. Thanks so much for tuning in.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Long Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downward,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that'll help you move with the tide.
An unmissable show.
If you want to be in the money.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downward,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that'll help you move with the tide.
An unmissable show.
If you want to be in the money.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downward,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
Hello and welcome to Earnings Edge. My name is Rucha Somaya and today we are going to talk about TeamLease Services. Well, the company reported its second quarter results. Well, the numbers were likely healthy, but the commentary is what is likely disappointing the street. The stock was down about 11% in trade today, but has now recovered in trade. But to talk to us more about this, we are being joined by Ms. Ramani Datti, the CFO of TeamLease Services. Well, thanks for joining us on the show. Can you give us some highlight as to what's your take on the results this time?
Sure. So this quarter, we have added a net headcount of close to 18,000. And for the first half of this year, we did add about 31,000 headcount between our staffing and apprenticeship business. And on a year-on-year basis, it's close to 48,000 net addition. So in terms of volume growth across all the sectors, we are seeing very good demand. BFSI, on the back of RBI regulations, especially regarding outsourcing of sales profiles, will have an effect on our BFSI headcount growth in Q3. So that's the reason we said BFSI can be muted in Q3. Having said that, be it in consumer vertical, retail, telecom, and manufacturing and other emerging verticals, we are seeing very good growth. And even net of BFSI drop, we believe that there should be at least 8 to 10,000 net headcount growth in Q3 as well. And by Q4, we expect recovery to bounce back, including BFSI across all other sectors, and we should be able to continue with a year-on-year growth of 18 to 20% headcount growth and revenue growth upwards of 20%.
Right, but let's talk about the BFSI vertical over here. I guess BFSI is largely picking up even for other IT companies. So what's your take on the BFSI segment? Are you seeing more kind of hiring? Because more hiring will likely imply that the demand is now picking up for the IT sector as a whole.
Yeah. No, let me unpack this into two parts. So one is BFSI within our IT staffing and BFSI in our general staffing. So right now we are seeing some sort of headwinds on the non-IT side of BFSI related hiring, and that was specific to Q3. Again, starting Q4, we are expecting the numbers to come back in BFSI non-IT profiles. Now, coming back to IT profiles, actually, we are seeing very good growth within IT, mainly coming from the GCC segment. And we believe this hiring trend in GCC, BFSI, IT will continue even for Q3 and Q4. And in fact, we are expecting positive headcount recovery starting 1st of Jan, starting Q4 this year.
Mr. Ramani, thank you so much for joining us today here, and season greetings to you and everybody at TeamLease. It's Puneet here. You did mention about the headcount addition expectations is strong for the second half as well. I just wanted to check on your new logos addition in this particular quarter. You've had decent additions as well. What's the outlook on that over the next 2 quarters for this fiscal year? And any kind of commentary that you can give us on that?
No, our new logo addition has been strong over the last 1.5 years, and we will continue that momentum even for second half of this year as well. We are focusing a lot on the manufacturing segment, auto and engineering segments, especially in terms of new logo acquisition, and we are seeing very good traction there. And again, within IT, a lot of new GCC clients are also getting onboarded. We have a good pipeline of new GCC customer addition even for second half of this year. So we are very positive to continue the current momentum of new client addition for the second half as well. Apart from our staffing businesses, even in our apprenticeship business, so we are acquiring a lot of ITES clients, because so far in our apprenticeship business, we used to have a lot of concentration with auto industry, and now we are building a lot of pipeline with IT and ITES clients as well for the apprenticeship business, which is very good because these clients tend to give us a higher learning component and higher realization for our apprenticeship business.
Right. Hi, Mr. Datti. This is Harsh here.
Ma'am, just want to quickly understand from you, where does therefore top line go maybe 2 to 3 years from now, and where outside of GCC are the other pockets of opportunity that you're focusing on?
So for us, the revenue growth, we would like to maintain consistently warm between 20 to 25% of top line growth over the next 3 to 5 year time frame as well. But with a higher focus on margin expansion and absolute profit expansion, because we hit our rock bottom in Q1 of this year with all the impacts coming from be it IT staffing or apprenticeship business and other impacts. And now we are focusing on expanding our profits quarter on quarter. So this year we posted about 30% sequential growth, and we believe we should be able to maintain at least a 20% sequential growth in profits for the next quarters as well. And overall, for the next 3 to 5 years, we believe there'll be a higher contribution coming from IT staffing and HR services, which have relatively a higher margin profile compared to general staffing, leading to the overall margin expansion at group level.
Right, Ms. Lati, one question on the specialized staffing services. Well, this one contributes about 5.1% to the total revenue in the second quarter, and the margins here have also, gotten a little better at 7.9% in terms of EBITDA versus 6.4% last time. But this has been a little under pressure, as the management had mentioned on the call, because of cautious demand in the IT vertical. So what's your sense on the specialized staffing? Do you think that this can be margin accretive and grow in terms of volumes going ahead?
Yeah. For us, specialized staffing, as you rightly mentioned, gives us about 5% in revenue, but in terms of profit contribution, it gives almost 30% share. And right now, that particular vertical is under pressure because of the headwinds in IT industry, which we believe will continue till Q3. But starting Q4, we are expecting a recovery. And with the increase in top line and growth in the volume, even the EBITDA margins can be expanded further. So currently, we are at about 7.8, 7.9% EBITDA margin, which can be improved to 8.5 to 9% over the next 1 year time frame.
Okay, so you will see pressure in this vertical, but in terms of margin, can we expect Q3 margin in this segment to dilute in the next quarter?
We are not expecting any dilution in margin in this segment for next quarter. So we can maintain the current margin profile for next quarter as well.
Right. Okay. And in terms of the other HR services, which you mentioned, has kind of a good volume, and also the outlook is good over here. Well, when I look at the EBITDA margin, it was negative last quarter, and you've posted like a flat kind of margin this time. So good improvement over here. So do you expect this kind of positive EBITDA margin to sustain, or how is the EBITDA margin profile looking like in the other HR services segment?
Yeah. In other HR services, this year we should be able to maintain at least a 6% overall EBITDA margin. And mainly this contribution is coming from our EdTech business. A lot of new universities have been signed, and the billing has started in Q2, end of Q2 and Q3. We believe that the profitability will be much higher, both on a sequential basis as well as year-on-year basis. In fact, this year, 100% of our EdTech profits get booked in second half of the year. So that should give us a higher bump up in margins and absolute profits in H2.
Mr. Mani, just one final question from my side. In Q3, what is the expectation of sectoral growth that will be driven? And talk to us a little bit about BFSI as well. There has been some clampdown by the RBI in terms of guidelines as well in certain segments and pockets, which were, high hiring segments. So just talk us through which segments do you anticipate in the short term to grow for you in Q3 and Q4? I think consumers and telecom is something that you mentioned, but talk to us on BFSI as well. What is the outlook for the next 2 quarters?
Yeah. BFSI, as I mentioned, in non-IT profiles, Q3 can be muted, or in fact, there can be a slight drop in our BFSI headcount. So currently in our overall headcount, we have 20% exposure to BFSI. And here, the profiles that we are expecting that there can be a drop is mainly into sales, the BFSI sales, the credit card sales, loan recovery. These are the profiles where we are expecting some dip. But other than BFSI, be it consumer, retail, manufacturing, ITES, and other emerging sectors, telecom, we are seeing very good demand in Q3 and Q4 as well. Even within IT, the GCC segments, the demand for the profiles in IT and ITES is very good for Q3 and Q4.
Ms. Datti, one follow-on with regard to the EdTech EBITDA, which you were speaking about, likely to recover in H2. Could you give us some color on this? Could you give us an understanding? You said revenues will likely be recognized in Q3, Q4, and therefore margins will be much better, profitability will be much better in those quarters. Could you talk to us about where, therefore, what will be the impact on margins, and give us context on this, please?
Yeah, sure. In our EdTech business, our billing cycle follows the student admission. And this year, specifically this year, UGC has given guidelines to all universities to realign their curriculum matching with the new education policy. So because of that, many universities have delayed the student admission cycle by 1 or 2 months. So that has, to some extent, deferred our revenue billing from Q2 to Q3. So even if you look at our Q2 performance in HR services last year, in terms of profit contribution, it gave almost close to 15% profit contribution at group level. But this time it's kind of muted because of this deferral in university revenue billing. However, Q3 and Q4, we are expecting between these 2 quarters close to a 15 crore of profit contribution coming from EdTech vertical alone.
Therefore, where should margins lie, ma'am? Q3, Q4? What should be the improvement?
Margin as a percentage, it's very difficult for us to give a guidance. Sure. But on absolute profits, we are expecting at least a 20% sequential growth on profits, on absolute profits.
Okay, understood. Thank you so much, ma'am. Been a pleasure chatting. Thanks so much for coming in and speaking with us.
Thank you.
Right, wee bit of pressure on TeamLease as we speak, 4.5% lower, but off the day's lows. So something that's recovering in some form or shape. But M&M came out with numbers. Puneet, Autopack also under pressure. If you can pull up the Nifty Auto. Strong set from M&M. Stock down 2/3% thereabouts. But you're looking at Auto under pressure, 1% odd lower. Puneet, give us context. First, M&M's numbers and maybe a few lines on Auto. Just give us some context.
Yeah, definitely. So, M&M was expected to be strong and that's what they delivered, but the profits has come much higher than expectations. So, revenue was, of course, growing double digits in this particular quarter. That's come in very well. EBITDA as well, if we can see, the 21% growth year, and this includes, of course, the income and investments as well. Apart from that, profitability has been another aspect as well. 13% growth in this particular time frame to come in at 3,800 crores. And what's important of profitability was expected to be around 3,500 as per Bloomberg estimates. Now, just a quick line on volumes. In this particular quarter, we had 18% volume growth by the company. Was the expectation of 1 to 2% from Maruti and just flat volumes from Tata Motors as well. Just to watch out, there will be 3 things. Order book of the Thar Rocks will be one of the things to watch out for in the management commentary. Apart from that, what is the current discount in the festive period? We had seen increased discounts for all players, but M&M also increased that as well. So we'll see what has been the impact of that in terms of Q3 volumes, because in October has been strong. And finally, the launch of the EV is going to be one of the most exciting things for M&M. The first, this first newborn electric EV scheduled on November 26th. So these 3 aspects will be one of the key things to watch out for, Harsh. And I think, apart from that, Maruti already came out with numbers. Tata Motors is coming out tomorrow. So it's going to be a very strong week, I think, for autos in general.
Well, let's hope those numbers are strong for it to be a strong week, because currently auto is looking weak this week. But I want to quickly mark out Trent as well. That one is down 6% now on the back of numbers. We'll obviously get more perspective, but we're going to cut into another conversation. Mankind Pharma. It's recorded a 29% uptick in profits. Margins have expanded. Very strong numbers. Growth also good. We spoke with Vice Chairman and Managing Director Rajiv Juneja on the quarter gone by. Listen in to a slice of that conversation.
Export, our philosophy is totally clear. Whatever we export, we basically export complex, difficult to make kind of products. And if some opportunity comes, that really adds to the growth side. So nothing special we have done. It's a continuous, consistent kind of a work, which basically is happening, and that's giving us a double-digit kind of a growth in export side.
Got it. Now on BSV, now you'll start integrating the asset. What are the milestones that you have set, or what kind of margin you are targeting when it comes to BSV?
Objective of taking BSV is a bit different. Objective basically is what to bring entry barrier products. I mean, those products which have a patent, which can draw attention from the customer, the consumer, whether it's a India market or export market. And of course, when you have patent products, when you have very less competitive products, the margins are supposed to go up. So last year, if margin was 28%, this year it's adjusted margins are 29%. Going forward, as this integration will happen, it's too early to say anything, but hopefully it will add a lot of value to mankind in every term.
Please go ahead.
In every term, I mean, in terms of value addition, in terms of giving us fantastic products, in terms of margins, because whatever margins we see, these margins are byproduct of some kind of a special thing in a product, some kind of a good marketing, some kind of efforts from the company side.
Got it. Also, your India formulation business, I just wanted to get a sense on how seasonality panned out this quarter, because it seems like obviously on the chronic side you've done a good thing, but is it fair to assume that the growth would have been higher, if we had a normal season? I mean, how did you perform versus your expectations?
One, our focus is towards chronic side, and that's one reason quarter after quarter, year after year, you see a lot of traction in chronic side. Our chronic is doing fantastic. There's no doubt about this. As far as the seasonality is concerned, it was good. It was okay. Sometimes the kind of numbers or the kind of growth you expect does not come, but these are intentional. Why I'm saying it? Because once in a while, once in 5 years, we bring commercial excellence in the company. We hire external agencies and make sure that whatever inefficient areas are there, whatever things are not really, moving as per our speed, are being identified, worked on. So we don't see short-term losses or short-term less growth. We always work for the future. And that's one reason the growth is a bit less than what we expected. Still, it is 1.1% to the industry growth. But miles to go, we are a more capable company than what we are projecting right now.
Right, all right. Also, on the consumer healthcare business, so we've seen growth of 20% there, which is kind of quite, strong performance. Now, how should we think about what is the sustainable growth that you're expecting here when it comes to your consumer business?
Consumer business, we have time and again said, is closest to our heart. We give our everything to consumer business. It does not mean we don't give everything to other business, but it has given us so much of name. So last year, we started the process of carving it out of main business so that we can bring right talent, right practices. It is carved out. It's a separate entity, 100% of Mankind. So you can see our confidence. We hope that OTC consumer business of Mankind would give us double-digit growth always, this year as well, and 18 to 20% EBITDA. That's the kind of expectations we carry in our head.
Got it. Now, we spoke about BSV, we spoke about your consumer business and India formulation business. Now, considering all this, what is the target that you have set when it comes to revenue and EBITDA for, say, FY25?
We always maintain one guidelines that we are supposed to perform better than the IPM, 1.3 to 1.4 times to the IPM. That we basically want to maintain. Plus, it's always good that you speak less and your action demonstrate more. It's always good. Market likes that, and we believe in that. That's the DNA of Mankind. Walk the talk.
Got it. Also, so you have raised 10,000 crores from non-convertible debentures and commercial papers. Now, basis the tenure, repayment tenure, what will be the overall cumulative debt that you are debt repayment annually you would be targeting in FY25 and 26?
In 3 years' time, we are supposed to, we repay all the debt. Right now, the debt stands at 10,000 crore rupees. But naturally, in next few weeks, in the middle of December, hopefully, QIP will happen of 3,000 crore rupees. That would be one. Plus, we have some non-core asset to the tune of 500, 600 crore rupees. They would be sold off, and the money will definitely go for the debt repayment. And we are pretty confident that in 3 years' time, we'll be able to pay our debts back. We are making a discipline that our debt to EBITDA should not be more than 2 times.
Oh, okay. Also on the Panacea brand, so I think last year you grew very well. Have you been able to maintain that kind of growth?
Yes, madam, absolutely. I mean, we are having a growth of 20-25% on Panacea brands. They're doing fantastic. We always believed in Panacea acquisition, where market said it is expensive, but we are very happy. Same kind of a confidence we have got in Bharat Serum, PSV.
Okay, on the current portfolio, if you can share what therapies you believe will offer headroom for improvement, maybe say in next 2 to 3 years.
In last couple of years, we have launched a lot of chronic therapy areas, approximately 10 divisions. They are in very infancy stage. They are on the cusp of becoming bigger and bigger. Right now, the PCPM is coming to the tune of 3.5 lakh rupees, 3 to 3.5 lakh rupees. We hope that, plus they're growing at 25% rate of growth. So once these will become bigger, so our chronic share will increase. At the same time, we are focusing towards onco because we feel that cancer is becoming a next epidemic in India. Neuro is one because after COVID, a lot of mental problems have creeped in mankind, in India. And we hope that these are certain areas. Apart from this, Gyna is there because now we have acquired IVF side of IVF products of BSV, and hope that these certain products, therapy will give us a lot of good growth.
The next Indian icons, beating everyone on the globe, B6E and XEV9E. Mahindra's electric origin SUVs. Catch them at Unlimit India.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Co-powered by Canara Bank. Together we can.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Co-powered by Canara Bank. Together we can.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Well, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that'll help you move with the tide.
An unmissable trade.
If you want to be in the money.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Co-powered by Canara Bank. Together we can.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Well, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that'll help you move with the tide.
An unmissable trade.
If you want to be in the money.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Co-powered by Canara Bank. Together we can.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Well, it's simple. If If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
As we've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
Hello and welcome to the Mutual Fund Show. I am your host Neeraj Shah, and in times like these, it's very important to get the right advice to try and understand what should you do with your mutual fund portfolios. Is it time to do some rebalancing? Is it the right approach to think of rebalancing, if at all? If you're putting in fresh money to work, what are the kind of funds that you should put your money to work? Because I'm guessing one thing is a given, that these times don't last forever, and therefore there should not be any change to the investment strategy if you have. There could be, or maybe there could be minor tweaks to it, but the process of investing, which a lot of Indian investors have gotten into a habit of, which is the systematic investing, should probably just continue. Is that true or no? Let's talk about this with Mrin Agarwal and Rishabh Desai. Both of them join me on the show today. And both of you, thank you so much for taking the time out and being with us, because you know it's an important day to be doing this show, because portfolios are reeling under pressure. Whether you're a stock market investor or a mutual fund investor, looking at your portfolios today, you must be a bit ruffled about how they are performing. So Mrin, before we talk about the how to rebalance, what should an investor do? Is this a good time to rebalance? Is it a time to sit tight? Or is it a time to continue the investment strategy as earlier, as difficult as it may be?
So good afternoon, Neeraj, and nice to be on the show today.
Thank you.
Well, as such, I think what is really important is to, first of all, build a portfolio that can withstand different market conditions. And, you know, it's very difficult if we have to keep changing our portfolio strategy or even doing the tweaking on a regular basis based on the news that's there in the market. It's going to be very, very difficult to actually manage a portfolio like this. So I would say, yes, we will talk about a couple of things that you can check at this point. But as such, I think if you have got your asset allocation right, and if your portfolio is as per your asset allocation, then I think you should just sit tight.
Rishabh, what would your view be?
Hi, Neeraj. First of all, thanks so much for having me on the show. It's been quite some time since we last did a show together. Yes, I think I more or less agree with what Mrin had to say. Like, you know, sticking with one's goal, one's time horizon, and most importantly, knowing your risk appetite and asset allocation is something what we advise our clients to do. I mean, if you have a long-term time horizon, then sticking with your risk appetite and your asset allocation is something what makes sense. So to answer it very simply, you know, sitting tight, put during these volatile times makes more sense. You know, another thing what we recommend our clients to do is to diversify well. You know, a lot of people, you know, concentrate on product selection, category selection. But, you know, it is very important to diversify across different styles if someone is venturing into pure equity, like growth and value and contra. So, you know, that really helps in kind of like mitigating risk. And, you know, I wouldn't say, see, if someone is investing in pure equity, of course, there are going to be double-digit drawdowns. But at least, you know, in different market cycles, different products and different styles will outperform. So it's very important to diversify across different styles as well, Neeraj.
Okay, so, okay, Rishabh, let's start with you on this then. Is there a change of style that you are prescribing with the markets the way they have behaved in October or the way they behaved in October? So come November, the first few days, should people change their portfolios to a style which according to you might work better? And why is that so?
I think what we recommend, and this is my personal portfolio as well, Neeraj. See, I invest 50% in growth and 50% in value. Right now, growth can consist of, say, like momentum and like pure value. Momentum and pure growth oriented strategies. And the value segment can consist of value style and contra style as well. So I think investing 50% in growth and momentum and 50% in value and contra is something what I personally follow. I really don't need to bother too much about rebalancing too frequently, when markets fall, because see, currently markets have just fallen around 10%, which is very hardly. If you see the mid and small cap space, it's the valuations are still very expensive, right? So I think following a 50% growth and 50% value strategy is something what I would do.
Sorry, one more follow-up. Actually, let me first go to Mrin. Mrin, I heard your opening answer. I'm just trying to understand. Would you do some rebalancing, some fine tweaking, or are you comfortable continuing with what your strategy was, let's say 3 months ago?
Actually, Neeraj, that really depends upon what the investor has done. The issue that we really see today is, as always, trend chasing. And people have taken very high exposure to sector and thematic funds, for example, or they could be overexposure to, for example, mid caps or small caps where valuations are stretched. So the tweaking is going to really depend upon the stance of the investor. As such, I do recommend rebalancing only once a year at the end of the financial year. But at this point, if you are feeling uncomfortable as an investor, the first thing that you need to be asking yourself is that, are you ready for market volatility? Because of 10 to 15% drawdown every year is very normal, firstly. Second thing is that if you are not comfortable with this volatility, then you need to look at your portfolio and you need to have a look as to where you have a exposure that you want to cut down. So is it small cap? Certainly, I would say that if you're holding these sector funds and thematic funds, which has been the largest category that investors have acquired over the last 1.5 years, I think those are the funds that you should certainly look at exiting irrespective of the return. So clearly, it's a question of the investor's stance and whether they have the ability to stick on or not. And that said, investors should also keep in mind that equities are meant for the long term. So a little bit of volatility in the short term is not really going to make a difference as long as you have the ability to remain invested for the long term.
Okay. So, Bryn, let's try and understand. Let's assume it's an average investor who's watching us right now with average risk appetite and an average time horizon as well. So let's say the time horizon is not necessarily 1-2 years, but right now we are trying to gauge, or even people who might have shorter term goals, but this show is dedicated to people who have a proper mindset in mind of having to look at or investing with a 5-year, 7-year, 10-year period under an ideal case scenario, right? Should thematic funds be out of the window for the time being? Let me ask pointed questions to try and understand this. Should thematic funds be out of the window, or are there thematic funds which you're happy having?
I never advocate thematic funds. So yes, thematic funds should be out.
Okay. Rushabh, what about you?
I agree with Mrin.
Okay. That's
I really don't see any value addition in sectorial and thematic bets, Neeraj. See, unless and until if someone is investing in a product like Nasdaq 100 or a FANG Plus index, that's very different, because they are taking global exposure over there. And in today's time and age, I think having global exposure is very important. But see, if you see the thematic and the sectorial funds today, I mean, if I diversify well across flexi cap, multi cap, mid cap, and small cap, automatically, sectorial and thematic rotations is going to happen from the fund manager side, right? So I really don't see a lot of, cluttering your portfolio with too many funds. And of course, see, there has been plenty of liquidity over the past 2-3 years. Returns have been phenomenal, and investors are more or less pumping in money looking at to the past returns. So I think, following a consistent methodology, right? See, we are in this business day in and day out. So we can take probably sectorial bets or thematic bets. But a regular investor may not understand, when to invest and when to exit. See, there are two things. One is entering at the right time and exiting at the right time as well. I mean, look at the China market today, right? I mean, China is more or less like a theme what someone would want to invest, or look at the media sector. It is still negative today. So I think thematic bets is something what retail investors should completely avoid.
Okay, thematic funds should be avoided. So that's the first one. A lot of people are talking about slightly exotic options, and I'll come to those before I come to normal. So people buying into China ETFs, people buying into global funds or global ETFs as well. Is that an option currently while India is looking so volatile? Rushabh, I'll start with this one with you.
Absolutely. I think global diversification, especially in the US economy, is very important. I mean, if you see, look at the 10-year data, Neeraj. See, 10-year data clearly tells us that Nasdaq 100 has actually outperformed most of the broader Indian indices, which is the Nifty 50, Nifty 500, right? So I think having one foot abroad, especially in the US economy, looking at the giant nature, looking at the consistent returns, looking at the transparency what the US economy have. I mean, there are so many sectors and companies what India has not even seen. I mean, we are still developing, especially in the technology space. Look at Facebook. Look at Alphabet. These are like Apple. These are giant, super giant company with global presence. And let's not forget, how much ever we want to discuss that the dollar is deteriorating, but see, today dollar is a global currency. I will not deny that, and it's going to take a very long time for the dollar to come down the rail or come down from the primary currency, at least at this point of time. So I think having some global exposure, especially in the US economy, is something what I strongly recommend, Neeraj.
Rin, would you concur, and is it only US, or would you look at China ETFs? Would you look at some others?
I would concur with I would concur with Rishabh. And yes, I think US is a great market. In any case, it makes up a large part of world market capitalization. And as Rishabh pointed out, some great investments out there. So certainly I would look at some diversification into US markets.
How do you do this, Brin?
I'm sorry, Neeraj?
How would you do this diversification? An average investor wants to know how to take that exposure. What would you say?
I would say look at a S&P 500 ETF or look at the FOF route, either through the international fund, of course, through the mutual funds, not through direct stocks. Because again, if you're going to try and identify stocks directly out there, one is, the whole aspect of what you buy, but more than that, the tax reporting of foreign stocks in India is quite tedious and complicated. So, of course, through international mutual funds.
Okay, and is there, are there specific funds, Brin? I'll come to you, Rushabh, with the same question. Are there specific funds? These need not be an exhaustive list of recommendations, but indicative list of some of the funds that people can look at and study.
I would say the S&P 500 index fund is a good option if you want a more broad-based option. Because again, when you look at NASDAQ or when you look at FANG, it's primarily directed towards technology stocks. So I would say pick up a S&P 500 index that's available. And of course, study the tracking error to know how well the fund is actually optimizing the investment.
Rushabh, what about you?
I more or less agree with what Miren had to say. See, there are two ways to look at this, Neeraj. One is, unfortunately, there is a offshore limit by the RBI. $7 billion is the MF overall limit, and it's kind of exhausted today. Okay, so maybe there will be many funds which may not take additional lump sum money, maybe SIP, but not lump sum money, especially in S&P 500 or Nasdaq 100. See, what happens is that when investors try to buy ETF, when there is a restriction, the ETFs can also go at a premium because they are traded in the secondary market. So that is also something what investors really need to keep in mind, is that go for either pure index funds or the FOF route. Let the AMC manage that for you. Because if you try to buy the ETF, you really need to see at what price the ETF is being traded. You don't want to buy an ETF which is trading at some 4-5% premium, right? It'll not add much value to your portfolio. So I think keep your portfolios very simple, keep your products very simple. It'll be much more easier for you to track and monitor. So I think if someone wants to invest abroad, Nasdaq 100, either in the index fund route or the FOF, or also investors can look at Indian mutual funds with a combination of Indian equities and foreign equities, for example, like Parag Parikh Flexi Cap Fund or the SBI Focus Fund, because even Parag Parikh Flexi Cap Fund do still have around 17-18% towards the US economy. And I think around SBI Focus Fund does around somewhere around 9-10%. So I think including these funds which have Indian equities plus US equities should do the job.
Okay. So before we take some queries, I just have one more question. Would you guys advocate bringing in hybrid funds, balance advantage funds at the current juncture, or was the right time in the Nifty, on hindsight of course, or was the right time when the Nifty was at 26,000? Min, the question to you first.
See, again, we can't time markets. So I would say, again, it really comes down to the investor. If you cannot take volatility that's there in mid caps and small caps, of course, you have the option of investing in large caps through the ETFs, or you have the option of adding in the balance advantage funds as well. Now, balance advantage funds can be added at any time, because the beauty of the balance advantage fund is that it keeps doing the rebalancing between debt and equity based on various quantitative parameters. And ideally, when markets are overvalued, then it tends to reduce the equity allocation. So I think, again, these calls cannot be taken basis volatility in the market or basis news that is coming out. This is a strategy that people have to decide, how much volatility they can take, how much risk they can take, and decide basis that. But yes, it's a good time for you to do that check in case if you're feeling worried about your investments right now.
Okay. And Rishabh, what's your view here?
Neeraj, see, if someone wants to play defensive, right? I think the best way to do is to be more aggressive during market corrections. See, what happens is during market corrections, you are going to accumulate more units, number one. Once you accumulate more units in the future, see, markets, we have seen that, the downfall or the negative periods have been much more lesser than the positive periods in the equity markets, right? So I think once the units have been properly accumulated during bull markets, the returns will be enhanced. And most importantly, once that volatility phase is waved off after a couple of months or maybe a year or two, the future downside will be very well protected during future market correction. So I think number one, if someone is investing in pure equity, I think the best way to play defensive is actually to be more aggressive and invest or pump in more money during market conditions, market corrections. See, if someone wants to go into dynamic asset allocation funds or balance advantage funds, one should be very clear why they are entering in these products. One is that they cannot stomach volatility. That is a good way to go into balance advantage or dynamic asset allocation funds. Number two is that they don't want to time the markets. They don't want to keep on rebalancing from time to time. And they want to leave that to the fund manager to do the job, right? From equity to debt and debt to equity. So once someone has a moderate risk appetite, someone who cannot stomach too much of volatility, and someone who does not want to time and rebalance on a regular basis, I think balance advantage funds and dynamic asset allocations funds are meant for that.
Okay, let's try and get in some queries going. G2 is the first question is from G2. Don't quite know the age, but G2 is ready to invest 50 lakh rupees into mutual funds with a long-term view. Considering current market conditions, a good time to invest, or should G2 wait until the US election outcome is over? Well, G2 is just a couple of days out, but he needs guidance on timing and strategy. Mrin, you want to help?
So as I said, you can't time markets. first thing to keep in mind that long-term view means that you should be in it for at least 7 to 10 years. So that's my definition of long-term. Secondly, in terms of strategy, well, again, it depends upon how much risk you want to take. But I'm presuming that you're looking only at equity mutual funds right now. I always suggest that take a combination of index, like a Nifty 50 index fund, a flexi cap fund, a mid cap fund, and a small cap fund. Because in this you're getting exposure across the different market cap segments as well as some amount of international exposure. Of course, provided you choose funds like Parag Parikh, which have international exposure. But I think one of each of these categories is honestly good enough. In the portfolio, it will give you large cap, mid cap, small cap, and international exposure. And always remember that it's very important to be diversified among fund houses as well. So don't choose all funds from one fund house, among market caps, and at the same time, remain invested in this for the long term. That is what is really important.
Okay. Rishabh, is your advice different?
I think, investing around 50-60% into flexi cap and the rest can be divided into mid and small caps. This is something what I would recommend because it gives a good blend of both these spaces, which is the large cap space and the mid and small cap space as well. So I think, first of all, staggering investments is something what I would recommend because we don't know where the markets are going. I mean, the earnings have also been quite flat on a year-on-year basis. So I think we may see some kind of stagnation or the correction could continue for some more time. So I think don't just look at the US elections. It's a combination of everything, which is the global picture and plus the domestic earnings of how they are panning out to be at this point of time. So I think staggering investments over the next probably 3 months or so, this is something what I would recommend. So 50-60% into flexi caps and the rest can be divided into mid and small caps.
Okay. Second query is from Aman Mehta. Aman is 33 years of age. He says I invest 1.24 lakhs a month. Interesting number. 1.24 lakhs a month through an SIP route and is looking for long-term wealth creation, ideally a CAGR of 15%. Is requesting a review of the portfolio. The goal, Mrin and Rishabh, is a 15% CAGR, as I said, and the portfolio has PPFAS flexi cap, which is about 31,000 rupees a month, SBI Contra 31,000, HDFC mid cap 31,000, and Tata small cap 31,000. So those are the four funds, 31,000 each, 1,24,000. Is this a good portfolio or does it need some changes? Rishabh, I'll start with you on this.
Neeraj, I think overall it's a brilliant portfolio, good blend of growth and value. It's not too cluttered. Perfectly what I had actually thought, Parag Parikh Flexi Cap and SBI Contra are like Flexi Cap strategies and one mid cap and one small cap. I think just one change I would like him to make is the HDFC mid cap opportunities fund is a giant fund today. It's around more than 60,000 crore fund. So I think the AUM, especially in the mid cap space, can hinder the future performance. So I think I'm not telling him to redeem from HDFC midcap. I'm just telling him to stop the SIP in HDFC midcap and start an SIP in a moderate AUM midcap fund. So probably I would suggest him, instead of HDFC midcap, I would suggest him to go for an Edelweiss midcap fund. I think that's the only change I would recommend. Otherwise, the portfolio looks perfect to me.
Okay, portfolio looks perfect. And Mrin, very quickly, your advice before we move on to the next query.
So I concur with Rishabh that the portfolio is fine. I think somewhere he needs to possibly look at moderating his the returns expectation. I do see a lot of investors who think, SIP, if I do, I'll get 15%. So I think it's better if you have slightly lower returns, lower return expectation of, let's say, 10 to 12% over, having this goal. It's nice to have a goal of 15%, but yeah, that's the only point that I'd like to make.
Okay. The next query, Mrin, is from Abhijit Das, age 22 years, wish to start investing 10,000 rupees a month into SIPs with a 10% annual step up. Horizon of 20 years? Can you suggest some funds?
Well, firstly, I'm happy to see that he's having this step up plan in place because one of the key things which I advise on is to focus on the corpus because we are resuming average returns of 10 to 12%. So then a good way to actually build corpus is the actual annual step up, right? In terms of funds, given his age being 22 and the fact that he has an investment horizon of 20 years, I would say take some good risk, take higher risk, and look at mid caps and small caps. So maybe like Mire mid cap, SBI small cap. These are a couple of funds that I would suggest.
Okay. Very quickly, I'll try and take one more query, and Rusha will have to make this quick. But Rajesh Chaudhary, age 36 years, is investing 90,000 a month through SIPs across 10 funds, 24-year time horizon, expectation of 14% CAGR. Please review the portfolio. Rusha will have to make this quick. The goal, as I said, 14%. The funds on your screen: PPFS FlexiCap 10,000, Mirae Asset Consumer 10,000, HDFC Midcap, about 10,000 in HDFC Manufacturing, about 5,000 coupled with the HDFC Pharma, Nippon India Growth, Nippon Multicap, HDFC AMC, Nifty B. So about 9 funds.
So there are two things, Neeraj. One is there are too many funds, which I would recommend to trim down. Number two is that he's concentrating on certain AMCs, which is HDFC and Nippon. I think diversifying across different AMCs and different products is something what I would recommend. I'm not a very big fan of the sectorial and thematic funds. So manufacturing, pharma, consumer, I think these are the funds I would like him to kick it out from his portfolio. Stick with 4 or maximum 5 funds. I don't think there should be more than five funds in one's portfolio, in one's core portfolio, especially on the equity side. So probably stick with FlexiCap fund. Introduce one more FlexiCap fund, like probably say Franklin India FlexiCap fund. He can stick with Nippon India Growth Fund, and I would encourage him to introduce one more small cap fund, probably say like Kotak small cap fund. But just stick with 4 or 5 funds, 2 or 3 FlexiCap, 1 mid cap, and 1 small cap, Neeraj.
Got it. Okay, both of you. That's all at the time that we have on the show. Thanks so much for taking the time and being with us and giving us your advice. Really appreciate your time. That's all the time that we have on this leg of the Mutual Fund Show. Stay tuned to NDTV Profit.
The next Indian icons, beating everyone on the globe. B6E and XEV9E. Mahindra's electric origin SUVs. Catch them at Unlimit India.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Lord Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Good evening and welcome to the big story on NDTV Profit. I'm Nupur Talwar Suri. Well, from being the 6th richest man in the world in 2008 to being labelled a fraudster, industrialist Anil Ambani's fortunes continue to take a turn for the worse. In another setback, the Solar Energy Corporation of India has slapped a 3-year ban on Anil Ambani's Reliance Power and its subsidiaries from participating in future tenders. Now, this penalty follows the submission of fake bank guarantees during the last round of bidding. This scandal is far from the first for Anil Ambani, of course. He's been involved in multiple controversies in the past, since the 2018 insolvency of Reliance Communications. Now, just months ago, SEBI had banned him from the securities market for 5 years over fund diversion charges. In today's episode of The Big Story, we uncover what this ban means for the reputation of Anil Ambani and entities that are associated with him. First of all, we go across to our reporter Vishwanath Nair, who has the details of how this scam was exposed. He filed this report.
So what has happened here is that essentially Reliance Power, which is an Anil Ambani-owned company, has been exposed for participating in a bid process with unclean hands, essentially. What they have done is that they've submitted certain documents which proved to be false. Now, I'll take you through what exactly happened in this entire story. Essentially, the Solar Energy Corporation of India, SECI, which conducts all the tenders for the government with respect to solar power projects, had conducted an entire bid process back in June of 2024. After that, essentially, certain discrepancies were found with Reliance Power subsidiary and the way that they have submitted the bid. What exactly they did was that they submitted a foreign bank guarantee as part of the earnest money deposit that they have to do. This foreign bank guarantee was supported by SBI. That's what Reliance Power subsidiary had claimed. What SECI in its investigation found out was that there was a specific email ID through which an email was sent from SBI supporting this bid. However, that email ID turned out to be fake. Now, you can see in this in the graphics on the screen, the email says S-BI, which is a very clear indicator that this was probably a fake ID. Next, what happens is that SECI pulls up the company. What it does is goes to SBI, and SBI confirms that this email ID was fake, that they have not supported the foreign bank guarantee that the Reliance Power subsidiary submitted as part of the bidding process. Next, SECI essentially decides to cancel the entire tender process because there were issues with the way a bidder had participated in this entire process. What sources are telling us also is that Reliance Power had actually won this bid, and after that, this has been cancelled and that bid has been pulled back. Reliance Power has on its part blamed a third-party arranger, saying that they had given them the fake bank guarantee in place, and the company did not know what actually happened on ground. But SECI has, of course, barred Reliance Power and all of its subsidiaries from participating in any future tenders for 3 consecutive years. So that's an important sort of announcement that coming from SECI this morning. They put out this notification on the website saying that Reliance Power and its subsidiaries will be completely barred. This is an important move specifically because you can see the comment that SECI made in its notice. It said that what it had discovered is that as part of the tender requirements, the endorsement of the bank guarantee against it was fake, and that was an issue. What they've also pointed out is that they have concluded, and it's logical to conclude that any action by the subsidiary of Reliance Power would have been done on the orders of Reliance Power, and therefore they had to bar the parent company as well. Important simply because Reliance Group, the Anil Ambani Reliance Group altogether, has been facing a lot of setbacks on most fronts, actually. If you were to look at an order by the Securities and Exchanges Board of India, they have barred Anil Ambani and certain other members with the Reliance Group from the securities market for 5 years. They had also levied a 25 crore penalty, which was, of course, removed by SAT. That case is still ongoing. Apart from that, you've had insolvencies of multiple Reliance Group-owned companies, specifically Reliance Communications, Reliance Capital, as well as Pipavav Defense, or what is now known as Reliance Naval and Engineering. So all of these companies are already under insolvency. This is another major setback for Anil Ambani.
Well, in fact, the current set of troubles does beg some larger questions. So the big questions that we are asking this evening are, number one, has Anil Ambani's business crossed a line with fake guarantees? Is the ban a death blow to Reliance Power's reputation? And is this the end to Reliance Power's solar ambitions? And we're going to tackle each of those in just a bit. But first, we've got Vishwanath Nair joining me in the studio. Hi, Vishy. Thank you for joining us. Vishy, of course, their set of troubles don't seem to end, but obviously there has been quite a bit of wrongdoing on their part. Now, we understand they've come out with a statement. Take us through what that statement is and what do you make of it?
So, as part of the statement, now, Nupur, you and I were chatting a little earlier, and I mentioned that this is something that is going to come out in the statement, which is that they're going to blame a third-party arranger. This is something that they have maintained. And they've said that in the statement as well. They said that they have been victims of fraud, forgery, and criminal conspiracy. That this third-party arranger submitted this document on behalf of Reliance Power subsidiary. The company has actually filed a case with the Economic Offences Wing as of 16th of October, and that the company will go ahead and challenge the SECI order that came out this morning because they feel it is unfair. Couple of issues with this. Firstly, who is this third party? Nobody seems to know because it's not part of any investigation. SECI doesn't know. The company has never disclosed it to the public. Nobody actually involved in this entire process knows who this third party is. So, hopefully, this FIR that they filed on 16th of October comes out at some point in time. But till that point in time, we're all pretty much blind in this entire situation. The other part, which is SECI. Now, the SECI order is in line with what their rules are. Their rules very clearly specify that if a bidder has misrepresented themselves or submitted something that is not a true document, then SECI has the right to A, change the entire bidding process, which is cancel it and restart it, which is what they've done. B, and or they could also bar the bidders from participating in the future tenders again, which is what they've done with Reliance Power. So this is not something that is out of the blue that is coming. This is well within SECI's abilities, its powers, and they have done what they had promised in the bidding documents. And if there are falsified documents submitted to it, they can take that action.
Oh, yes, absolutely. And we're going to talk more about it. But just joining us on the broadcast right now is also Mr. Sriram Subramaniam. He's the MD and founder of InGovern. Good evening, Mr. Subramaniam. Thank you very much for speaking to us. Mr. Subramaniam, first of all, what do you make of all of this that has happened? Now, the statement that Reliance Power has come out with seems to be shifting the blame away from them because they say that they are also a victim of fraud. But, the fact of the matter is that it's not them who's the victim of fraud. It is SECI that seems to be the victim of fraud because falsified documents were provided to them. And apart from that, of course, the shareholders of the company and this project now has been stalled.
Good evening. Definitely, the buck stops at Reliance Power for sure, because at the end of the day, the team within Reliance Power that put out the document should have verified all the details. Just coming from an email ID is not good enough. Whether the actual fixed deposit, the earnest money deposit, and the bank guarantee exists, whether they paid the bank guarantee fees, etc., they would only know for sure. Because no bank is going to issue a bank guarantee without charging them fees. So from that perspective, if they have given fees, then the bank guarantee should be legal, especially if it's a reputed bank. One, as you rightly said, which is the bank that has issued this bank guarantee? Two is in lieu of the earner's deposit. Three is who is the third party is what the question beget. And that too, one cannot rely on a third party. One has to have direct relation for the kinds of monies that are being talked about. One has to obviously, I would think the Reliance Power executives would have had direct discussions with the bankers. Even if a third party is involved. So I am surprised that they are trying to shift the blame onto a third party. So this is totally not accepted for the kinds of money is involved, for the kinds of project that's involved, but the kind of reputation that the ADHE group is now trying to bounce back from its, as you said, the past ghosts that it is trying to bury now.
Oh, yes, absolutely. Now, you did mention the fact that obviously this has caused a lot of reputational damage to the Reliance Group, and, their troubles don't seem to end. But, what remains in public memory often in these cases is the kind of fraud that is being perpetuated.
Definitely. See, the ethos, one which is, and the tone that is set at the top is what perpetrates down to the executives who are responsible probably for creating this entire mess. So at the end of the day, the ethos should be clear. The basic first principle should be clear. Of course, business failure is accepted where in that sense people could have over-leveraged themselves. There were many business groups that over-leveraged themselves and had to go insolvency process. There's a structured IBC process for that. But what is not accepted is fraud and blatant falsification of documents, channelizing and tunneling of funds, and all these. And the SEBI order really did point out about channelizing and tunneling of funds through various promoter group entities, Reliance Home Finance and the like, and thereof, which is basically public money and going into promoter entities. In this case, if there is a false document and if there is a false bank guarantee, that obviously, again, the blame rests on the company and its executives. And that is blatant fraud.
This is Vishwanath here. I just wanted to get your sense, the topic of fake bank guarantees. Now, this sort of, brings you back memories of another large fraud that happened just about 5 years ago, with the Nirav Modi scandal. But just to get this point clarified, since then, banks have all tightened their processes on how exactly bank guarantees are issued, how a company can claim it, and whether a company can claim that they have received a certain guarantee from a bank. Despite all of this, are there still loopholes to your mind?
I would think so. Otherwise, in this case, firstly, the foreign bank seems to have issued this. Secondly, they seem to have sort of given Indian banks sort of backstop by projecting SBI, State Bank of India, as a backstop, Indian bank backstopping that foreign bank guarantee. So from that perspective, there are loopholes to the extent that the person or the entity taking, in this case, the Solar Energy Corporation, is not able to verify the bank guarantee independently, right? I mean, they had their direct channel of communication to the bank itself. They could independently verify. So they had to figure it out from that false email ID and the like. So there could be some scope for enhancement of tightening of rules again.
Part, I just wanted to add this question. You mentioned the fake email ID, but when you look at the email ID, it's, to me as a layperson, it's very evident that this is not actually a State Bank of India email address, right? I'm surprised that multiple people who are far more qualified than me could get fooled with something so simple.
They have not got fooled. Otherwise, this case may not have come out at all, right? I mean, the fact is that probably that was the genesis. Two is it seems to be a very amateur attempt at firstly perpetrating a fraud, if anything. I mean, so that itself. I mean, and to think that this sort of the monies involved is very high. These are projects of high, I would think, stature and high reputation, and I would think where there are multiple bidders. and the like. So when such a project is and a group is trying to sort of bid for such a project, the chances of getting caught are very high. So the fact is, if not today, they would probably have, even if suppose there was a bank guarantee which needed to be revoked, at that time at least they would the SECI would know about it, right?
Also, Mr. Subramaniam, now we are talking about several lacunae being there. Now, one of the lacunae many would argue is also the fact that this did go through the last round of the tender process. And it was only then that this, sort of fraud was actually caught. Now, obviously, there is a lot that can be done in that department also. Perhaps SECI can also look at that. But apart from that, what do you think, what does it mean essentially for the overturning of the tender process now? Because there is obviously going to be a delay, new bids will be called, the whole, project that was supposed to have a start date then gets delayed. Overall, do you think that even the tendering process needs to perhaps be more foolproof?
There could be possibilities, but usually this is an earnest money deposit. Usually this is done at the last stage when the project is granted to the final bidder, because the first rounds may be just pre-qualification and the like, where just the technical and financial capability of the group is considered, or the company bidding is considered. But the earnest money deposit is actually sought only at the last stage, because that is really the deposit that is sought to get kickstart the project or to award the project. So from that perspective, it is only at the last stage that SECI would have come to know about it, or would have even got the bank guarantee for that matter. So from that perspective, I don't think there could be lacuna process itself, but what definitely there is a delay in the process now, which is not unheard of in many projects, where there are of course projects where there are single bidders and there could be some technical failures or financial failures, and the tender doesn't go through. So this could also be considered. Obviously now SECI needs to act post haste in issuing a new tender and going through the process in quick time.
Sir, I wanted to get your sense on something that Nupur mentioned earlier, and then you were also highlighting that, which is the fact that there are stories and historical context to this company and its promoter specifically. When we're talking about, for example, the Reliance Home Finance case, which you mentioned earlier, which is where SEBI had barred Anil Ambani from the securities market for 5 years. I just want to get your sense, when we're talking about somebody with a precedent for breaking rules, right? Coming to the current situation, to your mind, what does this look like? Is this par for course, or maybe that was these are two separate issues and maybe need to looked at separately?
It's a tough question, because at the end of the day, it looked like the group is trying to bounce back from its past. And there were media reports that the group had raised fresh funding and has good plans in place, etc. So from that perspective, this news definitely of this bidding being false and everything is a huge setback. The SEBI ruling just a few months ago, it's again a huge setback. But these are just the fact that this group, the ADAG group, has suffered, I would think, was very over-ambitious in the infrastructure space, had suffered setbacks, and one thing led to another, and that led to a cascading effect. And across sectors in which they were operating in, across this one, they had tried to channelize funds. And so all these has led to the ethos of the promoter itself being questioned, the executives of the group itself being questioned, their credibility and I would think, their integrity, all up for question. So from that perspective, the right question to ask is whether such a group should be allowed to bid for such large projects in the first place, if anything, till their reputation is clear.
I wanted to, bring a broader question to you now. So during the day today, we heard the story about Jet Airways, where the Supreme Court has said that they're going to go ahead with liquidation of the airline, right? And over the last 10 years, now we have seen multiple large business conglomerates go down. Their businesses completely unraveling, and these once celebrated promoters not really being seen anymore on the ground. I just wanted to get your view, what does this change look like to you? Large promoters probably no longer in the business. We are now actually seeing new guys coming into the picture and starting to form the new face of India Inc. How are you seeing this change?
Definitely. See, obviously, banks are these days behaving differently. Banks definitely are ring-fencing their, I would say, lending to promoter groups. No longer are they relying just on the name of the promoter. Two is directed lending, politically intervened, and directed lending has come down a bit from the heydays. Three is the IBC process of 2016. Definitely, the insolvency and bankruptcy process definitely enables banks and the committee of creditors to go and seek out this one if there is default and the like. And so that is the strengthening, and that's where the entire banking system has been cleaned up of the NPA mess of the past 10, 15 years. So from that perspective, the bankers should not just rely on the names of people or the purported reputation. They should look at the project feasibility and viability and fund it from that perspective. Business failure is accepted, right? The entire IBC process relies on the fact that bankruptcy is fine. I mean, there is no shame towards bankruptcy as long as it's business failure. Only integrity and ethos and channelizing funds to promoter entities from the main project companies, etc., that is not accepted.
What you're essentially saying is, there are several of these big business owners which become larger than life, and there is a certain trust that people attach to these people. But obviously, it's quite misplaced.
Yeah, that's what happens. I mean, even if a company comes out with a public issue, with its IPO, say, obviously investors are trusting the promoters and the management to with their hard-earned money. So that is an element of trust. Similarly, bankers are also trusting the banking fund, which is effectively depositors' funds, including your funds and my funds, which are lying in banks. Bankers are trusting the promoters to execute the projects. Yes, there could be project failure. That is the entire element of lending, right? I mean, lending, there is a risk that some part of the amount lent will not come back. That is the entire banking system. But what is not accepted is promoters channelizing it, taking it away from India, gold-plating projects, inflating project costs unnecessarily, and then obviously taking money out of the project companies and then using it for personal, I would say, building personal mansions, aeroplanes, and the like, and not paying back the money.
Do stay with us. Vishy, I just want to ask you this. You were the one who uncovered the story for us. What's very interesting is the manner in which this fraud was perpetuated. You have someone with a fake email ID that's given. And this goes to the last leg of the tendering process, and then we come to know that this entity has now been barred for 3 years, action is being taken. But what I wanted to ask you was that can SBI, which was supposed to be the lender in this case, actually take legal action against Reliance Power, because they also suffer reputational damage, don't they?
Yeah, so there are two ways to look at it. One is financial loss, right? Like if SBI were to, for example, if these at some point in time these guarantees were to be called, and what essentially this process means is that the foreign bank is liable to pay for the company. That's what a bank guarantee is, and the endorser pays on behalf of the first of the foreign lender. Now, if there was a financial loss involved in this case, then I don't think any bank would have just sat back and taken this. They would have definitely gone for legal action against the promoter. And especially if these were false documents. That's what happened with the Punjab National Bank, because when Nirav Modi's bank guarantees LOUs were encashed, it was realized that Punjab National Bank had never actually issued these. That's one side of the story. The other side of the story is the reputational